A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication.
Good morning, ladies and gentlemen. I request you all to kindly take your seats. We can expect our chief guest anytime. Good morning, ladies and gentlemen. Our chief guest, Governor RBI, is already here. We can expect him any moment. Request all of you to kindly take your seats. Good morning, ladies and gentlemen. I request you all to kindly take your seats. We expect our chief guest to arrive any moment. Good morning, ladies and gentlemen. Our chief guest is here. I request you to kindly take your seats.
Good morning, ladies and gentlemen, and a very warm welcome to all of you to the 20th edition of the FICCI IBA Annual Banking Conference, which over the years has emerged as one of its kind because of, the presence of all of you and many dignitaries over here. The theme for this year's conference is helping India step change its growth, how tech-enabled banking can contribute to realization of the $5 trillion economy goal. And technology and digitization has been is a theme that this platform has been following for almost a decade now. And of course, it's great to have you all back in person at this conference after a 2-year hiatus, and we can really feel the energy and the vibrance in the room. Of course, my thanks to the Honorable Governor RBI, Mr. Shaktikant Das, for making time to be with us this morning and address us once again at the FIBAC, the 20th edition. With these words, may I request Mr. Sanjeev Mehta, the FICCI President, and Mr. A.K. Goel, Chairman IBA, to kindly felicitate the Honorable Governor with a thicket of trees, which is a green certificate, our ecological way of welcoming our guests. So this is a thicket of 10 trees in the Sundarbans National Park in your name. So without further ado, may I request the FICCI President, Mr. Sanjeev Mehta, for his opening address, please.
Morning, ladies and gentlemen. A very warm welcome to all of you. On behalf of all of you, I'm extremely delighted to extend our gratitude to Mr. Shaktikanta Das, Governor, Reserve Bank, for joining us. Mr. Governor, sir, we have gathered to discuss the ongoing developments, opportunities, and challenges faced by the Indian banking sector and our economy. Over the years, FIBAC has played an instrumental role in bringing together the key stakeholders in the financial sector and laying down the policy contours for future. The global economy has been overwhelmed by the fallout of geopolitical conflict in Europe, which threatens to derail economic recovery that was underway post-pandemic. Many advanced economies are going through a phase of slow growth along with high inflation, posing a significant risk to the global demand. As per the latest assessment by the World Bank, global growth is expected to slow sharply from 5.7% in the previous year to just about 2.9% this year. As per the World Bank, many countries will find it difficult to avoid recession in the coming year. However, in case of India, we have seen a far better recovery. We are also expected to outperform most large economies in coming years. We must applaud the government and Reserve Bank's prudent policies that are helping us navigate the massive turbulence. Be it the policy reforms, ease of regulations, or fiscal support via high public capex, the accommodative stance of the bank when it was needed during the pandemic, or taking steps to contain inflation at present, the government and RBI's proactive approach has worked well. The role of RBI has been extremely important. I would like to thank the RBI Governor for his strategic decisions that have helped ensure financial stability. Mr. Governor, sir, the decisive steps taken under your guidance helped ensure market confidence, prevent contagion to other segments of the financial market. The bank's balance sheets are much stronger today, with higher capital adequacy, reduced NPAs, higher provisioning cover, and improved profitability than in the previous years. India is charting a different course of recovery from the rest of the world. The post-COVID-19 Indian economy, driven by increased digitization, the planned rollout of 5G, and a gradual transition to green energy, presents exciting opportunities for businesses and a society at large to adapt to a new way of life. As the team at RBI rightly put it in its August 22 monthly bulletin, India's time has arrived. We must seize the initiative with both hands. As the nation celebrates 75 years of independence and India enters into Amritkal, it is time for India to realize its potential and emerge as a global leader. What India needs is consistent, sustainable, inclusive growth of almost 8% per annum for the next few decades to realize the vision and aspirations of 1.4 billion Indians. The financial sector will, of course, have a key role to play in this journey. A lot has been done on the financial inclusion front, be it Jan Dhan or Mudra Yojana. The account penetration over the last decade has almost doubled, from 35% in 2011 to 78% in 21. After ATM and core banking, JAM, mobile banking, and payments through UPI are the transformative milestones in recent years. Today, India is a leader in digital cashless payments, even ahead of China. During the 6-year period between 16 and 22, the intensity of real-time payments has risen tenfold, from less than 5 transactions per capita per annum to nearly 52. However, we still have a long way to go when it comes to credit deepening in the economy. India's retail credit is only 14% of GDP, compared to 30% in Brazil and more than 60% in China. And 3/5 of the MSME credit in India is still sourced from the informal sectors. MSME credit continues to remain a challenging issue. The cost of financial intermediation in India continues to be high and has a direct bearing on the credit offtake. Banks can lower the cost of intermediation by enhancing capabilities and infrastructure. This would enable them to overcome information asymmetries and develop a culture of efficient operational design. For instance, a credit bureau or a credit registry could be evolved into comprehensive consent-driven information. Bureaus leveraging account aggregator framework, which enables stronger underwriting and monitoring. This would facilitate the creation of more dynamic and richer credit scores. The account aggregator framework can be further expanded to include beyond banking information, including government services, utilities, other information, such as warehouse receipts, e-way bills, crop information, etc. In essence, there has to be a greater adoption of transaction-related data if we have to give a push to MSME lending. Also, the inclusion of EPFO passbook, EPAN, and Form 26AS in DigiLocker would greatly facilitate the digital issuance of credit in a secure, transparent, and convenient manner. The move would benefit banks, finance providers, and fintech companies, as well as customers applying for credit. Technology, in fact, will be a great enabler to enhance the reach of banking across depth and breadth of the country. By embracing blockchain, banks can greatly reduce the time, cost, and risk of many transactions. As blockchains evolve to cross industries and more immediately verifiable data, including real-time access to assets and other forms of collateral, is captured and shared with banks, the pool of borrowers could expand to include the many small and medium-sized enterprises that are locked out of credit today. As we slowly step into the post-pandemic world, we must strive to be ahead of the curve in designing and nurturing a financial system that is resilient and sustainable. The role of banks in financing the transition to a green economy will be crucial. While we have set clear goals, We need to pace up the adoption, and that would require addressing key challenges related to borrowing costs, plurality of green loan definitions, maturity mismatches between long-term green investment and relatively short-term interest of investors, etc. Green financing will get a push if priority sector lending guidelines are revised to enhance qualifications of financing of green projects by bank. This would help improve lending appetite to the sustainable sector. Banks should also actively explore new and innovative ESG-aligned products and services. I'm hopeful that going forward, more policies would be put in place to help increase green finance and not let risk management become a bottleneck for financial flows towards green investments. Of course, RBI is working on many of these areas, including the recent discussion paper issued on climate risk and sustainable finance. During this two-day conference, we would be hearing many industry stalwarts deliberate on several areas, including how digital finance could unlock India's higher growth potential, the role of banks in financing transition of Indian industry and meeting India's national commitments, rethinking SME lending businesses, and many more crucial areas pertaining to the banking industry. I'm sure all of you will find this edition interesting and insightful. For us at FICCI, it has been a great and cherished partnership with the Indian Banks Association to build this program together. And I would like to thank all members and the leadership of IBA, especially Mr. Goel and Mr. Mehta, for their continuous guidance and support. We are also thankful to all our partners and support institutions for showing confidence in this engagement and being with us. With these words, I once again welcome all distinguished speakers and guests to FIBAC 2022. Thank you.
Thank you, Sanjeev. You just laid down some trends that are emerging, particularly the digitization and sustainable finance, and of course, challenges which RBI, of course, is seized to often working on. May I now invite Mr. A.K. Goel, Chairman IBA, for his welcome address, please. Over to you, sir.
Thank you, Jyoti. Good morning, ladies and gentlemen. Honorable Governor of RBI, Shri Shaktikant Das Ji, Shri Sanjeev Mehta, President FICCI, Shri Amitabh Chaudhary, Chairman FICCI Banking Committee, Shri Saurabh Tripathi, MD and Senior Partner of BCG, Shri Sunil Mehta, Chief Executive IBA, and Ms. Jyoti Vij, Deputy Secretary General, FICCI, and all the participants to this conference. Once again, very good morning and very warm welcome to all of you in this flagship annual conference of the IBA and FICCI. This joint conference of the two reputed organizations under the brand of FIBAC is entering in 17th year. Thankfully, we are in a position to convey this conference physically. As you all are aware, last 2 years, on account of the pandemic, we could not hold this conference physically, and we have done this virtually. Hence, today it is a special occasion for all of us. I, on my behalf and the behalf of the IBA as well as the FICCI, express our gratitude to the Honorable Governor for his gracious presence to this conference. Ever since the FIBAC was started, we have taken care to ensure the theme of the conference should be relevant and important in the present constraint. Today, technology is playing an important role in almost all the sectors of the economy, and the financial sector is the one which uses and benefits from this adoption of the technology in a very big way. Against this backdrop, the overall theme of the conference, helping India step changing its growth, how tech-enabled banking can contribute to realization of $5 trillion economy goal, is quite relevant. I understand that our knowledge partner, Boston Consultancy, will be releasing a report on the theme shortly, which will provide further insight to the overall theme. As you all know, the government initiated the Digital India program with a vision to transform India into the digital empowered society and knowledge economy a year ago. The focus is to bring transformation to realize India talent plus information technology to become India tomorrow. Since the adoption of the program, several initiatives were introduced by the government to improve the digital infrastructure, service and empowerment. These initiatives have helped us to improve the bank digital offering and also to improve the overall efficiency of delivery of the service to the citizens. Banking sector, which plays a key role to the overall development of the economy, embrace technology in a big way. Digital India helped us to integrate our service with the various initiatives of the government as Aadhaar-enabled payment system, etc. And we have brought the entire banking system together and created a unified payment system. Additionally, the bank are exploring and adopting various technology development like artificial intelligence, machine learning, cloud compounding, bank blockchain technology, etc. with a view to improve further their product and service offering on the one hand and to give the customer an excellent experience on the other hand. While adopting digitalization, banks are also mindful and embracing the principle of the inclusive banking as well. Over the last decade, we have seen the maximum innovation in the payment space with Fintech that bring with the new ideas that are easy to understand and adapt. Banks are collaborating with them to improve their offering, and Fintech are also benefited by this collaboration. I would like to tell that as on date, Fintech are not the competitor to the bank. They are equal partner in the journey of the banking industries. I must add that Reserve Bank of India is playing a key role to encourage the innovation, and at the same time, regulations are being made to ensure that all players in the payment ecosystem have an element of accountability and level playing field. Domestically, banks are the key players in the meeting of the funding need of the growing economy. Today, India is a $3.3 trillion economy and envisages to become a $5 trillion economy in a few years' time. Reforms like Make in India, CapEx reform undertaken by the government in the roads, airports, energy system are going up and expected to yield result in years to come. Each sector of the economy, be it is a agriculture, industrial sector, including the MSME and service sector, have to adopt the technology in the best possible manner to integrate their operation within the sector. We cannot have growth without keeping the sustainable part in our mind. Our national goal is for reducing the emission intensity of its GDP by 45% by 2030 and derive around 50% electricity from non-fossil fuel-based energy resources by 2030 and to achieve net zero by 2070. All these are important milestones to achieve. Banks' role in all these areas is to help the economy reach its target through funding the needy segment and also to create awareness among the customer on digital platform and create awareness on the cyber security issues and also to ensure that their internal system and processes are also made robust so that the customer are not compromised in any ways. The session of this conference deal with each and every area of the economy and how the development in technology are helping each segment to improve and expand their area of operation. Care is also taken to include the human resources challenges in the increasing digital world and how the sustainability should be a core area of focus in all the policies. All these sessions are significant in today's content. I am sure the participant will have a great experience during these 2 days of the conference and have good learning from the views of the expert and discussions. I welcome all of you to the conference and wish you the enriching deliberation. Thank you very much.
Thank you, Mr. Goel. Indeed, the technology and fintechs are being embraced by the banks to enhance the productivity, and of course the challenges like cybersecurity are being dealt with. We now move to the release of the FIBAC 2022 report, a report which is always, it's something which the entire banking fraternity looks for. So may I request the Honorable Chief Guest, Mr. Shaktikant Das, Governor RBI, to kindly release the report, sir, and may the copy be presented to all those on the dais. So the FIBAC productivity benchmarking, it covers bank productivity across 2,000 plus metros. Sorry. So the benchmarking covers bank productivity across 200 plus metrics, and this year we've also undertaken a survey with 2,000 plus heterogeneous consumers and 1,000 plus heterogeneous MSMEs in India to get on-ground pulse regarding various themes. As part of the FIBAC report, insights from the survey would be shared with various themes like product features, preference, digital journey experience, channel usage, trend, etc., and will also help industry offer product and services in line with the demand and the growth. May I now request the knowledge partner, BCG. So we have Mr. Saurabh Tripathi here, who's the senior partner and global leader of Fintech and Payments, BCG, to kindly talk about the theme here and present some findings of the survey as well.
Honorable Governor, leaders of banking industry on the dais and in the audience, leaders of the industry, very good morning. And it's a great privilege for BCG to have been the knowledge partner for this important event in the industry for the last 11 years. I'd like to start by congratulating the industry, because this quarter we are starting to see the green shoots, so to speak, after several years with much faster growth in credit and also an uptick in productivity. So we believe that golden period or next 5 years, fingers crossed, will be a strong period where banking industry can invest in its future. And that is one of the themes that I would like to cover today in this presentation. But before that, Governor Sir, I would like to also congratulate you for the launch of CBDC. In my role as a leader for Fintech in BCG, I cover the whole world and I see every single central bank in the world trying to launch it. But your paper was the best. It was the best that any colleague of mine anywhere in the world has seen in terms of quality of thinking, clarity of vision and roadmap, and also the credibility that India will be among the first few countries in the world to roll out CBDC at scale. And of course, that is just one of the things that's going to happen in our ecosystem that our financial industry has to deal with. The title of this year's paper is Riding India's Digital Supercycle, and how the spirited pursuit of public digital platforms as a national strategy in our country is putting a lot of pressure in a positive way for our financial institutions to move much faster and much bolder digital transformation to keep pace with what's happening in the ecosystem, to keep pace with the customer expectations. And we believe, we've done some numbers, that there are handsome rewards for those who do, but also we believe that there is a risk to handle. We all have seen how UPI, within 5 years of its launch, dramatically changed the landscape. And this is what happens with at-scale implementation of digital programs which are successful, where customer adoption happens. And in our case, because government is behind some of these things, adoption does happen. And in 5 years' time, we've also seen how big tech completely dominated the customer interface for UPI. And our expectation is that in next 5 years, the same will happen to the SME space in the country, as the large number of digital platforms that the government is pushing for whether e-commerce with ONDC, agri stack, health stack, you name it. Every ministry in the government wants to create a stack for a good reason. And that will drive a lot of businesses onto digital platforms. And once businesses go to digital platforms, their buying behavior changes. And they are much more keen to work with the digital platforms to get all their services, including banking. So we do have a high pressure from the customers for banks to transform themselves. We have just launched the aggregator framework. We did, as a part of the study, ask customers, what is your expectation from the aggregators? And their primary expectation is, okay, we will share data, but what will we get in return? It can't be just to improve banking sector's productivity. We need better services. So expectations will be high. Another very important point is, unlike our banking industry has adopted technology in a big way, we all know that, but unlike the first phase of technology adoption, this second phase of digital transformation is 10 times more difficult. Not only the demand is for our technology stack to mirror that of e-commerce players in terms of its scalability and in terms of versatility, adoption of cloud, so on and so forth, but also the cultural transformation that is required inside banks is a humongous task. The amount of talent that has to be inducted is very big. And we believe that some of these cultural changes are too big. And not all banks in the ecosystem are going to be able to deal with it. And those who will deal with it will improve their profitability, will improve the performance. But we do see, Honorable Governor, the need for proactive action, for more consolidation in light of what the industry might look like in 5 years' time. Banks do need support from the government. Singapore government has something called SingPass, which allows KYC with just facial ID. I think it's time for our Aadhaar system to be enhanced to get there. That will reduce KYC costs from current 50, 60 rupees, even with video KYC, to just 10. But the most important thing that we need is a digitization of our secured credit. Sir, we have seen how beautifully unsecured credit in our country has got digitized. People can get loans within minutes. But the same is not true for secured credit because it has a lot of physical legs. And that's where I would like to request that we extend our belief in blockchain that we are doing with CBDC to something that is even more disruptive, positively disruptive to banking sector, which is tokenization of real assets. If a lot of real assets, real estate, for example, were to be tokenized, the secured credit can be made liquid in the same way that unsecured credit is today, with people being able to mortgage their assets very quickly, release them, repay their loans. Banks can actually digitize the whole process end-to-end. So that is going to create a much more higher productive banking sector, and that is where we need support. And also, a very important point is, as we survey across the world, most of the industries get a lot of tax incentives for the research and development they do. Many banking industries also across the world get tax incentives for R&D. I think it's also important that our own banking industry, for all the investment that is required to create India-specific digital platforms, do receive tax incentives to move forward. With those words, Honorable Governor, I think RBI is regarded as one of the wisest regulators in the world. And I do say it with full appreciation of what it means. I think we need to embrace the idea that banks will engage now in very agile ways of investments, and that requires certain appreciation from our supervisory framework as well. A lot of investment is needed, and that investment does not follow the traditional model of deciding upfront what we are going to create. They have to change every 2 weeks. That's how technology investments in the new domain work. And also, we have to obviously think about what it means for consolidation of the industry in light of the systemic risk that this transformation is going to create. Thank you very much.
Thanks, Saurabh. Always insightful addresses from you. Thank you for that. We now turn to, of course, our chief guest, Shri Shaktikant Das Ji, the Governor RBI. He, of course, needs no introduction. With a past career in bureaucracy and current role as Governor RBI, Shri Shaktikant Das Ji has been a pioneer in bringing economic reforms. His deft handling of the economic challenges during the pandemic has played a key role in India's financial resilience and swift recovery from the unprecedented crisis that we faced. Thank you once again, sir, for being with us, and may I request you for your inaugural address. Request everyone to please welcome him with a round of applause.
Yesterday, we launched the trial of our CBDC project. It was indeed a landmark moment in the history of money, in the history of currency in our country. Going forward, it will be a landmark moment. It will be a landmark achievement so far as the functioning of the entire economy is concerned. So in that sense also, it's going to be a major transformation of the way business is done, the way transactions are conducted. And the Reserve Bank is among the very few central banks in the world which have taken this initiative. Last month, we launched also a pilot project on end-to-end digitized KCC loans, Kisan Credit Card-based loans. The pilot projects are now in operation in the states of Madhya Pradesh and Tamil Nadu, based on its end-to-end digitization. So whereby the customer, the KCC, that is the farmer, he applies through his mobile, then the system handles it straight away. The bank processes it. The data from the credit rating agencies, that data flows in. The satellite data is used through artificial intelligence to analyze the state of his land at that moment and what was cultivated in that land in the previous years. So it's an end-to-end digitized, process. A complete digitized process to grant the loans. The farmers don't have to visit the bank branch once or twice or thrice. Process of documentation is simple, and our effort, our endeavor, in association with the participating banks and the state governments concerned in this case, to ensure that the farmers get the loan at absolutely minimum amount of time. Depending on the learnings that we have from the CBDC pilot project and the learnings from this end-to-end digitized KCC loan, our endeavor is following. Number one, to try and launch the CBDC in a full-fledged manner in the near future. In fact, incidentally, the retail part of the CBDC trial will be launched later during this month. We will announce the date separately. But I don't want to give a target date by which time the CBDCs will be launched in a full-scale manner, because this is something where we have to proceed very carefully. This is the first time the world is doing it. We don't want to be in a great hurry. We want to learn from the experiences of the way the projects, the pilots are running. There will be some technological challenges. There will be some process challenges. We want to iron out all those aspects and introduce it in a manner that the whole process, the whole introduction and thereafter is non-disruptive. Similarly, second point I want to mention is that based on the learnings and experience of this end-to-end digitized KCC loans, our endeavor would be to launch it in a full-scale manner, everything going all right, not only for the farmers' loans, but also for the small and also for the SME loans. And if everything goes all right, we hope to do that, launch it on a nationwide basis sometime during the year 2023. I'm not referring to financial year, I'm referring to the calendar year of 2023. Of course, we are working closely with our banking partners. In fact, it will be extended in due course to all the banks. Currently, it is being done by 2 banks. 2 more banks are about to be onboarded very shortly. The banks will have to upgrade their technology simultaneously. And what is more critical is that the state governments also need to completely digitize their land records and the process of verification of the title, so that the title verification process also is simplified. Good morning, everyone. Shri Sanjeev Mehta, President FICCI, Shri A.K. Goyal, Chairman IBA, Shri Sunil Mehta, Chief Executive of the IBA, other dignitaries on the dais, members of FICCI and IBA, friends from the media, ladies and gentlemen. What I mentioned earlier was by way of a starter. Now I will get into the main course. I'm happy to be here, and I'm also extremely happy to have been invited to this annual FIBAC 2022 conference. I distinctly remember that I was here in this hall participating in the FIBAC 2019. That was 3 years ago, so therefore I am doubly happy to be back after a period of 3 years. Now this is an important forum for the banking industry as well as for business. We have the presence here of thought leaders, banking practitioners, stalwarts from the industry, and several technology players, some of whom have put up their stalls just outside this hall. So I'm extremely happy and delighted to be in a gathering like this. Now this conference is being held at a time when the global economy is going through a process of churning. Triple shocks of COVID-19, the war in Ukraine, and the current financial market turmoil have created a toxic mix of factors and circumstances which every country has to grapple with. The International Monetary Fund, in its recent annual meeting, has presented a rather somber outlook for the world economy and the world trade. And it has also gone on to make downward revisions in its growth projections for the current year as well as for next year, and also downward revisions in the volume of global trade. The existing international order is undergoing fundamental shifts in terms of geopolitics and economic relationships. Now, the confluence of these factors and circumstances is reverberating speedily across jurisdictions through various modes and spillovers. With monetary policy actions and stances undergoing a regime shift in the advanced economies, financial conditions have tightened sharply across markets and have accentuated financial stability and have accentuated what I call, financial stability risks. Emerging market and developing economies, that is EMDs in particular, remain highly vulnerable to these global spillovers. Capital outflows have led to reserve losses, sharp currency depreciations, and spiraling imported inflation pressures, and this has happened across EMDs. Several countries face acute debt distress, while many others are confronted with elevated food and energy prices. Conventional and technocratic policy making is increasingly getting challenged by unconventional and out-of-the-box approaches. In this unsettling global environment, the Indian economy has been growing steadily, drawing strength from its macroeconomic fundamentals and buffers. According to the IMF, India is slated to be one of the fastest growing major economies of the world in the current year as well as in the next year. Our recovery and growth have been more broad-based. Our policies, fiscal, monetary, and regulatory, were prudent, targeted, and time-bound. We were careful to ensure that demand remained in balance while supply conditions improved. As per the high-frequency indicators for the recent months, and in Reserve Bank we monitor nearly 70 high-frequency indicators on a real-time basis. Now, as per these high-frequency indicators, especially for the recent months and the weeks, we find that private consumption, especially urban demand, has remained quite healthy. The contact-intensive services have continued to make smart rebound, and aided by unfettered resumption of activities and full-fledged celebration of festivals after 2.5 years. So you see huge amount of participation we all saw during the Ganapati festival in Maharashtra and other places, and also during the Diwali festival. And as the data is trickling in and flowing in, we find that the sales of various, the overall retail sales of various goods, the white goods and other fast-moving consumer goods have also improved considerably. Now, amidst all this, external demand, however, remains a weak spot in the face of accentuating global economic slowdown. Domestic inflation remains elevated, We are closely monitoring the inflation trends as well as the effect of our past actions. In our view, that is in Reserve Bank's view and in my view, price stability, sustained growth, and financial stability need not be mutually exclusive. In the Mahabharata, during the famous Swayamvara, when the great warrior Arjuna was aiming at the eye of the revolving fish. You know, there was a fish and the fish was revolving during the Swayamvara. I'm quite certain, and he was looking at it through a pool of water which was underneath. I'm quite certain that he would have certainly assessed the speed at which the fish was revolving, the wind conditions prevailing, the intensity of the ripples in the pool of water below, the noise levels in the king's court, and similar other factors. No one can match the prowess of Arjuna, but our constant endeavor is to keep an Arjuna's eye on inflation, which is our primary target. At the same time, we keep assessing other related factors like the evolving inflation growth dynamics, soft indicators like our surveys of consumers and surveys on consumers and businesses, global macroeconomic, financial and commodity market developments, and aspects of financial stability. In other words, our policy measures are based on an assessment of the overall situation. We will continue to steer our policies accordingly. In this direction, our continued effort is to put in place strong institutional frameworks to ensure a sturdy and resilient financial system that would be ready for the challenges in the future. Let me highlight what I have done is actually I have highlighted about 5 specific areas, but I will not read out that part of the speech. I would rather, speak in a more informal and in a more conversational manner. And the 5 areas are, the first area is basically, I've talked about the monetary policy framework and flexibility. As I have said earlier on several occasions, and as our various publications from the Reserve Bank have explained from time to time, during the pandemic, we utilized the flexibility embedded in our monetary policy framework to tolerate a slightly higher inflation, but within the range of 2 to 6%, to ensure that the economy, overall the economy remained resilient and financial stability was maintained, with a clear objective that when situation normalizes, we will bring down the inflation to 4%. Now, in the process, today, we are in a situation where, the inflation has remained above 6% for 3 consecutive quarters, and under the accountability norms which are provided in the Reserve Bank of India Act, we are expected to send a report to the government explaining explaining as to why it happened, what measures we propose to take, and by which time we expect inflation to come within the target range of 2 to 6% and closer to 4%. This is what has been provided in the law. We are having a monetary policy meeting tomorrow. There's a lot of media reports and a lot of speculation about the whole process, because this is the first time India is experiencing something like that. The Bank of England writes this letter almost every month for the last 1 year or so. There are other central banks which also write similar letters. For them, it's not the first time. But in our country, the inflation framework itself is pretty recent. It was instituted in 2016. So the MPC will meet tomorrow and we will prepare a report and we will send it to the government. There is also some amount of speculation about what the Reserve Bank will write, and some people have gone on to conclude, based on what I replied in a post-monetary policy press conference. They asked whether the RBI will release it. I said, no, the RBI will not release it. It's for the addressee, the government, to decide and do the needful in this regard. Now, questions have been raised about transparency of monetary policy, transparency of what we are doing. This is such a sensitive bit of information. How can RBI keep it under the wraps? The entire monetary policy framework which was instituted in 2016 is based on very strong principles of transparency. The minutes of the meeting are released as soon as the meeting is over. The minutes of the meeting, the resolution of the MPC, it gives out what are the decisions and why those decisions have been taken. After 2 weeks, the minutes of the individual members are also released so that everyone knows who said what and how it facilitated a decision making. So the expectation is that since we release the monetary policy resolution on the day of the MPC, why don't we release the letter itself also on the day of the MPC? You see, I just want to place before you for consideration, and I would like you and the others who may be, listening to this this speech through the RBI YouTube channel, and let me say that the RBI YouTube channel and other social media platforms are also, live streaming this for the wider audience, especially from the financial sector. You see, the MPC resolution is meant for the entire economy. Immediately, the market should know what is the RBI's decision. Citizens of the country should know what is the RBI's decision. Unlike that, the letter in the case of a letter which which the Reserve Bank writes to the government, it's a report sent under a law. I don't have the privilege, the authority, or the luxury to release a letter like this which is written under the law as per the legal requirement. I don't have the privilege, authority, or the luxury to release it to the media before even the addressee gets it. There's so much of communication which goes on between the Reserve Bank and the government, both ways. We don't share each and every letter. But that is not to assume that the contents of this letter and the report are going to be perennially, under wraps. They will be available in the public domain at some point. So the limited point that I was making, and I don't want to be defensive about it because that is the legal position. I have no authority to just write a letter to government and then release it to the media. It's not like, in the political space, for example, there are leaders who write a letter to the government and immediately release it to the media. That is for a different purpose. Here, the first right of receiving the letter lies with the government. The addressee should get it first. In due course, sooner than later, it will be out. The Parliament will know about it. The Standing Committee of Parliament will know about it. It will be really, the contents will be known. So it is not as if there is transparency being compromised in any manner. And I want to say it very emphatically that the monetary policy framework instituted in 2016 is a very transparent framework. And the writing of the letter is also very much an essential and fundamental element of that transparency. Nobody is hiding anything from the public, but it's a question of time. And I think it should be seen in that context. In fact, I can say that the framework itself, we give it a lot of importance. When the framework had to be re-notified in 2021 March, in 2021 March, for the next starting 1st April 2021. There was speculation, and in fact, there was some argument in certain sections that the target itself should be, increased. The median point instead of 4% should be 5%. In fact, people have also questioned the necessity of a framework for a country like India. But we stuck to the framework which was instituted in 2016 because it was instituted after a lot of consideration and a lot of research within the RBI. And the RBI research showed that the mean point of 4% has its relevance for maintaining overall macroeconomic stability and for supporting growth. And any inflation above 6% can be detrimental to growth. So the whole purpose of having an inflation framework for the convenience of the people, for keeping prices low for the people, or for ensuring financial stability and economic growth, the purpose would be lost. So therefore, we reiterated the importance of continuing with the target, and we were very happy, and that that the government also appreciated our point of view. The government agreed with our point of view, and they have re-notified it. So on the first aspect I have highlighted here is with regard to, I have said few other things about our forecasting methods, about digital rupee, etc. I am not going into the detail of it. The second aspect which I have highlighted is that the second component of our effort to ensure financial stability is to bring about systemic changes, to bring about reforms in various key segments of the financial sector. During the pandemic and during this entire crisis period, the Reserve Bank continued to work as if it was normal time. It was, in fact, for Reserve Bank, our working hours, at least for the top management for the first year, and thereafter almost for everyone, it was business as usual. And I would like to place before you, I have listed out the kind of reforms which we have carried out in the financial sector. And we have instituted new frameworks, new regulatory guidelines in several areas. And these include, one, the guidelines on governance in commercial banks. We issued it in April 2021. Number two, a steady state prudential framework for resolution of stressed assets in June 2019. This was after the Supreme Court struck down the earlier circular on resolution of stressed assets, whereby one-day default led to a default and a process of resolution had to be initiated. After the Supreme Court struck it down in 2019 June, we have instituted a new framework. That was the second major step with regard to, sort of streamlining and reforming our regulatory framework for the financial sector. Three, securitization of standard assets, and this was done in July 2021. Four, very important, scale-based regulatory framework for NBFCs in October 2021. Five, revised regulatory framework for urban cooperative banks in July this year. Six, guidelines on digital lending, which were issued in September this year. Seven, revised guidelines for asset reconstruction companies in October this year. And number 8, issuance of a discussion paper on climate risk and sustainable finance in July this year. So as you can see, continuously we are focused on bringing about regulatory changes in which will affect the financial sector and which keeps the financial sector resilient and ready for the requirement of the future. We are talking of India at 100, we are talking of India at 2047, we are aspiring to become a 5 trillion economy and then go on to become the 4th or the 3rd largest economy after some time. Now, we want to prepare our financial system for that kind of challenge and to sort of be in sync with the requirements of the time. The third area where we have, again focused a lot is with regard to the supervision in the financial sector. I'm not going into it in detail. I have talked about it in at great length in many fora earlier and separately, but the thrust is now more on identification of the root causes of vulnerabilities in individual entities as well as in the financial sector as a whole, and to ensure that suitable measures are taken for mitigation on proactive basis. The fourth aspect which I have talked about, this speech will be, a copy of this address will be uploaded in the Reserve Bank website as soon as my speech is over. So those of you who are interested can have a look at it, and especially from my, for my friends from the media, many of whom are present here, you may have a look at it as, as you have done earlier. Now, the fourth aspect where we are focused is on developing financial markets. The development of financial markets has been a key priority for the Reserve Bank. We have been undertaking calibrated reforms to develop vibrant and resilient financial markets. These reforms, that is the reforms which we have undertaken, among other things, they seek to remove market segmentation, facilitate access, including access for non-residents, widen the participation base, promote innovation, and ensure customer protection. The other details are given here. I am not going into it. The fifth aspect which I have highlighted relates to the payment systems in India with focus on interoperability, cross-border linkages, and innovation. This has been talked about quite a lot. And let me also mention here, it was during the COVID-19 pandemic that we introduced 24/7 NEFT in January, I think in December 2019, if I remember correctly, and 24/7 into 365 RTGS, and that was, we are one among the few countries in the world to have 24/7 into 365 RTGS operations. We introduced in, if I remember correctly, in, I think that was done in December 2020. And there are very few countries which have done. The UPI has, as all of you know, has emerged as a major innovation, has emerged as a real, I think it's being talked about all over the world. We have brought about, we have also brought about, we have set up this innovation hub. We have introduced a regulatory sandbox. We have also recently announced a sandbox for, hybrid products and products which, involve several regulators. So all these things I have mentioned in my speech, and I'm not going into that. Now, I think I'm overshooting the time, so sorry about that, but I think, I'm speaking after a long time in the public fora, so, and there is a lot of interest, I'm sure, so I must utilize the opportunity, and I sort of request your patience. Now, I have talked about the triple shocks of COVID, the war, and now the financial market turmoil. I don't know what is in store for us next, but we have to be constantly, prepared. As we stand here, or as you stand in your respective places, in your businesses, or in your institutions, or in organizations, if you look at how the Indian economy looks today, I think India today presents a picture of resilience and optimism. And this was the sentiment which has been expressed by many countries in our interaction with them last month when I participated in the IMF annual meetings, and not only in the IMF plenary, but also in our bilateral discussions with several other countries, the central banks and finance ministries who were present there. Now, how this has been possible? I think that is something which needs to be kept in mind, and we should not forget. Much has been made about RBI, not being able to adhere to the inflation target. But I would request you to consider, just step back for a moment, pause for a moment, and think about if we had started the process of tightening earlier, what would have been the counterfactual scenario? What you prevent in the process doesn't get the kind of appreciation that it should get. We prevented a complete downward turn of our economy after recording negative growth in the year 2020-21. India's economy, bounced back in 21-22 and sustained in 22-23 and also next year. Now, how was it possible? If we had prematurely started tightening, there is a lot of public debate. I think history will judge. There will be several points of view expressed. But it is our sincere and firm belief, and especially in the early part of this calendar year, in January, February in particular, when we looked at the inflation trajectory, our assessment showed that the inflation during the year 22-23, that is the current financial year, the average inflation would be 4.5%, CPI headline inflation. We had done our scenario analysis. We had that time, nobody had thought that the oil prices, the crude prices will shoot up so much. We had done our internal analysis, assuming $100, and that time the oil, crude oil was about $82, $83. We had assumed $100, which was, the kind of extremely high level, which, so we just did a scenario analysis, and even then we found that the inflation is going to be around 5%. So we didn't want to upset the process of recovery. We wanted the economy to safely land in the turbulent waters through which the economy had been sailing through the period of COVID. We wanted the economy to safely land the shores, to reach the shores, and thereafter try and pull down inflation. But then on 24th February, you had the commencement of the war, and within a matter of 3-4 days, the crude oil prices, the commodity prices, the food prices, you know, large number of countries are importers of food from that part of the world. Wheat gets imported, edible oil gets imported. In India, we import a lot of sunflower oil from the Black Sea region. And when international prices of wheat went up, in India, despite India being a surplus, despite India being surplus in wheat, our domestic wheat prices also went up. And crude prices, it hit $130 per barrel, then it came down to about 120. And it stayed around 120, then it hovered between 110 and 120. So 24th February completely changed the entire picture. And it was not just our analysis of that during the current year, the inflation would be 4.5%. Even the professional forecasters had projected the inflation to be anything between 4.5% to about 5.1 or 5.2%. So that was the expectation. So therefore, the counterfactual also needs to be appreciated. In the process, yes, there has been a slippage in our inflation targeting, in our capacity, in our ability to maintain the inflation below 6%, but it would have been very costly for the economy. It would have been very costly for the citizens of this country. We would have paid a high cost. And I think that is something which needs to be appreciated. The timely actions, the Reserve Bank has been taking timely action. When the COVID hit us, the nationwide lockdown was announced with effect from 25th March 2020. 5 days before that, or 6 days before that, we had started our quarantine facility of all our market infrastructure. 200 service providers and RBI employees were put in quarantine, and that quarantine lasted for almost 2 years. 27th March 2020, we announced the first set of COVID relief, COVID support measures. And we, in quick succession, 27th March, April 17th, and on 22nd May of 2020, in three quick successions, we announced several measures. More than 100 measures were taken during the COVID. When Delta suddenly suddenly hit our country in April and May of 2020, we came out with several measures, including provision of liquidity for contact-intensive services for the healthcare sector. We came out with a new resolution framework for the MSMEs because we wanted the MSME sector to be protected. Now, this year, when I have explained the background, when because of the COVID, because of the Ukraine war, when suddenly inflation spiked, and not just in India. I mean, you look at the inflation level in other countries, advanced countries where the inflation, in fact, the terminology of low for long, they were maintaining 2% inflation, and they were consciously trying, the central bank was desperately, they were consciously trying to push up the inflation a little bit because it was being negative. The real rates were negative for far too long. They are today at 10% plus inflation, CPI retail inflation. Our last inflation print, as we had expected, it has come more than 7%. Going forward, we expect the inflation to moderate. We have given the trajectory for that, so I don't want to, again, load you with that. So when that happened, the war came without any, the war came as a surprise. The war came with any advance notice. So we had to hold an off-cycle policy meeting of the Monetary Policy Committee. That was also a surprise. So, I mean, it's not possible. The war comes as a surprise. The war came without any advance notice. So we had to act quickly. We could not have delayed our action, just to maintain because we had not said and market would be surprised. Sometimes negative surprises will be there, and one has to be prepared for it. If the war gives a negative surprise, if the COVID gave a negative surprise, COVID gave a huge negative surprise. But that time, we gave a lot of positive surprises because we could afford to do that. And because of inflation targeting framework, our average inflation till the COVID-19 hit our country or the world, our average CPI inflation was 3.9% from 2016 to February 2020. So we had the space to do that. Similarly now, when the war started this year in February, in April we announced in our monetary policy number of measures. I am not going into it in detail. We started giving priority to inflation. We introduced SDF, you know what is, SDF, that is for liquidity absorption, and we increased the rates, instead of reverse repo, we had the SDF at, 40 basis points higher rate. So we had to act, but it was a negative surprise. But it was necessary and it was important to do it. And because we did that, today I can say with confidence that this whole debate about the Reserve Bank behind the curve, that debate has ended. It's no more there. Now, so therefore, I think this whole question I'm addressing about this inflation targeting and all that. Now, where do we stand today? The growth momentum has been sustained. Inflation is expected to moderate. The banking, the non-banking, that is the banks, the banking, the non-banking, and the entire financial sector is stable, it is resilient, it has withstood multiple shocks. In fact, the balance sheets of the banks are today looking very robust. I don't need to give the figures on GNPA, on the provision coverage ratio, or how well capitalized the banks are. The corporate sector balance sheets are also strong. And I'm happy to note that both banks and the corporate sectors, they mobilized a lot of capital or they did a lot of deleveraging during the crisis period of 2020 and 2021. The MSME sector has also withstood the crisis. The credit offtake, the latest data which we have released, which you have released, I think the data pertains to as on 7th October, or it's there in the RBI website, you can just see that. The credit flow is the highest in the SME sector. It's in the region of about 27% or 36%. One of them is about 27%, the other one is about 36%. I think the small industries are getting credit, the growth is about 27%, and the micro is about 36% or something. It's there. I may be slightly wrong in remembering these figures. So where do we stand? As I mentioned, the momentum is sustained. Inflation is moderating. The financial sector is stable and resilient. MSME sector has withstood the crisis. The excess liquidity which we had injected during the COVID-19 pandemic has been substantially drained out. We were, of course, we were also helped by our forex, intervention in the forex market. Credit offtake, as I just mentioned, has picked up. The 24/7 RTGS is fully functional. UPI is recording new volumes of transactions. The CBDC has been launched, and several other measures that have been announced, about which I talked. Now, all this, did they happen just like that? I think it happened because the Reserve Bank, the government, the banks, and every stakeholder in our economy, including the private businesses, the MSMEs, everybody, I think we all work together as a country and we have made it possible. And these are things, I think, which need to be appreciated. Now, I have taken again too long, but there are two aspects on which I'm sure there is a lot of interest, and I'm sure the participants would like to hear. One is on, the first one is on liquidity situation, the second one is on the exchange rate of the rupee, so it will be only fair that I address both these issues. Now, in the month of October, the interaction of global, first I will talk about the current liquidity situation because there is a lot of talk about liquidity being tight. Now, in the month of October, the interaction of global and domestic developments has somewhat tightened the liquidity conditions. Average daily absorption under the liquidity adjustment facility, that is LAF, amounted to rupees 1.35 lakh crore during the month of October. That is the liquidity at the end of the day which Reserve Bank absorbs from the banks. Now, this is compared to rupees 2 lakh crore, which was prevalent in September. The tightening of liquidity in October is attributed to several factors. During the month, currency demand was high on account of the festival season. This constitutes a leakage of liquidity from the banking system. That is when, the currency in circulation goes up, the liquidity available with the banks, that goes out to the hands of the people as currency notes. As currency, the Reserve Bank's forex market operations, along with GST and other tax-related outflows, also drained out liquidity. Banks partially ameliorated the liquidity stress by drawing down their excess CRR balances and non-SLR investments. Certain banks also took recourse to MSF. Now, this episode of liquidity strain is likely to be transitory on account of several factors. First, the leakage due to currency demand will slow down once the festival season is over, and it is almost over. And as the currency returns to the banking system, the system liquidity will improve. Second, government expenditure is likely to pick up after the monsoon season. Usually in the monsoon season, usually in the second half of the financial year, the government expenditures tend to pick up and gather substantial momentum. Third, the pace of forex outflows has moderated, which augurs well for system liquidity going forward. Net FPI investments, which were robust in August but turned negative in September, have resumed in October. And October, there were, on a net basis, there were inflows. Fourth, deposit growth of banks have also picked up in recent fortnights, and especially in recent fortnights, and is working towards bridging the funding gap associated with the double-digit credit offtake. Fifth, banks have adequate cushion of SLR to meet any potential liquidity requirement. In fact, the outstanding absorption of liquidity under the standing deposit facility stood at 84,768 crores as on October 31st this year. That is 2 days ago. The Reserve Bank remains agile and watchful, continuously monitoring the liquidity situation, and is ready to undertake liquidity operations on either side so that overall liquidity remains adequate to meet the requirements of the productive sectors of the economy. Now, our markets department is constantly in touch with the banks, with the businesses, and I mentioned about so many measures. One thing which I would like to say is that our entire approach has been very consultative. Even in matters of liquidity also, we are constantly in dialogue with the banks, with the market participants. Or during the times of COVID, we were having interaction with the market, with industry leaders, with industry associations like, and MSME and other associations, the Apex organizations. We are in touch with the market players, with the banks, and with the other financial sector participants. And as I mentioned, the RBI will take necessary steps as to ensure that there is adequate liquidity in the system to meet the needs of the economy. Now, let me now focus on exchange rate and Indian rupee. Exchange rate of the Indian rupee. And I would like to say as follows. In recent weeks and days, movements in the exchange rate of the rupee have been the subject of animated discussion in the media and in several other fora. Talk of unidirectional downward descent and the Reserve Bank's defense are dominating the narrative in the public space. It is therefore important to address the issue free of emotions and fully loaded with nothing but facts. On a financial year basis, that is from 1st April to October 31st, 2 days ago, the Indian rupee has depreciated by 8%. Over the same period, the US dollar has appreciated by 13%. This holds true even on a calendar year basis, that is from January 1st to October 31st. During this period, the Indian rupee has depreciated by 9.8%, whereas the US dollar has appreciated by 15.8%. On a financial year basis, almost all major currencies, barring a few, like, for example, the Swiss franc, the Singapore dollar, the Russian ruble, and the Indonesian rupiah. All other major currencies have depreciated against the US dollar by levels which are much more than the depreciation which we have seen with regard to the rupee. In fact, the Indian rupee appreciated against all other major currencies, barring, of course, these currencies which I mentioned, and of course the US dollar. And the size of the Indian rupee's appreciation was indeed the highest vis-a-vis the Japanese yen. By, Japanese, when the INR's appreciation was highest vis-a-vis the Japanese yen, the Chinese yuan, the pound sterling, and even the euro. Cross-country comparisons of exchange rate movements are often made on an inflation-adjusted basis, or what is called in real effective terms. On a financial year basis, that is between March 2022 and September 2022, the Indian rupee has appreciated by 3.7% in real terms, even as the euro, the Japanese yen, and the pound sterling and the Chinese yuan have depreciated. Thus, even in real terms, the INR is the least misaligned in the face of tsunamis of global spillovers. The story of the currency movements following the war in Ukraine, the story of that is India's currency movements following the war in Ukraine, is more about India's resilience and stability in the face of unrelenting strengthening of the US dollar rather than a story of weakness. It is important to evaluate these currency movements against the backdrop of global and domestic macroeconomic and financial developments. Since March 2020, the world has been buffeted by extraordinary and repetitive shocks. I have spoken about the pandemic, the war as two black swan events. There is yet another shock, the globalized inflation. The most recent shock has been the aggressive and synchronous monetary policy tightening, leading to the kind of turmoil which we are seeing in the financial markets. The result has been tightening of external financial conditions, capital flight from emerging markets, sharp currency depreciations, and reserve losses. No country in the world is immune to this kind of turmoil, which has followed two previous episodes of global crisis. Yet, the strength of our macroeconomic fundamentals has stood out in comparison with peers, bearing testimony to the prudent macroeconomic policies and the resilience of the buffers which we have built up. An assessment of India's innate strengths can be gauged from comparison of the state of economy today after 3 years of multiple shocks with the situation during the taper tantrum of 2013. Now, I have got several data and statistics here, which in the interest of time, I'm not reading out. I have just given the data to show. Because, as I said that, let's not go by the headline that the currency is depreciating. We need to look at it contextually. We need to look at it in a granular manner. And I have given several data here. I don't want to sort of load all that on you. Those of you who are interested, you can have a look at it. Now, I have tried to also compare the present situation with what prevailed during the taper tantrum of 2013. Now, whether it is with regard to current account deficit or it is with regard to, the sustainability levels of our forex reserves, I have given several data and I am not reading it out. Now, fundamental factors that drive exchange rate have moved distinctly in favor of India since 2013. In 2013, inflation in advanced economies was 1.4% as against 10.1% in India. The inflation differential of India vis-a-vis advanced economies is now negative, a rare development with several advanced economies experiencing double-digit inflation. India's growth differential with global economy has improved from 3% in 2013 to 3.8% in 2022. The corporate sector balance sheets are strong, the banking system is well capitalized, credit growth is in double digits, and growth momentum is steadily improving. The terminal interest rate that the US Fed is targeting is anybody's guess. But it cannot be a case that the US Fed will tighten monetary policy endlessly. When the tightening is over, the tide will surely turn. Capital flows to India will resume and external financing conditions will ease. In this complex world in which both push and pull factors are at play, the Indian rupee, which is market determined, should be allowed to find its level, and that is what we have been striving to ensure. As I have just explained, the Indian rupee has seen a very orderly movement since the onset of the current geopolitical crisis. We must deal with the global hurricane with confidence, and when I say we, I include everyone who is present here, all the businesses, all the stakeholders in our economy, the government and the Reserve Bank. We must deal with the global hurricane with confidence, endurance, and the courage of our conviction that we will weather this turmoil. Let me conclude by saying that the current global economy is sailing in extremely turbulent waters. Despite humongous challenges, the Indian economy has progressed relatively well. I would like to impress upon the banks and businesses to remain focused on reinforcing their resilience while continuing to grow and meet the market demand. They should continuously assess the risk buildup, if any, sharpen governance, and strive to maintain healthy levels of capital and other buffers. So far as the Reserve Bank is concerned, we remain committed to support and preserve macroeconomic and financial stability. Once again, it is a moment of whatever it takes. Thank you very much.
Thank you so much, sir. A very insightful address. Indeed, the message is very clear. So while keeping Arjuna's eye on the economy and local and global challenges, and you've been continuously, introducing several regulatory reforms and efficiency in supervision, and you're actually endeavoring to lay down a foundation for a strong financial sector to ensure, the sustainable, strong, and inclusive growth of the economy. Thank you so much once again, indeed. Sir, would you have time for a few questions? There were a few requests out there, but so. I can give time, but I think I have taken much more. No. So there are a few questions with us. I can just invite, may I invite Mr. Sanjeev Chadda from Bank of Baroda for his question, please.
Thank you very much, Governor. My question is that there are a lot of consensus which were prevalent for a long time which seem to be giving away. Among them is about the desirability of free global capital flows. Yeah, so among the consensus which have withered, one of them is the desirability of global capital flows. So in India, we seem to have had a golden mean in terms of having some controlled capital flows. But given challenges like FPI being impacted by Fed decisions, do you believe that this is the right time for us to look at what kind of capital flows are to be encouraged and what can result in some dislocation and also some vulnerability?
So would you like to take the questions together? Or what? So there are 5 actually. Okay. So may I request Mr. Shubhrakant Panda, the Senior Vice President, FICCI, for his question, please.
Honorable Governor, first of all, on behalf of FICCI, I'd also like to thank you for being present with us here today and delivering such a comprehensive address and agreeing to take a few questions which I may say so is akin to dessert after a very satisfying meal. Earlier this year, RBI has permitted rupee settlement of external trade, and this has seen quite a bit of traction given the geopolitical developments. And while it is a good move in itself, is there also a thought process that in the long term, there is a need to develop local alternatives to global practices or global systems, much as being done with UPI? So I'd appreciate your thoughts on that. Thank you.
Amitabh?
Sir, thank you for taking the questions. Frankly, when you have proactively thought about what questions will be asked and answered them already, so I don't know what else to ask you. But very quickly, two very quick questions. One is that you started your speech by saying that we are introducing the digital currency. We have started with the Kisan credit cards. You talked about SMEs. So with all these platforms being pushed for by the government and Reserve Bank of India, where do you see the traditional banking industry 5 years down the line when you're going to disintermediate almost everything that is happening out there? So we should start preparing for it. Second, you talked about the paper from RBI on climate and green financing. I mean, the Indian requirements are about $17 trillion if they have to meet the 2060 goals. Sir, at some stage, I know RBI needs to provide some kind of impetus and push. So as bankers, can we hope that it will become part of PSL one day? And hopefully will help our cause a little bit. So just two quick questions. Thank you.
Mr. Somani, the past president FICCI, and also the MD, the chairman of HSIL Limited.
Thank you for a very comprehensive address. Sir, if we have to transform our country into a developed nation like the Honorable Prime Minister's speech this year, we will continuously need to grow at 8% plus for the next many, many years. One of the sectors which creates a lot of employment and helps in the cause of the development of the country is the real estate and construction sector, sir. There RBI has some guidelines in terms of priority lending, and for an urban purchase of a dwelling unit, the priority lending is 35 lakhs for a 45 lakh rupee purchase, and for non-metro purchase it's 25 lakhs for a 30 lakh purchase. Sir, now with high inflation globally and material costs going up, our request is, sir, that this figure should be looked upward in both cases, and maybe the RBI should link it to inflation index, so this need not be renegotiated or discussed on an ongoing basis. This helps the bankers and it helps consumers in terms of purchase of their valuable homes and dwelling units. Thank you, sir.
So there's one last question, Zareen.
So according to the recent BIS triennial central bank survey, INR is now the 15th most traded currency in the global market. So what do you think are the key actions and initiatives which could take India into the top 10 globally traded currencies?
Yes.
Thank you for the questions, and thank you very much once again for your very patient listening to my unintended, rather long speech. Now, talking about, I'll address this last question together because there was also, this on this rupee settlement and the rupee-based trading which you are mentioning. Now, we have introduced this rupee settlement, and as you have rightly pointed out, it is slowly gaining traction. Several banks from various countries, they are already in touch with us. Our banks from India are also in touch with us, with the Reserve Bank for opening the Vostro accounts. And I think there is a lot of interest among the importers and exporters also. So we announced this, I think, sometime in July. On July, I think July 6th or July 12th or so, we announced this. And it's just about, 4 months, 5 months. And I would expect the real transactions to pick up. And with regard to the share of the, the ranking of the rupee, I think it is linked to the size of, the growth of your economy. Once India becomes a larger economy, I think the volumes of trade and other things, or the payments linked to the rupee, I don't know if I have understood your question rightly, but that will be linked more with the, the growth of the Indian economy. And we expect India, to become the, the sort of the fourth or the third largest economy. I'm not going into any year, but there are estimates for the same. But I think it will be more linked to that. But I see a lot of traction in going forward, and with the kind of disruption which this entire the war and the post-war, not post-war, but the kind of disruptions which have now being experienced all over, I think countries are looking at various other alternative modes of payment. And I think in this process, two things that will help India. One is our UPI going international. We have, linked up through UPI, the RuPay card and all. UPI is now going international in a very big way. I have mentioned about it in my address. And the other one is this launch of the CBDCs. Once the countries at the other end also launch their digital currencies, then I think, it will become kind of seamless and interoperable. And it will be, in that scenario, it will become very difficult to really categorize whether it's Indian CBDC or it's a foreign, other country CBDC. But I think that will also assist India, because we are one of the, we are among the few countries which has really, we are one of the pioneers in CBDC in that sense. And if everything goes all right, we will certainly be launching it, hopefully, sometime. And we are quite certain, we are quite optimistic about it. I am not at all having any reservations. So these are the things, this is what I would like to say. With regard to the, there was one point made about the construction sector and the priority sector lendings and green finance as part of priority sector lending. Now, as you know, as I've mentioned, we follow a consultative process. After very wide-ranging consultation, we brought about several modifications in the PSL guidelines about 2 years ago. And we have just revised them, but we keep on getting suggestions, and we will it's a consultative process, and we will certainly give a look at all suggestions which come to us. We will give a look at it. Now, a question was asked about with all this digital and technology, where do we see traditional, bank functioning or traditional lending? Now, banks, I have said it again, and many of you are already doing it. I think banks also need to adopt technology, and you are doing it. So the character of, the way the banking system operates, that also will go a fundamental shift in in the days and years to come. All of us, the RBI and few of the banks now and going forward, all banks, we are working together to ensure this end-to-end digitized loans for certain segments, agriculture and the SME sector. So technology is going to play a big role, and in this scenario, what is important is that banks also must invest in technology upgradation. We just, the Honorable Prime Minister launched the, the DBUs, and I think almost every bank is participant in that initiative. The DBUs were launched on 16th of November. So together we are working, and it needs more dialogue between the regulator and the banks and the other players in the fintech space. We want to encourage innovation, but we also want to at the same time ensure that there is orderly development of the innovation, so that it does not lead to any kind of financial instability or disruption. But having said all this, having said that technology will be the future, having said that the banks must also, and this is very important, continue to invest in technology, I think the traditional bank branches will continue to be relevant. The way I see it, I don't see traditional bank branches to become completely irrelevant. They will be relevant, and I feel they have a major role to play. Given the nature of our country, the composition of our population, and the way our economy functions, I think traditional bank branches in the physical mode will continue to play, an important role. So that is the one. With regard to there's one more with regard to capital flows. You see, with regard to capital flows, let me mention that our market, India, is one of the most liquid financial markets. It's very liquid. In fact, we see, if we compare the, how liquid is Indian market, and if you compare it with several other countries or many other countries, I'm not talking about the advanced economies, even to some extent the advanced economies. In our country, the entry and exit is very simple. All this talk of ease of doing business and all, it's okay, but a lot of work has been done to simplify the procedures, the processes, and other related aspects over the last few years. And our markets are very liquid. That is why you see, whenever there is an inflow and outflow, India definitely, India gets affected. First, that is because our markets are very liquid. But the market should continue to be liquid because we are not playing a T20 match or a one-day match. We are playing a perennial match. It's not even test cricket, it's much beyond that. So on a continuing basis, on an enduring basis, a healthy and robust financial market needs to be liquid and needs to have easy entry and exit norms. We are fully convertible in the current account. On capital account, as we have said time and again, we are moving towards that. But our capital account convertibility, so far as India and so far as RBI is concerned, is not an event. It's a process. And we are moving in that direction. We have undertaken so many changes about which I have mentioned in the speech, about this NDF trading. We have permitted the banks to do, NDF trading and so many other steps which we have taken. So I think, as a part of our financial market reforms, this seamless, easy entry and exit, liquidity, all these aspects are very important. Capital should flow into the country. Capital should move out. So far as India is concerned, I see very small amount of what may be called hot money. We don't see that kind of money which flows in and flows out. Even as I mentioned, last 5-6 months we witnessed certain outflows, but they have moderated. And people who pulled out their money, they pulled out because liquidity was becoming tight in those countries. But our interaction with all the players, with most of the players, shows that they continue to have confidence on the Indian markets and the return which Indian markets offer. So it's a question of time before they come back, and many of them are already coming back. Thank you.
Thank you once again, sir, for gracing the occasion and for your extremely insightful address and for also taking some of these questions. May I request Mr. Sunil Mehta, the Chief Executive IBA, for his concluding remarks, please.
We all have relished a very thought-provoking starter, a main course, followed by a dessert in the form of a question answer by our Honorable Governor RBI, Shaktikant Das ji, and the way the Indian growth story, even during the pandemic, was prepared with the active involvement of the Reserve Bank and under the leadership of Das Saab, deserves a great appreciation from all of us and needs a great round of applause, I request. I think this is one of a rare opportunity for all of us to listen his views so clearly, explaining the thought processes, including emphasizing the need for brick and mortar branches and the need for sustaining these structures in the context of Indian geographical situations. Thank you, sir, for being present here and enlightening us with your very candid speech and guidance to all of us. In his opening remarks, Mr. Sanjeev Mehta has already given the perspective of the industry, the bankers' expectation, what do the industry expect from them. And it's a very good platform for exchange of ideas where we understand each other's perspective and work in tandem to achieve the national goal of 5 trillion economy. I think the entire theme of today's FIBAC is revolving around two major concepts: the digital revolution, which we all are witnessing, and the 5 trillion economy goal, aspirational goal, which we all have to make India from 5th largest economy to the 2nd or 3rd position in times to come. So that is what we all aspire for. And these deliberations will definitely pave way for it. Mr. Goyal, in his opening, welcome, has given the perspective of the bankers how the system has really worked in difficult times under the guidance of RBI and the support by the government, especially the emergency line of credit, the TLTRO window provided by the regulator to inject the liquidity and sustaining the growth in the most difficult time. This has really helped us in understanding the perspective of the banking industry. My thanks to the FICCI and the entire team for jointly organizing this FIBAC. The presence itself indicates the response we get from both the segments, industry as well as the bankers. I'm really thankful to all the participating banks, the industry participants, for their presence and support in this event. Our sponsors and the technology firms, those who have come here to showcase their product, will provide us an opportunity to understand what is the new available in the market. That will also facilitate us in getting and updating ourselves about the recent developments in the industry. I'll just share with you, to keep our country as a digital economy, RBI has taken an initiative of launch of the 75 digital banking units on this Azadi Ka Amrit Mahotsav by 22 banks, both private and public sector banks, just on 16th of September by Honorable Prime Minister. Even Governor participated when he was abroad, and the event was launched. This was a step to reach the digital banking and the digital products to the Tier 2, Tier 3 cities in the rural areas, so that banks are not only providing the services, but hand-holding the first-time users of the digital services, and this will definitely facilitate the entire ecosystem in adoption of the digital facilities by the banking system. Thank you all, sir, with your presence here, and I'll definitely like to appreciate our team, those who have contributed in making this event a very important one and participative by all. And thanks to the media for your presence here. Thank you all.
Thank you, sir. May I request Mr. Arun Chawla, Director General FICCI, for his vote of thanks, please.
Mr. Shaktikant Das, Governor, Reserve Bank of India, dignitaries on the dais, ladies and gentlemen. There is something that I want to say in the most simplistic manner, but from the bottom of my heart. And that is a big thank you to Mr. Shaktikant Das, Honorable Governor of RBI, for sharing his vision and insights with us. Honorable Governor, your address was not long. It was interesting, engrossing, and reassuring for all the stakeholders here. So another round of applause, please, for the Honorable Governor. Ladies and gentlemen, the Governor touched upon immediate issues facing the Indian economy and the banking sector. While revealing on how RBI is navigating and further plans to tackle these challenges, he also provided a look into the future of the Indian banking and the way it is expected to evolve given the many significant and broad policy reforms being undertaken in the country. Honorable Governor, let me convey our deepest gratitude to you for sparing your valuable time and being with us for today's program. Sir, your presence at the helm of affairs of the country's central bank has a soothing effect in such a tumultuous time when the entire world has been grappling with once-in-a-century pandemic. The actions taken by the RBI in tandem with the fiscal measures announced by the government during the pandemic have really helped a lot to steady our ship. The fundamentals of our economy remain in good shape, despite the impact of COVID-19 and the Russia-Ukraine war. Friends, all of us are aware of the milestones set by the Honorable Prime Minister for India to meet in the next 25 years. The Honorable Prime Minister has spoken about Atmanirbhar Bharat in all key economic areas, including industrial production of critical goods. He has spoken about the transition to low-carbon economy. There is emphasis laid on fully utilizing the digital public goods that have been set up in the country. Then there are plans to build our massive infrastructure that could meet our country's requirement for the next 50 years. As we gear ourselves for meeting these targets, the role of the banking sector will become increasingly important. And we heard the Governor speak about this in much detail in his address. We are sure that with RBI leading the way, our banking sector will transform to support India's sustainable and inclusive growth in a meaningful manner. Ladies and gentlemen, we are grateful to all the speakers, our partners, delegates who have converged today to participate, and I'm sure all this will prove to be a rewarding experience for all. Last but not the least, let me express my gratitude to the friends from the media who joined us for covering this important program. With these words, I once again thank the Honorable Governor for joining us, and we look forward to having you amidst us again in the future. Thank you.
While we come to the end of the session, we will just take about 5-7 minutes to change the dais and start the next session, please. Everybody can remain seated here.
Ladies and gentlemen, I request you to kindly take your seats. We shall be very soon starting with our session 1. Ladies and gentlemen, I request you to kindly take your seats. We shall be starting our session 1 CEO panel very soon. I'll quickly, but all of them are not there, na? OL sir is not there. I know. We'll have to quickly. Ladies and gentlemen, my humble request, kindly take your seats. May I request, dear ladies and gentlemen, kindly occupy your seats. Dear ladies and gentlemen, I request all of you to kindly take your seats. We are already short of time, so we need to start our session. Dear ladies and gentlemen, I request you to kindly occupy your seats. We are starting our session 1 CEO's panel. My humble request to dear ladies and gentlemen, Ladies and gentlemen, kindly take your seats. Final call. Good afternoon, ladies and gentlemen. I am your host, Nanda Putran from Indian Banks Association. After an enriching inaugural session, may we now move on to the first session of the day, which is a CEO's panel discussion on the topic, Riding the Digital Super Cycle, how digital finance can help India leapfrog. For the current session, it's my pleasure to invite the eminent panel of speakers to the dais. Mr. A.K. Goyal is already there. Mr. Dinesh Kumar Khara, Chairman, State Bank of India. Mr. Sanjeev Chadda, MD and CEO, Bank of Baroda. Mr. Amitabh Chaudhary, MD and CEO, Axis Bank. Ms. Kaku Nakate, President and Country Head, Bank of America. Mr. Hitendra Dave, CEO, HSBC India. Ms. Zareen Daruwala, MD and CEO, Standard Chartered. Our moderator, Mr. Saurabh Tripathi, MD and Senior Partner, BCG. Ladies and gentlemen, I request you all to kindly occupy your seats and clear the dais area. May I invite Mr. Sanjeev Chadda, MD and CEO, Bank of Baroda. May I now request Mr. Saurabh to initiate the panel discussions.
Okay, while people are settling down, I guess we will get started. I don't think we can complain. I think governor got carried away in a very positive way and shared a lot more of his insights, which was great. So we are running a bit behind the schedule. And I'm going to seek permission from my very, very special panel here. In terms of how much time we can have to close this panel discussion, given that I believe you all have schedules ahead of you. 1:05. So we have to finish by 1:05. Okay, so okay, I'm going to cut short on many things. I was supposed to present the BCG report, but I'll not do that. But I'll just present one slide just to kick ourselves off. Of course, this report is available for download from the FIBAC website. I would just like to say, how does this go back? That we did this. We asked SMEs for the survey that we did. Are you willing to share data with the banks? And this is what they're saying. Only 40% are happy to share data, but then the number one thing they ask is, what will I get in return? Personalized offers. So it's not going to be straightforward. Let me show one or two more things. I know Governor said we need branches in this country, but just facts on the table. India's branches per lakh adults is growing, as you can see, from 14.2 to 14.7 because we added 5,000 branches in the last 3 years. China has been static for the last 5 years. I think we need to have a look at this because this has profound implication on productivity of Indian banking. And also that in the next 5 years, we are going to have at least 5x, if not 6x increase in the load that Indian banks will have to take because of the rising transaction. The costs are going to go up. And of course, we also notice that when we actually talk to customers, the number of times the customers have to, the customers are not satisfied that they can actually truly do end-to-end banking digitally because our services are not yet reached there, at least not to that level that customers are expecting from a Netflix or a Amazon and all that stuff. And of course, the challenges are well known. They are about talent and they are about the investment that's required. So there's one more piece I would like to show you. This is BCG's global study on digital transformations. We found some of them are successful, some are not. The ones who are successful always have to invest a lot more, as you can see on this page. And this is not just for banks. Across the whole, 14% of the revenues are invested by the successful digital transformations. In case of banks, I think it's like 3-4%, but that's also a huge number. And then, of course, you get good returns. But also deeper organizational interventions. You're designing a journey. Is it made by business analysts or it is made by designers? Like very few banks in this country actually have designers on their roles. Do you run these change programs as a project mode or a persistent mode? Like, it's an always-on thing because you have to continuously improve it. Very few banks have adopted the kind of business model that is needed to continuously do these things. And then finally, many times banks find that they should have a digital department which will do all these things. But we found that it doesn't work unless each business unit feels that digital transformation is their job, right? So these are all cultural aspects that take a lot of time. And then of course we all know, I will not get into the details, there's a lot of work required in technology itself to change it, and a lot of investments has to go there. But we did one analysis, and I'll just stop after this. Today our banking industry's cost income ratio is 48%. If we were to look at all the investment that is required in digital transformation, cost pressures due to increasing transactions, rising cost of compliance, and very soon we'll have privacy law also, this is going to go up. But then if we were to undertake digital transformation at a bank level, in true spirit, with the right investment, it will go down by about 7%. And this is up to the banks, of course, and some branch reduction has to happen. It can't continue to grow at this pace. And then certain initiatives from the government, which is what we were talking about. I think our Aadhaar ecosystem has to be now upgraded to next level so that the cost of KYC goes down much further, and similar other initiatives at the systemic level to reduce cost of banking. But also, we need to take the tokenization of real assets on blockchain. That's the most advanced way to create secured assets digitization the way unsecured has been done. So those were the main points, and we'll reiterate to the governor, because with CBDC launch, the level of confidence that we have, like we are one of the first countries in the world to really launch a very clearly defined CBDC strategy. I think so digitization and tokenization of assets on blockchain is not something out of our reach, because our CBDC is also on blockchain after all. So those were the points. I would like to stop here in interest of time. And thank the August panel here. Thank you very much, sir, for being here, ma'am. Now, I think given that we have run out of time a little bit, I may be able to ask one question from all of you. So let me get started. And Mr. Goyal, you have a flight to catch, so I'll give you ask you the first question. Mr. Goyal, you are heading Punjab National Bank, and if I may say so, Punjab National Bank was not the first ones to start digital transformation. You picked it up now and you're driving it. So obviously you must be having to prioritize what to do first. So what have been your learnings on it? What can the industry learn as you sort of got started on this journey and you had to prioritize in the process?
Punjab National Bank is the second largest bank. The only challenges after my taking of the charge ki how to drive the digitalization. That was the talk of the whatever the talk we have discussed in the morning also. The future of the banking industry is the digitalization. Although it is not ki we have not started. We have started long back, but pace of the digitization which should be as compared to the other bank of the same size. So we were little behind in the digitalization. So last 6 months, basically, we have started our digital transformation journey, basically. And ultimately, we have to change the mindset of our employees also to adapt the technology. In same time, we have to create the awareness of the customer also, because we have the different type of the customer. Today, we are having the 10,000 branches, 18 crore customer. Customer may be from the metro also, customer from the rural also, customer from the... So priority is to use the digitalization technology and change the mindset of the employees and create the among the customer. And I will tell you, last 3 months, we have launched this pre-approved personal loan. And within 3 months, the business which we have done the last 15 months, 6-7 times of around 650 crore rupees we have done in the 3 months. And most heartening what I have seen, entire workforce has come together to launch this product within 45 days. So it was the game changer for the Punjab National Bank. And moment we have launched this product, it has come to the mind of each and every employee, what is the power of the technology, what is the power of the digitalization, and it has changed the game plan of the bank. After launching this product, another 4-5 products we have launched in this OD against the FDR, then KCC renewal up to the 1.60 lakhs, and pre-qualified credit card within 1 minute, which pre-approved personal loan, which I am telling, it is within 1 minute with 4 click and 1 OTP. Similarly, the credit card also, within 1 minute, you can generate the card, and virtual card, it is available on you, even you have not received the physical card, you can use. Everything is available on your mobile, and we have revamped our PNB mobile app also, which is also one of the, because ultimately what customer want? Customer want 3 things. Ek to reduction in the cost, second convenience, a third is the confidence. So mobile banking is it is a basis where we can provide the service. On account of this revamped of the PNB mobile app, our ranking in the Google Pay, which was 2.7, has improved to 4.3. So this is our priorities, Saurabh ji, whatever I have told you. Thank you very much for the opportunity. Yeah.
Thank you, Mr. Goel, and all the best for the rest of the journey. I know you've got just started. Mr. Khara, could I come to you, because State Bank has been at it for a long time, and the level of investment and the ambition with which the bank has pursued digital initiative has been quite huge. So what has been the learning in terms of how to get the returns from the huge investment that is required? And I guess you always find that more investment is required after you've done something, because it's never enough, right? So what is your experience to be shared with the industry in terms of how to really do this well, and where does it end?
Thank you. Well, when it comes to digitization, normally, typically what happens with any public sector entity, or maybe entity which has got a history. Sorry. Am I audible? Yeah. So normally what happens for any player who has got a long history, whenever they try and embrace digital, they try to digitize the existing journeys into the digital medium. But the fact remains that if at all we have to really go for a digital, we have to rework the whole journeys also, customer journeys also. So I think that is one of the major learning which we have from our past experience, and that is something which we are now working on. In fact, our past also, when we created a similar kind of new set of journeys. The fact remains, when it comes to the choice of channels, banks like us serve the variety of customers. And there is a need for a variety of channels of distribution. If you really ask me, is the digital the panacea? Perhaps no. What Governor also mentioned in terms of the existence of, or maybe the relevance of the physical banking, I think that's a reality for a country like us to see for some more time to go. So I think in that context, I would say that, yes, of course, for a bank like us who are serving variety of customers, we have to ensure that we remain digitally active, and we also remain physically also very strong. So that is, I think, that's a reality for all of us. Now, in terms of investment, of course, investment in technology has got a high obsolescence also. So, and also, it gets replicated with the competition also in no time. So if you really think that the digital is something which will give you a competitive edge, perhaps for some time, but not for, I think if at all you have to stay competitive, you have to stay ahead of the curve. That's a felt need, which means that the ongoing innovation, ongoing investment in technology is a necessity. So that is something which will work.
I would also like to draw your, I have looked into your presentation and what you have mentioned in terms of the cost of compliances, etc. Cost of compliances stay, whether digital or physical, it stays, but maybe it will get rationalized to some extent if at all it is digital, because it will be all centralized and it will have the boundary conditions laid out in the system itself. So to that extent it will get rationalized. But eventually, if you expect that only the digital or will probably solve the problem relating to compliances, perhaps no, because always there is a need for an application of human mind when it comes to compliances. There cannot be any escape from those kind of realities. So I think it is going to be a blend of both the digital and the physical, and increasingly with the adoption of the digital, what is required is that the teams within the bank have to reorient. There is a need for giving impetus to the newer skills, because eventually when it comes to development, perhaps the development can happen, or maybe we can depend upon for the development for the outside the vendors. But when it comes to the running of the show, that will be all within the system. So which means that we have to give required emphasis for identifying such skills, grooming them and creating a cadre, or maybe those are the kind of, it's actually a paradigm shift when you go for the digitization, when you go for the increasing amount of digitization. Though we are also seeing when it comes to the traditional markets also, there also we are seeing that there is a definite shift, because what has happened post e-commerce, post the COVID, the e-commerce has taken a significant jump, which means that people are now very, very comfortable using their mobile apps for the e-commerce purposes. So which means that now some of the transactions from the banking system can happen in a digital mode, and that number is growing. UPI again is the other very factor. So ecosystem is evolving, ecosystem is strengthening the digitization. But yes, of course, all have to move in tandem, and it's a journey. It's not a destination. Thank you.
Thank you, Mr. Gala. It's a journey, and it's a journey of continuous investment and continuous reinvention, because things are changing faster. Also around us, in particular in India, the ecosystem is changing also as rapidly as the banks want to change themselves. Maybe sometimes actually faster, because we are now the first country in the world almost to launch CBDC. That's just as an example. And so you raised also this one important point about, talent has to be hired, Mr. Gala. Talent has to be hired, and a very different type of talent is needed. So could I ask Mr. Chadda, Bank of Baroda is being recognized as a very good example of taking this talent issue head on and actually really doing some things unconventional, but very boldly, to create the right type of talent to really take these things forward. What would be your learnings to be shared with the industry?
So thank you, Saurabh. So I think whenever you have any issue, any problem, the first step is to recognize that it's a problem. The second is to have the conviction that can be solved. And then 3, to see how you can solve that. So as you very correctly said, if you look at today's banking, the 2 central challenges before us are A, the theme of the conference, technology, and number 2, talent. Between the 2, I'd say talent is possibly even more important, because you can't even have a technological implementation without having the right talent for that. So that really is the central issue for us. It's more so in the case of public sector banks, because we have been, unfortunately, providers of talent to the industry, and for some reasons we have not had either the humility or again the need to accept and attract talent from outside. So this has been an issue, and it's been an issue for a long time. Now in terms of accepting that problem, I think BOB was very fortunate that in the time of my predecessor, Mr. Jayakumar, I think the fact that a public sector bank could attract talent from outside, that was something that was unambiguously established. And I think that was a central achievement as far as BOB was concerned. Third, of course, was that if you accept that you can attract talent, what is the kind of talent that you require, and how do you go about attracting that? So to my mind, if you have to really attract talent, and if it has to make a difference to the bank, it has to be at the top levels. You can recruit hundreds of people at the middle level, but to my mind, that does not really have that kind of impact. And if you see the human resources of public sector banks in particular, I think in terms of a junior and middle level, we have absolutely first-rate people. But when it comes to senior levels, there are areas which are not the traditional strength of public sector banks. For instance, again, you can talk of wealth management, you can talk of collections, you can talk of technology, you can even talk in terms of the finance function. So I think what we have been able to do is to attract senior level talent in all these positions. And how that has been possible is first, of course, what is again surprising is that people are very keen to join a public sector bank which has the right atmosphere, because the scope of having a transformative impact is immense. That's something which is really unparalleled. So if you give people the autonomy and you give people the opportunity, people will come. The second is that very often we believe that salary levels are a constraint, which I believe they are not. For instance, again, in BOB, we have a salary bill of 8,000 crores a year. Now, if you were to just put away 1% of that, say 80 crores a year, I think you can get ample senior level talent, which can then make sure that your balance 99% of the cost is money which is well spent, and you get enormous operating leverage. Then, of course, I think the last point I would like to make is that when it comes to talent, you must have room to give that talent upward mobility within the organization. And that's again something that we have done to some extent, but I believe it is still an agenda which is incomplete. For instance, there is not enough scope for a senior person to, say, move to executive director level or as an MD in a bank. I think that's a bridge that we need to cross along with the government.
Thank you very much. I think this is, while financial investment is a very big deal and it has to be continuously made in very substantial amounts to transform, I think the challenge of cultural transformation, challenge of talent induction is actually probably an even bigger change. And it doesn't end there, because you hire talent from outside, then to make them work together in a new way of working is even more difficult. Amitabh, you have been applying yourself to this problem for quite a while, and you have got good point of views as well. Would you like to share with us?
Well, you know, as the governor mentioned and as some of our other speakers mentioned, that it's almost a given in terms of what we need to achieve through technology transformation. And it's not just technology alone. I mean, there's a huge amount of data which is coming our way. What do you do with that data? There's people, it's not just about saying that we need to change the customer journeys. It is about what is the UI, UX there. So there's very different kinds of talent which are needed across the banking space if you really look 5-10 years ahead. I mean, if you look at 5 slides of yours out of the 16 which you presented, 5 are doomsday scenario, that if we don't do anything, where will we head? And it's right. I mean, we have to think of those things. So, and then you have the government and RBI which are setting up open platforms, which are disintermediating. You know, all of us are so proud of the customers we have. But if all these platforms are going to be available, and you said MSME, 40% are willing to share data, but they're asking what you give for me, but 40% are willing to share data. And that itself is a very big number. So if you just project it a little bit in the future, you will potentially have customers who are willing to test. You are potentially going to have customers who are willing to shift if they get a better journey, better price, better proposition. And you will have open platforms, which these platforms will be talking about. If you take what happened with UPI, no one could have projected where we are with UPI today. And I don't think any one of us can project what UPI will do to us 5 years down the line. Wish we could, but we don't. And by the way, it doesn't pay anything. It makes no money. So I think it's a question of doing a couple of things right. One is that you obviously have to project 5 years hence and invest in it. And if you can have that clear vision, you can show that vision to the people who potentially can join you and who can be part of that vision. Second is that you need to create sometimes separate teams, arms, who are treated differently and are kept differently, so that they don't get caught up and get sucked in by the so-called traditional bankers. And I'm not saying anything is wrong with traditional banking, but the people you need are very different from what traditional banking represents. Third is that, yes, it's a constant effort. You do see attrition, and at times it is very important to have the right kind of partnership, so everything doesn't have to be done by you, but it can be done by someone else. But if you don't have a vision, whatever that might be, knowing fully well it might change, you can't paint that vision and sell it to the employees or to the new employees and keep at it consistently. I think your doomsday scenario will play out. I think the top 5 players will change, or there will be new players who will emerge, who will take away the juiciest parts of a market share, and we have to assume that that will happen. So in a journey of this nature, huge amount of investments, commitment, rigor, patience, all of that is required. And it takes a lot, because you do get asked, where is all this money going?
Exactly. Well, thank you very much, Amitabh. So this point about, we don't know what UPI will do to us in the next 5 years is also not clear. But I think we have got at least 5 or 6 of these things now staring at us. The ONDC will become something real in 5 years. Agri stack will become something real in 5 years. And in all of these stacks, you will have SMEs on the digital platforms. And the SMEs will be doing their business very differently. So we are hypothesizing in this report that, the way industry got surprised with UPI, that initially we thought it's a small thing, maybe it will be successful, not. Within 5 years, it is so big and it's all dominated by big tech. And I think something similar will happen on the SME space, because there's so much of big tech and fintech attention in building platforms on which SMEs can do their online business, get a lot of services, and so on and so forth. So while we're talking on SMEs, Hitendra, you have gone on record talking about your belief in the SME sector and how HSBC is growing so aggressively on the SME space. How do you see that, and what is the bank doing differently? Because obviously Indian banking sector has also seen a lot of NPAs and all that stuff, so there's also a little bit of discomfort with the sector.
Yeah, no, I think there are certain advantages to entering a segment a little late. So that's what we are experiencing here. That possibly we are a beneficiary of the learnings of the industry, so we are able to incorporate that into our customer selection. I think the beauty of being in India at this time is that frankly there's enough in it for everyone. So there's not like I don't have to take a business away from any of my colleagues on the right hand side of this panel. But within that, I think why we have been going public with our aspirations on the SME segment is because we are clearly sensing that there is a segment of the SME population which is extremely aspirational. Okay, I mean, all of us serve a certain customer segment. Typically, a bank like ours with a very large international footprint will typically tend to attract those businesses that have an international connectivity. That could be trade, that could be FDI, that could be technology, or any of those things. So I think that's one part, that we are focusing on that segment of the SME, which is not only looking for credit, but we are looking for customers which are looking for the full-fledged FDI advisory, FEMA advisory, fairly high-end payments and collections technologies. So it is sometimes assumed that because we are not, so when I say we, I really am talking now about international banks actually, because we are not so visible at the technology and digital end in the retail segment, people don't realize that in the business segment or the wholesale segment, actually the technology offered by international banks tends to be at par with most of the local players, if not better in some cases. So I think that is one. The second is, like I mentioned, I think most of the customers in the SME segment, I think the great thing is with the data architecture that we spoke about earlier, access to GST and access to EPFO, access to employee income tax returns, etc., corporate income tax returns. I think we are now discovering that there is a segment within SME, which is within the risk appetite that we want to operate under, where we can access a bulk of the information digitally, process it using whether it's using artificial intelligence or machine learning, or in some cases even human. We do treat them, many of them, as in our SME model, a lot of SMEs tend to have RMs. So I think that's the other segment. And third is obviously, if we are to achieve, since the broad topic here is $5 trillion, $10 trillion, etc., I think it is impossible for any of us to envisage that this will not happen without the total amount of bank credit to SME outpacing everything else, right? When we already, I think the governor mentioned about 26 to 30% or so. I think you can have this going on for 5 to 10 years or so. And that will not happen without us as industry helping that segment fetch data digitally, but also this SME segment or even the $5 trillion economy dream, I don't think is possible unless we start selling a lot more to the rest of the world. The Indian economy is just not large enough as a consumer for that to happen. So hopefully a bank like ours can play a role in what our tagline is, connecting a world to opportunity outside. So thank you.
Thank you. So while on the SME topic, I think one of the ways in which SMEs get funding is through supply chain finance. And Zareen, I know you are quite deep into that product. So how are you seeing that transform with all the digital transformation that we're seeing in the B2E space?
Yeah. So supply chain finance, clearly, I think with the Threads platform and then the fintechs getting into the space has really benefited. We as a bank have started using alternate data to fund small ticket SMEs, and we are validating that using AI ML. And what we find now is that if you look at a country like China, we've partnered with Link Lodges. And what China does is an electronic death certificate, which means that if a large vendor is giving credit to, if a large company is giving credit to a vendor A, that vendor A can use that credit using blockchain technology and give it to vendor B from whom they source. And the entire value chain gets the benefit of having sourced from a very good corporate credit. And those are things that I think will play out in India, and I think you alluded to that, Saurabh, and that's what we'll see play out in the next few years. The other place where I think we'll really see again some good work happening, taking from where we are video KYC today for individuals, I think for SMEs and corporates, I think that I'm sure RBI at some point will look at how you can digitally onboard a corporate also. Today you have to do a physical meeting with a corporate. So those things, if they happen, then actually the blockchain technology with the KYC, if the two kind of go hand in hand, that will really revolutionize complete seamless SME kind of financing. Today what we are seeing is in supply chain, the tier one suppliers and dealers do get credit from the banking system. It's the tier 3 vendor and dealer that will be enabled through blockchain and some of this automation that we'll see play out in the next few years.
Thank you very much, Zareen. I think we also very strongly believe in this. The time has come for us to embrace the blockchain, and if we are getting comfort with CBDC on blockchain, which we will launch soon, then some of these other applications on blockchain are really very directly relevant for opening up the full potential of banking sector. So Kakul, I'm coming to you in the last because I have many questions to ask you. And also you are the primary sponsor of this conference, so thank you very much for that. There are two things I want to ask you. One is, now you are actually quite very deeply integrated with the international investors who are coming to the country and also to the Bank of America system. Firstly, India is really standing out in terms of what we are doing. How do you see the international community seeing what is happening in India, and what does it mean for the investments that will flow? What does it mean for the fintech industry of India in terms of the investment that it will get? Because the rest of the world, fintech is getting starved of credit, but do you think, given what is happening here, India will be different?
I think on the digital side that we were talking about, India has really proved a lot of new models, including platforms, if you go to see. None of the developed countries have gone into so much of depth where all the payments are, 24/7, 365 days. And everybody was worried about cybersecurity, fraud monitoring. Of course, we need to be worried because as the scale goes up, these are really big things. But from what the people can learn from us, to your point, and which will also attract a lot of flows, is going to be the OpenStack technology that we have adopted. The account aggregator model itself is kind of a huge benefit. Something that you mentioned about ONDC, that's going to be a big thing because today, only digital commerce on the SME side, which all of us may be funding through supply chain financing, only around less than 25,000 SMEs are digitally enabled on the e-commerce platform. So that funding is there, and MSMEs only 11% are really creating digital credit. So the opportunity is huge, but the core ecosystem that it is creating across and bringing all classes of credit together is something people are watching us in the world. And when I was at the IMF, I had a very proud feeling as an Indian to see that the UPI, which is now going to be deployed in Singapore, France, many other countries, was simply fantastic. And I think there are a lot of key takeaways and use cases that Globe is working on going forward.
Okay, so very quickly on that note, you have also gone on record and said that digital is fine, but in ESG also we will be the best in the world. Right? Why do you think that we will be, because we have not done any numbers for that, but I'm sure the ESG will be very similar. The cost of banking sector will go up, and then maybe it will go down. But do you see industry embracing ESG in a manner that we will be standing out in the world economy as a role model?
So what I had gone on record to say is that the ESG opportunity is very, very big. By 2070, we have lots to do. And around 33% of our GDP has to become carbon efficient just by 2030. So as a bank and as all of us as intermediaries, we have a lot of sustainable finance role to play. And the supply chain, like we are at least at Bank of America, already doing ESG supply chain. And that kind of not only gives them the money, but then gives them the money at a slightly lower rate. And they are helping the corporates also meet the ESG targets with the vendors. So I feel the ecosystem in India and what we have to do, even to go into the EV space, on renewable space, all requires a lot of money. And frankly speaking, we have a golden chance to think of a green bank for India.
That's very inspiring. So I'm exactly on 105, which is the deadline that was given to me. That's okay with everybody. Thank you very much for your time. I know we ran out of time a little bit, but I guess for good reasons. So thank you, everybody.
I request the panelists just to stay there for a quick photograph, group photograph. Thank you all to the distinguished panelists on sharing your deep insights, adding immense value to the discussions on the chosen topic. Thank you. Ladies and gentlemen, I request you to kindly occupy your seats. Ladies and gentlemen, I am now pleased to take you all through our second session on one of the most trending topics in the world, climate and sustainability, role of banks in financing transition of Indian industry and meeting India's national commitments. It's my privilege to invite on stage the panel of speakers for the session. Mr. Ashwini Kumar Tiwari, MD, State Bank of India. Where are they? I request the panelists for second session to kindly join us in the stage. Mr. Ashwini Kumar Tiwari, MD, State Bank of India. Mr. Dev Datta Chand, ED, Bank of Baroda. Mr. Rajiv Anand, DMD, Axis Bank. Mr. KVS Manian, Whole-Time Director and Member of Group Management Council, Kotak Mahindra Bank. Mr. Raj Balakrishnan, MD and Company Head, Investment Banking, India, Bank of America, and Mr. Yashraj Irande, MD and Partner, BCG, who is our moderator for this session. May I now request Mr. Yashraj to initiate the panel discussions. Over to you, sir.
Thank you very much. Gentlemen, thank you very much for gracing the occasion. The topic of the panel that we have is on the one hand extremely critical, but on the other hand also a very hard one to crack, because the entire world is kind of looking at this issue for the first time. We are going to talk about green financing, and I think we have all the people on the panel who would have the most thoughtful perspectives on this. The way we'll run this is we'll get a lot of comments and insights from the panel, but I will also love for the audience to participate in some of the in the dialogue. So there are some questions where we would love to get your feedback and input as well. To kick us off, let me kind of open it up to the panel first, and from your vantage point, gentlemen, how are you seeing this entire green financing, climate financing shape up in India? How far are we down the road? Are you happy, satisfied? So let me open up with that question. And Mr. Tiwari, if I could request you to start.
Oh, thank you, Ashar. Good afternoon, everyone. So first of all, I was very worried that if lunch is opened up, I wouldn't have anybody here. So Yashraj promised that lunch is not going to be opened up till we finish the panel. So thank you for that. As far as green climate finance is concerned, again, this is a word which brings to mind other word which is evoked today with greenwashing. So we talk about it too much, but how much are we doing? That is the key question, because the time of talk is now virtually over. Whatever estimates there are about 1.5 degrees, there are some estimates it's already reached or close to be reached. So the time is actually running out, and therefore the time now is to actually start implementing a lot of things. Now, where are we in India on this? In India, actually, we at the regulatory side, as we know, there are still very early stage. SEBI has come out with the BRSR framework for reporting. And we have the RBI, which has just come out some months back on a questionnaire for banks, which we all have responded. So hopefully they will come out with some framework. So what is required is, one is to have a standardized framework of reporting. Right now we have many global frameworks. I hope one of those like GRI or TFCD or some such framework which is internationally accepted will be taken up. So that's one thing, one expectation which the banks have, so that we all report equivalently. In terms of funding, a lot of banks, including us, have issued green bonds. We have also got a lot of lines, credit lines from multilateral institutions for rooftop solar, for various renewable energy, largely in renewable energy space. We're also talking about funds for things like green buildings. So a lot of those funding lines are getting available, especially from Europe and multilateral institutions. In terms of where we are investing those and what are the opportunities available, I think those opportunities are at the moment largely in renewable energy space. Not so much in the other spaces. The EV space, for example, has just opened up. We are seeing very good traction, especially on the back of PLI scheme by the Government of India. So this again is a big opportunity. EV, not only the EV part, the charging infrastructure, but also the battery. Because battery is a key component not only for EV, but for many other applications. As we know, renewable energy does need a storage on the time when the wind is not going to be blowing, or for that matter, the sun is not out. This battery technology has evolved quite a bit. We are still some time away from a very stable scenario here, but then there are funding opportunities here. Of course, we are talking about smart grids and talking about buildings and meters and all of that. So by some estimate, Yashraj has given some estimate in his presentation, but by some estimates, the total size of this opportunity is as high as 20 lakh crores, 20 trillion rupees. So which means a very big opportunity for financial institutions and banks to attract, to make these investments, to get the funding lines and get this going. We are all aware of India's commitments under the COP and the nationally determined contributions. Those are very, very high. I mean, if you look at the current renewable energy capacity at 116 gigawatts, the commitment is 450. And it is 116 is not getting utilized fully. We are aware that the actual usage of power is still largely thermal. And therefore, the renewable energy, even if the capacity is 116, the actual utilization is much less. So when we talk about this 450 and how do we get there, that again is a very, very big opportunity. So there is a lot of opportunity, not only in the renewable energy space, but also in terms of the other elements of electric vehicles, the other elements of smart grids, green buildings, all of those opportunities are available. Plus, there will be a lot of transition opportunities, which we haven't looked at. So for example, a lot of people, when we talk to any investors, they ask about your emissions, etc. So what we are looking at in our bank at the moment, apart from lines and getting renewable energy, and we have a fairly large portfolio of renewable energy, upwards of 30,000 crores at the moment. So therefore, what we are also trying to see that can we start to measure the emission of our portfolio. We haven't done that yet. So we are talking to players who do this, and we will be partnering with our customers. But we want to have a high-level framework which enables us to do a high-level measurement first. Once we do that, then we can work with groups of industries. For example, power. Now, nobody's case that India should not have the power it needs. And a large part of that is still thermal, will remain thermal for some time. So therefore, if it is going to be thermal, what do we do to reduce the emission of that thermal? FGD, for example, the flue gas is one such case. There could be cases like washeries to just wash the coal. It's a very low-cost thing, but it results in a lot of emission reductions. So we have opportunities available to reduce the emission of the existing power sources, not necessarily build up only renewable. So India, with being such a large country, does need multiple pathways, multiple solutions. One solution, I'm afraid, will not work. So with taking into all this into account, I think we have a lot of opportunities, and we are working towards that as a bank. And of course, we will work with all the industry as well.
Right. No, thanks a lot, Mr. Tiwari. I think you obviously set us up with a somber tone about being cautious about greenwashing, but at the same time, also recognizing that there are some really practical and rare opportunities. I just wanted Mr. Anand to get in the private sector perspective in this, and I know that you have been thinking very hard about it, potentially with investors as well. So how have you seen this play out?
I haven't been called Mr. Anand in a long time. I think the fact that we have to commit to transition financing, and I prefer that to climate financing, and I think it's also important for us to recognize that while climate finance, transition finance has become fashionable over the last few years, the S part, the sustainability part, is something that is embedded in every bank in India through priority sector lending, where we are mandated to lend to the weaker sections of society. So this is something that we've been doing for 50 years. While there is greater focus on the environment today, I think we must take credit for the sustainability aspect that banks have been able to deliver really over the last 50 years. I think coming to green financing or commitments to COP, I think the Prime Minister has made a commitment. Axis Bank itself is the first bank, at least in India, where we have a ESG committee at the board level. And so therefore they guide us in terms of what we need to do. We have adopted the IFC Washington principles. And so therefore what we do is, for every loan that we are giving out over a certain level, we are actually going out and doing ES due diligence. So we have a team that does that, goes to the factories, looks at effluents, etc., etc. And I'm quite delighted to mention the fact that for companies, let's say A and above, I don't think we have rejected any proposal because of environmental issues. So I think in general, adoption of ESG principles in corporate India is pretty strong. But having said that, I think the next level, remember, the next big, sort of growth avenue for all of us is the SME sector. And I think the cost of adopting, ESG principles within that space is going to be large, and, there is a lot of education that we need to do. And I think that is a space that we will certainly need to work upon as we go forward. We've also, as Mr. Tiwari mentioned, we have also done a ESG 81 sustainable bond. Only two countries in Asia have issued those bonds. Very strong demand for that. I think the book was built about 3.8 times. Very, very, very tight pricing for that, and something that we're quite proud of. As Mr. Tiwari mentioned, we are working with multilateral agencies as well to create guarantee structures as well. As we think about transition, we spoke about EVs, batteries, hydrogen, etc. But I think many of these are concepts at this point in time. They have not been scaled and may not necessarily be bankable at this point in time. But probably venture capital, private equity guys will come into that space. But is it possible for banks to work in some of these new spaces with the help of some of the multilateral agencies, which will give you first loss guarantees, to be able to build a small book, participate within that, and see how it goes as we go forward are some of the things that we are sort of really looking at. We've also committed to the external world that we will disburse 30,000 crores of green financing in the next 5 years. It's already 1 year, so over the next 4 years, and we are well on our way to be able to do that. We've also committed to, within the EV two-wheeler space, we are committed to grow that to, that the book itself will be 5% will be EV, and there is a rate of interest benefit that we are giving to customers within this space. We are also working towards reducing the overall exposure, at least in percentage terms, to the dirty sectors. So I think it is a journey, and I think banks in general are well down this journey. I don't think the issue, yes, I mean, very large numbers are being thrown around. I don't think the problem is the availability of finance. I think, we have to get that taxonomy in place, the point that Mr. Tiwari was making, so that we are all on the same page, when we define, green or climate financing. And I think, getting that in place becomes very, very critical. And once we get that done, I think, bankability of many of these projects, I'll just, get to that in just a moment. But I think availability of financing is not a problem. But I think ultimately, as banks, our primary concern will be the viability of each of these projects. Under no circumstances will we lend to projects because it meets green financing considerations. It has to meet the bankability criteria that any bank would have. I think that is very, very critical.
That's fantastic. It's extremely encouraging, Rajiv. The entire spectrum of ideas and initiatives around, just from funding 81 bonds all the way to thinking about lending and education for the MSME sector. It's quite phenomenal. The fact that nothing has been rejected, at least AA and above, because of ESG in terms of credit, it's quite remarkable. Mr. Chand, I know that you have been, when we spoke before the event, you mentioned a lot of thinking going within the Bank of Baroda and as one of the larger public sector banks. How are you seeing the market play out? What do you think is the real movement which is happening in the market which will make a difference?
Yeah, thank you. See, currently, if you look at the scenario on the entire ESG financing, incrementally, if you look at as a bank, we are more towards the renewable side. So if you talked about a 30,000 crore book, like last a year and so, possibly Bank of Baroda would have created a $1 billion USD book. 1 billion USD, something around 8,000 crore of in a year time we have created. So while saying so, that the focus is with regard to the renewable energy, and there is a great in terms of creating capacity to look for the 500 gigawatt kind of a capacity within India in 2030. But at the same time, as a bank, we are also quite long on the carbon intensive side also. And the dependency on the carbon intensive is going to be there, and currently the geopolitical scenario across world, we can't have anything beyond that, because the dependency would continue for possibly decades. In that same scenario, as a bank, what normally we have been doing, and the corporate also increasingly coming to us, to have some energy efficiency measures within that, like which can typically reduce the carbon footprint. And as a bank, as we do have a comprehensive ESG framework, and lending practice is one of the part of the ESG, increasingly we are all engaged with our customers in terms of how do I improve both in terms of lowering the carbon footprint, at the same time creating capacity for renewable, which we have been doing very, very aggressively, and the market is also tuned to that in terms of both solar and wind in that way. So this is one aspect of what Bank of Baroda we do on the lending side, but I believe that the ESG financing or green financing is a bigger, what you can say, the bigger ecosystem in terms of how do you drive the entire country to get into a lower carbon kind of a scenario. So one aspect that I do have, which we normally talk about, that how do, as an organization, I create some kind of a better ESG roadmap. Just to articulate for an example, as any, like from my foundation day from July, any new housing loan or car loan I give, I plant a tree. And we do that through an agency across India, and almost like 74,000 of plants, trees we have planted as on today. And in 3 years' time, we have a plan to make it 3 lakhs to 5 lakhs kind of a planting tree. So my sense is that to make the entire ESG more intensive across all vertical, like in India, the greater part is that anything with a financial incentive does work well. Like we have seen in the financial innovation also, incentive does work well. So as a country, now the time has come wherein we need to go beyond the lending side to see that whether we can pass on this carbon credit. An example which I have given just now, make it more of a standardized, bundle it and make that as a financial product. Because we do have a very excellent financial market we have. And that can typically make the entire country as a whole more towards the ESG framework. And we as a banker also, ESG talks about the environment and society also. Then we have been, priority sector has been one key piece of the entire thing. As a banker, we have been there for priority sector since long, and we are keen to have the society getting impacted in terms of better living standard, better capacity in that way. So as a bank, we are very keen, and as a lender, increasingly, as I said, and we are, if I look at on a curve in terms of our migration towards the COP commitment, and then we are riding the curve, although we may not be at the high end of the curve, but we are riding the curve, and possibly a couple of years from now, we'll be in a better position to have that mapping in terms of the mandate that we think of a zero carbon by 2070.
Thank you. Mani and Bala, I'm going to come to you in just a bit, but given that there were a lot of claps in the audience, it looks like there's some energy, and I'd want to just tap into that a little bit. If you could bring up the slide, there's something I wanted to check with the audience. So a few quick facts about some of the early moves that have happened in India. Many of you might be familiar, but putting it all together in one place really kind of opened my eyes. Everyone has spoken about one North Star national ambition, which is net zero by 2070 and so on, which is obviously great. But even the regulator has actually started moving some, making some very seminal moves. By 2015, basic renewable energy financing was included in priority sector. Indian regulator has become member of NGFS, which is the international body where 114 odd central banks have come together to think about climate and green finance. Obviously, there are a lot of discussion papers and interactions happening with the industry. And a lot more which is happening even beyond that. So I think overall, pretty interesting moves happening. Just shows how serious this issue is for all stakeholders. And this was what Mr. Tiwari was referring to earlier, which is really, it is a $1 trillion journey. Whether we look at it as an obligation, whether we look at it as an opportunity, that's something we need to think about. And Rajiv is spot on. This has to be a commercially viable one to really get funded with the amount of debt this is going to require. So the commercial viability and the economic rationale behind these are critical. But if this is done right, this is a $1 trillion journey that we need to do, and way beyond just renewable. Buildings, waste, mobility, biofuels, hydrogen. There's a lot that needs to happen within this. Will this demand get met? We need to see. And obviously there are hurdles. We'll talk about that. The frameworks for assessment, audit, etc. are critical. Now, here's a question for the audience. Now, having heard what we have heard and having seen what we have seen, all of you are in the market in senior positions. How many of you are optimistic that in the next 5 years, the Indian financial services sector will be able to gear up to address this $1 trillion demand which is going to come up? Show of hands maybe, how many of you are optimistic? Yes. Okay. I will ask for no because some might be indifferent. So how many for no? Okay, I think this is really helpful. There is obviously a large portion which is sitting on the fence, right? Which is they don't want to commit. But it's great that there are more saying yes than no. Still, the dominant silent majority is kind of sitting on the fence. So that brings me to Mani and you, and then Bala, I'll come to you as well. How do you see institutions gearing up, and are we being too optimistic and dreamy-eyed about it?
Yeah, Raj. I'll make a nuanced difference from the earlier speakers. Personally, I am of the view that we need to hasten the walk on this compared to the talk. I think far more needs to be done. I mean, everybody intellectually agrees to this, but I think we've been slow off the mark. And my own sense is that, you know, these things require a framework of benefits and incentives which have to be put in place. Without that, it's difficult to make it happen. For example, I mean, you know, you mentioned there that renewable energy was brought into priority sector. I think there is much more regulators can do. Much more of this can be brought in as priority sector, for example, as a regulator. Or as a government, let's say things like during pandemic, the way we supported the SME sector through a guarantee scheme, right? Rajiv talked about the credit issues that can come up in this financing, right? There will be uncertainties in this. There is learnings to be done. Banks may be uncertain about whether to lend. If there is a framework of guarantees put in place equivalent to ECLGS kind of thing, it could work. It could, you know, there was a time when RBI used to incentivize export finance by doing an interest subsidy. So could we do something like that? So I think we have to think through. There are innumerable things that can be done. Can there be better depreciation rates for lead buildings? Multiple things. You can think of so many things. But I don't think we have made concrete progress in terms of if this is so important and all of us believe that it is important, I think we need to make significant regulatory as well as government actions to promote this for the banks. Banks will of course do it, but like Rajiv said, like the other gentleman, Mr. Tiwari said, Mr. Chand said, he talked about the carbon credit thing as an incentive, right, indirectly. So I think banks are willing to do, for example, our own bank, we are among the best rated ESG banks. If you pick up the ESG scores, we are one of the best rated ESG banks in the country. We put in place various measures to, you know, evaluate ESG when we lend, board committees. All those, of course, we have to do. But my own sense is that these are not enough to get the momentum that we need to get. And I think this has to be done yesterday. That's what my...
No, thank you. Thank you very much. The fact that if the 1 trillion demand needs to be met, we need a lot more enabling framework. Some of the risks are going to materialize for the very first time. So it's very hard to really sit here and on an Excel sheet feel comfortable that this is a risk worth writing. And Rajiv?
One of the things that we need to also understand, look at renewables, for example, right? I mean, we've been at it for almost, banks have been at it for about 10 years, right? It's really over the last 3-4 years where banks have gotten more comfortable, and you bring a renewable project, it goes through the credit committee quite easily. The quality of the sponsors has improved quite significantly, and therefore, you know, all of us have fairly large renewable books. I think whether we like it or not, we will have to go through those journeys on some of these other EV batteries, for example. I mean, the last word on which is the technology that is going to work is not yet there. And therefore, as a banker, I am not a venture capitalist. And so therefore, you know, unless the technology is clear, it is viable, we can see mass scale, we see, you know, good quality sponsors, we would obviously then look to lend. And so therefore, it is not just banks' pools of financing that is important as we think about transition financing, but it is also risk capital that needs to come in.
Yeah. No, phenomenal. It's not just the bank's pool of capital, but also the risk capital. So we, I mean, naturally in a steady state, at least 1/3 of it right now needs to come from equity, even by our estimates. Bala, you actually have a cross-border view of this phenomena, right? And we are going really deep into the Indian realities, but would love to hear how does this sync up with what you're seeing in India, but also maybe in other parts of the world as a foreign banker?
Sure. I think I'm actually extremely bullish about the entire ESG financing space. So at Bank of America, our ESG journey kind of started off 2019. Brian Moynihan, our CEO, made a $300 billion commitment towards green financing initiatives. We upped that last year to $1 trillion for environmentally focused initiatives and another $500 billion for the broader social space to meet the UN SDGs. And I think linked to that, I think every person down the organization has been trying to think, how do I run my business in a manner that tries and meets these goals? And so when I think about that, what have we done? From an investment banking perspective, for example, we've been very, very active in the entire green space. Worked on a number of capital raises as well as exits for people who invested in renewable companies. And I think the renewable space today, the fact that you've had multiple people make successful exits, the fact that you have people like a Shell who invested in a transaction that we just led this year, $1.6 billion enterprise value transaction for Spring Energy, or a GSPC from Thailand, which invested taking a 45% stake in Avada. It's another transaction which we did last year, investing $450 million. I think what that brings out is that this is something, it's not just something you're doing to do good, but it's something which makes money while doing good. And I think that approach has to be extremely important. And for that, we do need the right regulatory framework which lets people make money. So, for example, the commitments, having something like SECI as an off-taker for green power has helped reduce the risk perception about, the DISCOMs and everything else quite considerably when people are investing in renewable power. Similarly, I think the entire framework where different states have given incentives for EVs means that you have EV penetration increasing rapidly, and so you have a deal such as TPG going and investing $1 billion into Tata Motors EV platform. And I think it's the same thing that, so you'll have to strike a balance. There are things, the initial investments will need to come from what I'd call risk capital, a lot more equity. But I think, ultimately speaking, as long as the regulatory framework is right, this transition is going to continue. And as you rightly said, there's a lot more to be done. Our estimates were about $250 billion more towards renewable energy, probably $600 million to come in the EV, battery, storage, green hydrogen kind of space over the next 7 or 8 years. And so it'll have to be this mix. And I think some of the things that people talked about, such as, for example, expanding the priority sector ambit for green financing beyond just the very small projects towards large projects. And we should not see large things as not being things that need to be supported. In fact, it's very often the large projects that lead to dramatic transformation. So at least that's where I would look at it.
Thanks, Bala. If you could pull up the slides, we'll shift gears into the next section of the discussion. We'll go around the horn a couple of times just for the audience, and towards as we get to the fag end of the session, I would love to keep 5-10 minutes for an audience Q&A as well to the panel. So if you want to start jotting down your questions, this is probably a good time. So I will come to this question because Manian, you raised this, that you talked about depreciation. I think a lot of people on the panel spoke about PSL and other framework, rating frameworks, audit frameworks, etc., etc. As providers of debt capital, and maybe your perspective also from an equity capital perspective, what kind of innovations really are required to even start addressing this opportunity? And can we, I will go, on this one I'll go around the horn, the entire panel, and get your inputs and feedback on this.
Yeah. So, earlier panel members talked about pools of capital available, especially in Europe, right? Where there is a pool of capital available for investment in these initiatives. That's not, India doesn't have those pools, right? In India, you can't find those pools easily. Of course, one thing is to go out to those pools in Europe and get them to invest in India. We have made some tentative efforts in that. There's still, the project risks here. These are not easy.
What are you hearing in those outreaches?
So either the sizes. So the small sizes are more difficult to get from these pools, right? They don't want to do 20 evaluations to get to investing in India. So they want a large project, but large project comes with project risks which are not acceptable to many of them. So one of the things innovation we have to do is how to create these pools locally. You know, we are also one of the largest wealth managers in India, and I find at least initial interest. I won't say it's a huge flow, but there is interest in our high net worth individuals and family offices to create a pool out of their overall pool towards ESG. And we are seeing initial interest, but we have to find a way to channelize them into vehicles which will get benefits in making those investments and can provide. See, one way to think about it is it their CSR? But that's not the way to do it, right? It is not charity that we want here.
Right.
It must be commercially viable. People have been talking about that. So it must be commercially viable. So can we provide them the right returns, even if they take some risks in keeping away some capital, part of their capital, for investment into this. So I think we have to think of incentives for creation of those pools, and there are various ways of doing that, but we can discuss that in detail. But I think this is one thing I personally feel is a big innovation that can be done. You know, you can create vehicles specifically designed to invest in green and give them some benefits.
This is, I think this is a phenomenal point. The India offshore available AUM base is a north of $600 billion, but when we looked at propensity to invest in funds or structures that are tagged ETF, it's high, but there is no appetite to take any economic haircut for doing that, right? So your point is, yes, it's something that they would want to do, investors, but not something on which they'll take a haircut.
We aren't seeing investors saying that, okay, it's okay, you do it in ESG, I am okay to take 3% haircut.
Yeah.
If my return is 11, I'll do it at 8 here. I don't think that's happening. So we have to create that structure.
Actually, maybe that's a question I want to throw back to the audience. So again, show of hands, it's a simple question. We are discussing that if we were to launch mutual funds, ETFs, which were green, which were climate, how many of you would be able to take slightly lower returns, let's say 2% lower returns, but still put money in it because it is green and climate and ESG friendly? Those in favor, show of hands. Okay, there are a few hands up, so they are early adopters.
I must say 2% lower is a lot. 20 basis points lower, maybe you'll have more hands.
Yeah. Actually, maybe, okay, 20 basis points lower, show of hands. Okay, we have price discovery. So, Rajiv, over to you, boss. I mean, what kind of innovation do we need to do, if any? And let's say the top 1 to big changes that can make this work.
No, I actually want to see it from the other side. Bring us bankable projects, right? We'll worry about what is the structure that should support that. Same point that I made on renewables. Banks are now very comfortable with renewable structures. The NTPC SECI structure as an obligor on the other side has got created. Most banks don't touch state government PPAs. All that has been a process of evolution, right? So therefore, rather than create an innovation looking for a problem, I want to look at it from the other side. Yeah. Let's look at a project. Let's look at the bankability of that project. What is the risk that the banks are running? Yeah. And then accordingly, try and create solutions.
Yeah. No, perfect.
Just coming in there, since he talked about it, it's a related innovation one can do, is what I already referred to. You can create guarantee fund like it was done in the case of ECLGS during COVID. You can create a guarantee fund in a specific area which is important for us, whether it is renewable or whatever other area. See, renewable, there is still some progress, I would say.
Sure.
But there are lots of other climate areas which need progress.
Sure.
So if on a targeted basis, there could be a guarantee fund created sponsored by the government.
Sure.
And therefore increase the bankability of projects or increase the returns on projects.
Right.
The fund could do both.
Right.
That's another possible innovation that is possible.
Sure.
To
I think these ideas definitely get baked into a set of recommendations that go back to the regulatory ministry. So this is very helpful. Mr. Tiwari, I could request you to talk about any of these two or both of things. One is any more innovation, and specifically maybe to address the pools of demand that sit beyond renewables, because as been addressed already by Rajiv and Manian, this has been solved for over the last several years. The other one could be that are there hurdles you think we need to?
Yeah, so let me start with the pools of capital problem. What we are seeing is, and we have got more than $2.2 billion from international pools of capital, the multilaterals largely. And what we are seeing, and this is based on our conversation, when we started with the World Bank line, it was rooftop solar. They wouldn't agree to any other format. So we found it very difficult to actually utilize that money, and it took some doing. So now increasingly what we are finding, the multilaterals and other pools are ready to actually be more flexible. So when we talk about solar, they are willing to say, okay, commercial solar, rooftop solar, ground solar, and maybe going into other areas as well, as long as it is renewable. So that flexibility we're already seeing, that's one. Second is, as far as innovation goes, I mean, everybody has made this point, the projects have to be bankable on their own basis. Until they are there, then some kind of a support, whether in the form of a guarantee or within the form of a backstop or a first loss, some such support will be required, especially for newer areas. And as they pick up over time, yes, they will become commercially viable. Like solar today doesn't need any support, etc. It is viable on its own. And of course, now we are seeing the tariffs fall to such a level that it is either competing or better than thermal in many cases. So that's the other part, that what are the credit support structures till we evolve to a viability status on its own. However, I would also point out to a lot of opportunities which exist on a national level. So for example, if you recall about 10 years or maybe 20 years back, there was this national campaign on replacing all the incandescent bulbs with CFLs. And it was very viable on its own, though the initial cost was high. And over time, we found that a mix of some subsidy provided on the bulbs by the government, lot of educational campaign, lot of promotion, and we have had a 90% conversion from a normal light bulb to a CFL. The other big opportunity which is available is the fan, of the standardized fan, which the Bureau of Standards has come out. The amount of reduction of power requirement is as high as 40–50%. Similarly in ACs, big opportunities in all these consumables which we have, which every household uses. So why can't some kind of a inter-agency, inter-government plus banks, for everybody together, we can create packages. We fund ACs as a small consumer loan. Why can't we give some national campaign on these, and we'll find the result of this would be amazing. In a country like India, if all fans get replaced by the standardized one, and every household has a fan, I mean, the kind of emission and the power requirement which will be there will be massive. So these opportunities exist. We just have to have those conversations, not only talk about very big events, very big projects. These are small opportunities, but the impact could be very large.
No, this is fantastic. I mean, this is so insightful. At the other end of the spectrum, these are small granular opportunities, completely domestically controlled. Maybe if you have some time towards the end, I'd love to hear a bit more about how suppliers of capital are becoming a bit more flexible. You said something extremely interesting on a very large pool, so would love to learn more. But Mr. Chand, if I could bring you in on both the opportunity and the hurdle, and I'll towards the end, once Bala has also commented, we'll open it up for audience Q&A as well.
Yeah, I do agree. The innovation that we require more on the product side than anything else. As far as capital is concerned, I don't think there is a constraint, because existing institutions are capable of funding all these requirements. And the structure do evolve along with time. Suppose there is not a bankable and then we want some kind of a guarantee, then it evolves. So to my sense, capital is not the constraint at all for creating the scenario that we are talking about in terms of green financing. There would be a bond market, definitely green bonds and all, but then that would be there.
Sir, example of this product innovation you spoke about?
So one take that I have a slightly different take for a larger theme on this ESG. Like the carbon footprint that we talk about, carbon credit for manufacturing, can we extend that to entity who typically don't produce it, but then they are making efforts to reduce it? And then you bundle that into a financial product, then it would work, because then the cost of ESG would be taken care by this. And then we don't have to have talking about incentivizing thing to roll out this a bigger mandate of lower carbon emission. So I think actually on the product side, even Mr. Manian talked about product side, I do keenly believe that we need to do much more on the product side so as to make things more, what you can say, more attractive for people to get in and get in a big way. So that at least on the ESG curve, we need to be ahead of the curve so as to, because we are the fourth largest greenhouse emission. So, as a whole ecosystem, we need to, we have done exceedingly well, but at the same time, the opportunity are huge for us to slightly go ahead of the curve and create some kind of a model for the world also.
No, this is fantastic. I do remember in our previous conversation, you mentioned that we have to realize that it's not going to be a wave of wand where all the brown is replaced with green. So we have to find a way to make even brown more amenable and greener. So this carbon credit and all of these improvements, I think very, very practical, very realistic ideas. Thanks a lot. Bala, your comments before we open it up to the audience.
Sure. So I think as everybody has said, the renewable space probably is self-sustaining in India today. But obviously, as the amount of renewable energy goes up, now you have to find ways to store that energy, use that energy, and that's where I think you have to drive innovation. To my mind, and it's something we always ask for in terms of tax incentives, but tax incentives for green pools make a lot of sense. Both for international investors looking to come into India. For many, many years, we had the Mauritius-Singapore tax treaties, which effectively let international equity funding come in with very, very low rates of taxation in India. And now that's been tightened up for most sectors. But if I were to think of one space where it would be justified to create such incentives, it would be the ESG space. And similarly, just like we have, for example, InvITs as an attractive structure for investing in infrastructure more broadly, could you create some kind of a regulated venture investing structure which helps bring in that pool of, private wealth, which Manian talked of, into the market? I think those are a couple of ideas that we could throw and could help serve the next phase of the energy transition in India.
My God, I think the range of ideas and suggestions that I have, there's probably 10 unicorns sitting on these 2 sheets of paper. So I'm going to try and collate this and put it up on our blog and on this as well. But in the last few minutes, I would love to get in some audience questions. Is there a mic that we can? Is there someone? I'll come to you. I'll come to you. मैं आ जाता हूँ.
In this entire discussion in the panel of 5 panelists, I think 3 of them are weighing towards the risk capital, private equity coming in, HNI, family offices. So this is not the, can you imagine that those people coming at the return less than 18 to 24% IRR which they are looking at, and can this sector survive, which has no visibility, no clear commercial viability? So we have to think out of box. And these commercial banks, they are not going to make that kind of mistake which they have made 20 years or 15 years back, that just on a government call of infra, of airport, roads and business, and they have burnt their fingers, power sector. So we'll have to think out of the box and find out some solution to meet this 1 trillion demand of ESG. I think some bold answers have to come. Yes, we are ready. We are ready to take that risk as a commercial bank, because the major factor today is of commercial bank funding them. Not the private equity, not the investors coming in from outside, or not those family offices. Name a single family office who has put any money in last 1 year or 2 years in this sector. I think it is difficult, sir. So we'll have to think little differently on this. Your view, sir.
Manian, please.
In fact, if you heard me say, that is precisely what I said, that family offices are not willing to do it. So I didn't say that they are willing to do it. The question to answer is, how do you create pools that will go into this? There is definitely some risk capital that has to go in. The commercial banks cannot fund it if enough risk capital doesn't go into this. Otherwise, it will be a mistake of a different kind, by different name, called by a different name, but it will still be a mistake. So if the expectation, banks are happy to do their bit in terms of the debt capital, but the debt capital cannot be with equity risks. The debt capital give debt returns and they must have debt risks in them.
Very right.
So therefore, it is important if we want to drive this initiative, both the kinds of capitals have to come in. The risk capital in terms of wherever, whatever name you give it, whether you call it private equity or you call it government guarantee or whatever, which takes the risk off, creates the debt as a debt risk, is very important. Therefore, the walk has to be both ways. It cannot be, the whole problem cannot be dumped on commercial banks and say, now you finance it. They have to have an enabling framework under which they can finance it. They are happy to do it, but they need that enabling framework.
I'll just add a couple of lines here, if I may.
Please.
We have one example in our group. We have a very small group company called SBI Ventures. It's 100% owned by us through capital markets. This company has gotten a lot of, its company is better known by the Swami fund which it runs for the last mile real estate funding. But more than that, it has had two SME focused funds called NEEF funds, where it has attracted multinational capital, JECA and UK funds, etc. So it is providing to companies focused on the ESG space in the SME sector, which is again a very niche sector. And we have seen very, very good results. The overall investment amount is just about 1,500 across two funds. Now, I see the role of the banks as to when that equity capital has come in and this company has scaled up to a certain level, and we have seen Shell, etc., come in at a later stage. Why can't the banks lend at that stage? So I think this has got to be a combination of this initial risk capital coming in from such kind of funds, and then subsequently the banks can come in while the company has scaled up. So that's one model we can pursue.
Got it. Got it. No, superb. Sorry, in the interest of time, maybe one final question. If you could also introduce yourself.
Yeah, I'm Sunil
there's
Mehta
one more?
here.
Yes, we'll take two questions. Thank you.
Yeah, I'm Sunil Mehta here, not in the first row, the second row. Okay, now, you just spoke about out of the box. I'll speak within the box. Like all of you have funded a lot of projects which has a very high level of ESG compliance, no doubt about it. Can we some way identify existing finance project itself, green and non-green out of that? So that there's awareness amongst the people who are putting up the project. Today, frankly, those who are putting up the project, most of them really cannot classify what is green out of it or non-green out of it. Probably even it's evolving day by day. So if every bank can identify some project which they have funded on a test basis, probably that would be a big boost, and everybody would be aware. Like business people, the moment they see that there's a benefit, they will identify green, non-green, and come to the banker.
Sir, you said it right. As I said earlier also, we are very long on the renewable side, but existing carbon producing, particularly in the power sector, increasingly the conversation is with regard to energy efficiency, and we had a typical case wherein a thermal wants to go for a solar. I mean, those kind of structures are evolving. So it would take time, but then the conversation is on the right side in terms of how do you look into the existing, how do you reduce the carbon footprint or emission of the existing carbon intensive kind of industry, and that's happening. But scale and extent can go up subsequent, like in, couple of years from now, but then things are moving in the right direction from the point that you have said.
Thank you.
So I have a related question actually.
Hello. Can we go on a bit longer? Sorry. This is one panel after many years that I think we can go on and on, but I also want to...
Hello. What I understand from newspaper reports, just follow-on question, that United Phosphorus has refinanced their 4,000 crore portfolio by dividing into green and non-green, and they were able to get green finance on that. It's a big deal, that's all.
Thank you.
Yeah, hello. Yeah, I'm an ex-banker. If I understand correctly, ESG is a very noble initiative, right, at the moment. bankers are in the business of not taking business risk of a project. All business risks have to be apportioned to the guys who are best positioned to take those risks. So you are stuck in a quagmire of sorts. And the potential solutions cannot be sort of, looked at somewhere in sight, right? What could be potentially a solution is something which the government of India had started from the independent power policy, way back in 96, 97, is that, they had some showcase projects like 8 central counter-guaranteed projects, right? Of course, only one turned up, one came into being. So, as I understand it correctly, the first solution could be that, through budgetary allocation by the government to serve this noble initiative, that's probably the only solution to begin with. And then, as you have more projects, seeing the light of the day, then, risk capital as well as lenders can come in. Your views, please.
Maybe I'll take that. To my mind, actually, let's break this up into 2 bits, right? So for renewables, what did the government do? They came up with SECI and NTPC as effectively high quality off-takers to reduce risk perception, and therefore they attracted risk capital. Right? And I think that's worked very well, and you've got to a stage where banks are comfortable funding that. So as we move ahead towards areas such as green hydrogen, storage, batteries, EVs, I think these are spaces where you need a lot of innovation. And it's not that you're copying a playbook which exists elsewhere in the world. Even elsewhere in the world, people are trying to create the playbook. And therefore, you need risk capital. And that's where my point was that, effectively speaking, therefore, you have to try and reduce or at least increase the upside that someone can make for investing that risk capital. And so it's probably an ideal space for the right kind of tax incentives to come in. And for bankers to start funding this, obviously they will be able to start funding it in terms of debt financing, provided there's a sufficient equity cushion and provided that the technology is known to work. Today, we don't know whether, for example, if you look at two-wheelers, we don't know whether it's going to be a replaceable battery, whether it's going to be a fixed battery, whether it's going to be whatever. There are 20 different technologies that people are talking about. Very, very difficult for a commercial bank to lend against that. It has to be incentives for risk capital, which 3 years from now, some of this will play out, and then the banks can step in.
Super.
So can I ask one last question?
I want to get to the panelists will be here. Okay. If it's okay, you can always hopefully catch them offline. But towards the end, just getting to final word. Rajiv, if I may request you to start off by commenting on any final words as we bring this panel to a close.
Just a last point. I think all of us spoke a lot about financing of either transition, climate finance, etc. Unlike manufacturing entities who have a responsibility, who create, sort of emissions, etc. I think banks in general, their core business doesn't, generate much emissions, etc. But I think it is very important as financial institutions to push our borrowers towards commitments towards the green climate. And I think, if you put the collective pools of capital, whether it is, through mutual funds, banks, private equity, etc., I think each one of us has a responsibility to push our borrowers to be able to commit to this green environment as well. And I think that is perhaps a bit underappreciated at this point in time.
I think that's a great point. The fact that all providers of capital, the entire ESG capital stack kind of needs to encourage the users of the capital towards green. Manian, if I could call on you, and then Mr. Tiwari, Mr. Chand as well.
No, I would sum it up like this. There are 3 parts to this: the customers, banks, and regulators and governments. हम सब साथ साथ हैं, सबको एक एक कदम चलना है. The expectation cannot be कि इन तीनों में से एक ही आगे बढ़े. All 3 have to move step by step.
It's a sack race, Mr. Tiwari.
Yeah, so if I take the 3-wheeler analogy, Hindi wheels में एक पहिए पे भी चला है. So, so yeah, taking this forward, there definitely on the regulatory side, as I mentioned earlier, we do need clarity not only in the measurement framework, but also reporting framework. All of that definitely needs to be in place very, very quickly. Add to that the carbon trading framework, etc. That also needs to come in very quickly. And then, as all of us have talked about, the capital being available, it has to be a judicious mix of private capital, the banks funding, supported by structures of either guarantees or additional risk mitigation structures. I'm sure this would go alongside, and it's not that the sector is standstill. I mean, the kind of sense I get from a lot of questions is that some big bang thing has to happen, government has to come in, or somebody has to come in. Everybody is doing the bit. So it's not standstill, but we do need to move very, very quickly forward. As we say, time is running out, we should have done this much earlier, but it's moving. So a lot of hope for that.
Thank you, Mr. Chair.
Yeah, I think the best part of the entire thing as on today is the conversation around this ESG and the green financing. And that's the most beautiful part wherein we can again, coming years we can leapfrog. But again, I reiterate my earlier in terms of can we bundle all this credit and make it a financial product can be a great thing to happen for India.
Thank you. Bala?
Yeah, so I'd say, as everybody has kind of said, you need that mix of horses for courses, right? So there are spaces where I think banks can come in. Over there, you need to have perhaps some mechanisms to ensure that that credit risk is appropriately mitigated, including first loss guarantees, the right off-taker, things like that, the right regulatory framework. There are spaces where equity needs to come in, and for that you need to create an appropriate incentive mechanism. And as everybody said, measurement is something that is extremely important. You get what you measure. And I think corporate India probably has lots of easy wins which make economic sense, and as long as it's being measured, people can go out and do that.
Thank you. This has been one of the most fantastic pre-lunch panels that I have done in a long, long time. Thank you very much, and a really, really great audience. I'm very sorry we couldn't come to all of you for your questions. There were a lot more hands, but hopefully we will be around for you to answer some of them offline. Thanks a lot. Thank you so much. Thank you.
Sir, if we can have a group photograph. Thanks indeed to the distinguished panelists for such an enlightening discussion on the chosen topic. It's now time for our lunch break. May we request you all to assemble back for the next session at 3 p.m. Managing committee members and the panelists may join us for the lunch at Jacaranda room. Other delegates may join us for lunch at the Gulmohar and Lotus room. I also request you all to visit our expo, which is set up in the pre-function area. Thank you.
Card de do, I'll send you a text. You have the mobile number? No. No. Now उसके कैसे? ये वाला दूसरा है? नहीं.
I have your number. 98203.
Very good, sir. Thank you so much.
Kotak is known for that.
Thank you. Thank you. Right, thank you.
और सर कैसे हैं?
बस मेरा सब
परसों मिलेंगे 5 तारीख।
हाँ बिल्कुल मिलेंगे।
आपका खाते नहीं है सर मेरे पास एक
ये चुका आपको बदलना
है पर आपका नंबर पता इसमें
कोई इस पे तो नहीं है मैं देता हूँ। Sir, can I have 93115 76644?
अभी आप रिकवरी कर रहे हैं?
हाँ रिकवरी रिसेंटली हाँ 3-4 महीने हुए। हाँ
So may I have a number to please? 93.
Should the world expect from a bank? A bank with deep roots in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific.
Ambition. Same corporate office.
What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish. A bank that recognizes that economies fluctuate, but values don't. And never forgetting, our only ambition is to help you fulfill yours. Bank of America is proud to celebrate 75 years of commitment and dedication in Asia Pacific. What should the world expect from a bank? A bank with deep roots for the last 75 years in the world's most diverse region, Asia Pacific. A bank dedicated to meeting the challenge of change. One that honors the business environment and the natural environment with equal passion. Providing companies the tools and insights they need to succeed. And offering people and communities the resources to flourish.
Welcome back, ladies and gentlemen. I request you to kindly occupy your seat. We shall be starting with our session 3. Ladies and gentlemen, we shall now proceed with our third session on a contemporary topic, payments and cards. What to expect in a post-UPI Indian payments market. I am pleased to invite the panelists to the dais. Dr. N. Kamakodi, MD and CEO, City Union Bank. Mr. Dilip Asbe, MD and CEO, NPCI. Mr. Nikhil Sahani, Division President, South Asia MasterCard. Mr. Prasad Sonavne, Chief Revenue Officer, Innovity. Mr. Mahendra Nerurkar, CEO, Amazon Pay India. And our moderator for the session, Mr. Vivek Mandhata, Partner, BCG. Thank you, gentlemen. May I now request Mr. Vivek to initiate the panel discussions. Over to you, sir.
Thank you very much. I hope I'm audible. It's my privilege to be sitting with such an esteemed panel on the topic of payments and cards. And so let me get this going with a little bit of some context as we go along. I think we've all lived the journey of surge in digital payments. However, I'd just like to start with the point that we're still just beginning that journey, right? I mean, if you look at some data around whether it's payments to cash in circulation or number of payments being done by a bank person and benchmark us to many peer countries, we're still not there yet. And so there's a long journey to go. Similarly, if you look at even UPI, which has taken us by a little bit of a storm, right? I mean, from an activation perspective, if I just look at the statistics of active UPI to active savings accounts, it's still only at about 30%, which means there's still a long way to go even in that penetration cycle. The sentiment, though, there's a clear secular shift when we speak to consumers, which is saying we're going to use a lot more UPI, lot more wallets, less of cash, less of check, less of debit cards. The sentiment is quite secular. So I think with that, I think the question comes as to, we're going to see a growth cycle, right? We've seen a 5x growth cycle already in terms of volumes. We're set for another 5x growth in the next 5 years to come. So now maybe we get started with deliberating on where is this growth going to come from, right? So what are the interventions that are needed to drive this penetration further? And maybe I'd start with you, Dilip, to kick us off in terms of what more will happen which will get this penetration further going as we see the next 5 years.
So, so I think while the digital payments have been growing at a great speed, we still believe that there is a reasonable market left out, and we, I saw some number. I don't know whether it was 10x, 20x, or whatever it is, but we firmly believe that from where we stand, 10x growth is easily possible. I'm talking about all payments mode put together. From a UPI standpoint, we are looking at $1 billion a day as a target to be achieved by India. And earlier when we started talking about this about 3.5 years back, and that time it was like a long stretched number, and now it's just 4x what we need to reach $1 billion a day. So I don't think it's it doesn't appear to be a dream now. It appears to be reality. I think the question is when now.
Got it. And Mahendra, as you look at it as a facilitator of this UPI transactions, digital payment model, what further innovation do you see happening which will help get that remaining transaction target that Dilip is talking about?
Yeah, I think it's a great question for something that has already been growing at this kind of tearaway pace, right? But I think if you look at what are the potential pockets of opportunity that are relatively untapped, and what could be areas where within existing pockets penetration can be deepened, I can kind of think about it at least on two axes. One is for the set of customers who are already onto it. I think there are some areas where from a experience perspective there can be improvements. From a use case perspective there can be improvements. So the more the number of use cases you bring onto the network, you're going to see more growth coming in, right? So whether it is being able to pay from my bank account, which I can already do today, being able to pay from my credit card, that's like the next level thing. So I can see myself as a customer wanting to transact more and more as some of these features come alive. There are also use cases where today, I mean, it's fairly ubiquitous, but international, for example, is one of them. So some of these things will drive the next wave of growth within the existing consumer that is already transacting with UPI. I think amongst the next set of consumers, I feel underbanked and unbanked with newer payment products themselves, whether it is PPI or small bank accounts, etc., can be the next wave of growth as well. So I think, I mean, 10x growth, as Dilip mentioned, it's a matter of when versus if. But I would focus on those two accelerator dimensions. One is how to improve the experience and the selection offered to current customers, and how do you get more new customers into the fold. And of course, in addition to the underbanked and unbanked, there's also the under smartphone penetrated as a segment, right? And how do you, with feature phones and some of the newer features that NPCI is rolling out. So I think it's, I mean, 10x is underballing, I feel.
All right. And of course, a natural byproduct of what's happened is, debit transactions are all shifting towards UPI, converging towards UPI as a preferred model basis the experience that the consumer is getting. Mr. Kamkodi, when I come to you as a banker, what does this mean to all the investments that's happened in getting the debit card penetration to where it is, right? I think that's one of those penetration numbers that's very proudly spoken about. We have a quite deep penetration when it comes to debit cards. What does it mean to that form factor?
Vivek, one thing, if you look into the data, particularly when you have NPCI seeing, like say, 5x growth, and you are saying that you are going to see 10x growth, I won't say, or even the data don't suggest that it has totally eaten away what has happened through the ATM, or even if you look into the number of cash withdrawals from ATM network, when UPI transactions have increased by 5 times, those numbers have not come down. Even if you look into the other transactions by, like say, debit card, things have not come down. Maybe that they have not grown too much. Maybe you need another, maybe a 5 to 10 years time period when this has to happen. How I basically view this is that these modes will coexist at least for one more decade. See, probably they have to give only one thing. Like what is that? Is that instead of typing something, if I think in my mind, money is not going. So probably they will, NPCI will find that out anytime sooner that, like say, if I think something, the transaction will go through. I mean, that's the thing. I think they should be already working on that. So how it basically looks like is that at least for another 10 years or so, and as he rightly said, you have, I mean, the entire, like say, the incremental transactions, it has basically come from, I view that is that many of the transactions which are happening through cash have actually come to your digital or NPCI, I mean your UPI route or whatever that is. So, like say, the life for debit cards, I don't expect that to go anytime sooner. Already the wearables and all have come. Even we, from our bank, we introduced keychains and things like that in a different form, where you need a chip to initiate that transaction and all. They will coexist for some more time before everything gets into maybe other biometric based recognition to complete the transaction also. So, to summon substance is that maybe till they see another 5 times increase, like say it has to start from the rural and like say under-penetrated market where the cash transactions will migrate and these numbers will come. And slowly things will stabilize. Maybe I think we should be seeing before our retirement.
Good. And Nikhil, to Kamakodi's point, I mean, the non-ATM transactions are stagnating. They're not degrowing, but they're stagnating, right? So what does this mean to a network like, and how do you see that playing out as you look forward?
Oh, thanks, Vivek. I think Mr. Kamakodi has made it very easy for me to respond. So I think if the bank is saying that this is what's happening, there's not much more there is a network I can add to. But yes, I think the importance that I would want to articulate is it's a form factor. And, you know, once we had demonetization, you know, one of the strongest achievements was that we leapfrogged from 200 million debit cards to 900 million debit cards. And therefore, that form factor and that entire infrastructure, that entire distribution is already in place. Now, it is for the ecosystem to innovate to see how is it that you can make these form factors more relevant. So, these are all payment mechanisms, right? Fully understand. But is there a game that one can play by using this distribution capability that is available to build something on, you know, what the debit card has to offer? On non-ATM transactions, I do understand and I agree. So anyways, 75% of our market is still cash, which is, and a significant portion of that because of efforts from NPCI side on, and what UPI has delivered for us and as an economy is phenomenal. So we have got a whole lot of these transactions move from cash to digital. But as I said, it's a form factor, and let's face it, if you look at the overall ecosystem, you have 935 million debit cards, you have 78 million credit cards. Now, I rest my case. The number is significantly huge for us to be able to utilize what we have created than just say that it is something. But yes, ultimately at the end of the day, I don't even know what 10 years have in store. So I think Mr. Kamakodi has given a fairly, you know, kind of measured response on what will happen over the next 10 years. We actually don't know what's going to happen in the next 2. There is some sort of significant innovation which comes in and makes these things to go. So that would be my response.
Correct. Shifting this to one form of payment mode, which is e-commerce, right? We've seen a lot of trends around digital, and COVID has really accelerated the whole digital trend, and not just payments, but also in terms of online shopping behavior, retail behavior. And you know, from where we had at one point in time projected where commerce was going, we believe we've seen an acceleration of 3-4 years in terms of those numbers coming ahead in terms of online behavior of Indian consumers. However, when I look at payment checkout, it's still not the most seamless experience, right? I think the offline experience has been reasonably getting better and better with card tap, with QR-based payments, etc. Online still has to get that journey going. So Vasu, from your perspective, what innovation can we see happening in that space?
7-8 years ago when we do panels like this, the most common question asked either from the audience or the panel was, India's there in terms of potential e-commerce growth, explosive e-commerce growth is possible. It's just that there's not enough payment infrastructure or ability to pay digitally, and there are failures to, this used to be the most common question. So I'm glad it shifted from that focus to say that, and even though those days, one of the points that would get made is India perhaps has the best infrastructure from moving money in real time at very low cost. So over the last 7-8 years, if you take UPI, not meaning that if you ask me honestly, there's no further improvement possible. You can in terms of user interface to everything, but at the core, you're moving money in real time at no cost to consumer, or in today's context to a merchant. It can't get better than that unless you want to start paying people for transacting digitally, right? So we are at that peak in terms of what can happen from payment innovation. In terms of the experience from a checkout, usually a market gets what it wants or what it values. That's what drives a payment experience. What influences it further is consumer behavior and regulation. So those two have significantly shaped stuff in India, right? Because both from a technology perspective or a merchant ability, let's say, there's enough at play to say you can make it the equivalent of a 0 or a 1 click. There is that, let's say, technology and experiences available today. But it's also been shaped over the years by what consumers in India like, what gives them comfort, what makes them go through a secure experience. All this has also influenced the way regulations evolved. There's obviously been enough discussion, debate around what regulations evolved over the years, but many of these have centered around the consumer experience in terms of payments. These have tended to focus on what makes it very secure for the Indian consumer. And I think that's been the right focus in India. And one of the advantages we had is, in a regulatory sense, this was proactively thought at a point when the market was still beginning to grow, which is given enough time for the ecosystem participants to put in place a way to make payments and transact, which is perhaps among the most secure in the world, right from the second factor authentications to now card tokenization. So what we have now in place is the fact that you have the ability to move money in real time, no cost, and perhaps what is the most secure way today anywhere in the world. So from here on, user experiences will evolve, because I would think of the last 3-4 years being flux in terms of new payment products coming up, ways to pay. It's reasonably stable now, and I think as some of the points got made earlier, from here on we'll see innovation which will revolve around use cases. Because now with the payment infrastructure fully being ready and tested at scale, as each vertical of business will change, let's say something in healthcare, something in agriculture, something in B2B, those innovations will come around, not just the payment side. It will come first around the business, the documentation side, and the payments will all seamlessly fit in. The last step is, as Mr. Kamakuri said, there are only 3 things possible from here. Either you go predictive payments, where I anticipate what payment you want to make and I'll go ahead and make it. Or I move to telepathic payments and say, okay, I can read what's in your mind. Invisible payments have been talked of often. It's possible to do it even today. And in many forms they exist. They may not be called by that name, but they do exist in some sense. You set up recurring payments, it's happening seamlessly in the background. So yes, I would see many of the use cases evolving around specific verticals or way consumers behave going forward.
I think whenever we speak of growth, we speak of volumes going up. I think the next natural question comes down to the question of economics, right? And of course, we all know that there's a reason today that UPI is 0 MDR, RuPay debit cards are 0 MDR. Even the new credit card on UPI coming up, from an expansion reach perspective, it is incentivized with small ticket transactions being at 0 MDR, not all transactions being 0 MDR. And there is, of course, a cost that goes into all of this for the entire ecosystem, right? Not just for banks. There's a number that's put out there from a bank perspective, but everybody is incurring a cost to deliver this experience to the end consumer. So what does this mean in terms of the overall ecosystem? Will we see this become a hindrance to growth? Maybe Dilip, if I may just ask you that question, right? How do you see the ecosystem still continue to drive this growth despite this economic situation?
So, when we say zero MDR, there is some incentivization happening back from the government. Last 2 years, the ecosystem is getting some incentives in terms of part of that MDR. And as the volumes keeps growing, I think the expectation is the cost to the community has to rationalize, right? That's the standard logic which anybody would think about. But obviously, there is still more investments required, and I think as of now, the incentives from the government are helping to some stage. When I look at credit card, right? And today you can look at it. We have said that nil MDR for the below 2000 for the small merchant, which is the small merchant category as defined by the regulator. See, today you have to assume that that category does not exist on the credit card today, right? The category is a new category. There is no POS machine today and being the credit card being accepted. So we don't believe that more than 10% of the total RuPay credit card value will be on that small merchant. However, one important issue which we thought is when you see a QR code, today you are able to make payments using UPI, and when you add the RuPay credit cards on UPI, that will use while the payment product is RuPay credit cards, it's going to be still UPI railroads, and we thought that the customer must be able to use the credit card at the small merchants. It's very important, and we see two values, two big important aspects of that. One is the small merchant also gets some part of the credit to be utilized on his at his or her store, so that makes them part of the credit ecosystem. More transactions, and people use credit and pay more, right? Normally that's a logic which has been used, and merchant gets incentivized for that. And as they grow, automatically they will come back to the small merchant to a regular merchant category. Obviously, then they will start paying the MDR. So one aspect is how do we grow this merchant ecosystem, which is about 5 million merchant accepting credit cards to a 50 million merchant actually are capable to accept digital payments. So that's the first objective in terms of how do we give them that pathway to become a regular merchant. The second point is from the consumer side, which is from the demand side. The demand side also, right? Today the credit cards, Nikhil was talking about 78 million, while debit cards are 900 million. So I'm just saying that there's a huge 10x growth easily possible, 10x to 15x growth possible on the demand side, right? And it need not be 50,000, 1 lakh credit. It can be a small credit. However, the growth predominantly is going to come from tier 2 and above, right? And today the issue has been that there is no POS machine right now. So it's very important to supplement with the small merchant acceptance ecosystem, which is there up to tier 6 now, right? So that even the demand side can take advantage and grow. Obviously, it goes without saying that the 10% of the value which may go without getting reimbursed. Actually, it's a loan product, right? So loan product, there has to be some remuneration back to the bank. But what we feel right now, if that ratio remains 90-10 or below 10 somewhere, I think the banks will still promote this product to take advantage of the what you call the demand side explosive growth and the supply side explosive growth, right? Because normally the credit card is the income is interchange and revolvers, right? So I'm saying somewhere there could be subsidization. If the activation is very good, if the engagement is very good, revenues can be made. That's what is our assumption right now. But obviously we'll have to see how the market accepts it. Banks look at this whole thing.
And Prasad, if I may bring you in on this one, right? You deal with the merchants day in, day out. So and how is that cross subsidization that, and this is a belief that we've all had for long, right? As the merchant relationship becomes stickier, you'll be able to cross-sell, you'll be able to show value to the merchant and actually make the merchant more at a unit economic level profitable. Does that really play out, and how is it playing out in terms of the different merchant segments?
So thanks. I'll delve it into two parts. First part, I think, like Dilip said, there is exponential potential available still for consumption, right? So if I look at a digital transaction today, there are various users of the transaction, and it's important to see whether the economics make sense in everybody's mind. So, for example, if I go there to buy something, if I'm the buyer, then I am looking at convenience. I'm looking at risk-free transactions. I'm looking at maybe interest-free credit. I'm also looking at some saving on the transaction, which means I need to get my loyalty points. I need to get my cashbacks, promotional offers, whatever. So, as a customer, if I'm using the card, I'm willing to budget some amount of cost. Right now, in many form factors, there are no costs, but I'm willing to do that, right? So there's opportunity to be, cognizant of that. If I'm a merchant per se, then I would look at something like a deep integration, seamless integration, something which is like a straight-through reconciliation, where my efficiencies are increased for doing businesses. I will also not want to lose the customer. I want to make sure the customer buys more. How does he upsell? How does he, So I am also, as a merchant, willing to invest some kind of a cost, and I'll park it as my customer acquisition budget. Banks obviously, are looking at it from a perspective of, they are already, because of UPI, seeing very healthy saving account balances. They're looking at current balances. Their cost of borrowing is going down. They need to borrow less as well, right? In fact, at Innovative, we also look at a fourth partner. We look at the brand, the guy who actually sells his products. He is also looking at it from the transaction as a point of, a place where he can reach out to the customer directly. He can offer his benefit directly. He can talk to the customer directly. So he is also willing to invest. All these four parties actually make, a business case for being willing to share some amount of cost. This is where the economics gets impacted. Now, as a player in this business, if we can stitch all these four parties together, definitely it's possible to make very good economics out of it, right? How is it that we promise each of these players an incremental X over what they're already doing? So if it's a merchant, can I promise him extra growth in his business? If it's a customer, can I promise him extra convenience or some offers? All those things, people are willing to pay a price, and that's where I think the economics will come. Dilip obviously has talked about the potential growth in future. So I think that way we have been kind of successful in terms of stitching these four parties as a collaborator, and we are making good. We can see good economics coming out of it. I hope I answered the question. Yeah.
And Vasu, does it differ in the online merchant space, right? So online space, again, typically we believe the small merchants won't be willing to pay, but in the online space, maybe the larger enterprises are being more demanding in terms of economics. How do you see that in terms of the full value of the customer, profitability at a merchant level? How do you see that played out in the online space?
Personally speaking, I've never subscribed to your view that the merchant doesn't want to pay. In behavior sense, it's part of the cost of the business. You're paying for materials, you're paying employees, you're paying for rent. This would be another input cost. I just think in the way India has evolved, there has been the opportunity for merchants to gain from this in the shorter run. Now, from a national level, it's helped in many ways. It's accelerated digitalization, consumer adoption. But structurally, I don't think there was a great merchant reluctance to pay to begin with. And the merchants all over the world have paid. And all over there's been a debate, am I paying the right price? Am I paying the right price for credit, debit? That's been an ongoing global discussion. Given India's needs, which came in sense, it's a timing issue where free worked. But just to digress for a moment, before we look at payments and being free, one must remember it's the digital economy that introduced free, right? And all these terms. The pre-digital, there was nothing called free. Then you had propositions which said, do X transaction, get a Y cashback, right? The construct that you get paid as an incentivization started from that phase. So in the short run, obviously people are benefiting. To your question on UPI MDR2, it wouldn't grow if somebody wasn't benefiting. It's a question of who's gaining, and there'll obviously be some part of the chain that's not gaining as much as it should versus somebody else who's gaining. But there is that one dynamic. The second dynamic, to the point Prasad made, can you keep evolving business models to say, I will run a certain part of it at a loss to make money elsewhere? which is to say, do I run search free to make money on advertising, like a Google model, right? So you can keep extending that to say, can I offer payments free to make money elsewhere through value-add service, till somebody else comes and disrupts your value-add service to offer it free to make money elsewhere. So this is something one hopes will settle at some point. As the key aspect in this is primary providers of payments infrastructure even today are banks. So that's where people, and there has to be adequate, let's say, compensation remuneration happen, irrespective of where it comes from. So I do think that is something that will correct at some point. And this one can see of it as an investment phase. People have to run these investments to see. Some will win, some will survive, some won't. But that's how it will grow.
Taking cue from that, I think when we speak about investment and banks, right, one stat that I'll just like to show here is we are literally moving very fast into a multi-banking space as far as saving account customers are concerned. And almost 40% of the consumers we surveyed said they have multi-bank accounts, and 50% of them literally said payments is what drives which bank account is my primary account. So
you give this slide to me. I'll put it in the steering committees. What we run.
So Mr. Kamakodi, do you, for you from a bank perspective, of course you're making a little bit of an investment when it comes to processing all of that, but is this dimension helping you look at this more holistically to say payments is an investment for the lifetime value of the consumer?
See, I mean, particularly when I hear, like say, from the side of your fintech side or those who are on payment space, when you try to focus mainly on the payment side alone. As a banker, I find a disconnect between, like say, your the way you look into and the way we look into. Even like say, always during this transformation, like say, okay, there are a few fintech companies who commanded a lot of market capitalization and like say, a lot of value is created. We hear so many things. But as a bank, like the most important thing is the sustainability. Like say like say for what are all the priorities of like say particularly when you look into the payment space, who created value and all. Here the point is when we look at our investment on this thing, it is cost of being in the business. Like say for me, like say payment, like say this is the part and parcel in that service. So when he holds the thing, but at the same time, it is only one of the things for him. Like say, even now as we started from the beginning, like say, your ATM withdrawal, both in terms of number and amount, has not yet come down. So in that way, and another important item here is that, in fact, one of the, like say, visionary CEO of a banking industry, he asked, where is the profit? Laddu kahan hai? That was asked by, like say, I think you know what I'm talking about it. So basically, like as a bank, whether we like it or not, we had to copy or provide the services which are given by whatever that is getting cleared out in the thing, and we have to continuously make that investment, which is still part, we add it as a part of our CASA cost or whatever it is. Finally, we make in overall, whether we are able to take our return on equity on the overall investment. But coming to the payment per se, say at least when we all started our career, a credit card or debit card was supposed to be very exclusive product. So that investment cannot be, like say, distributed across everybody, so you needed a lot of MDR at that point of time. When cards or other, like say, even starting from the bank accounts, everything became democratic. So the same investment, the cost is getting distributed among multiple times the people. So you cannot continue to add that, like say, you made a 2.5% MDR 10 years back and you will be having the same percentage going forward also. Finally, the expectations for the community at large should be, like say, when I am transacting cash, I am not incurring any cash. Probably it will be the bank which is incurring cost on sorting, giving out, moving or whatever it is. The expectation of the customer will be that, like, whenever I make a transaction, it should be zero cost or near zero cost. So in that way, it will be, going forward, it will be very difficult. Like say, we all need to make that investment on infrastructure continuously. Say, for example, the QR card, it is completely a different thing. Like the major investment that was needed for, like say, even it could be 1,000 rupees, say, PAS machine. So the QR code completely replaced that. Like say, the hardware is getting replaced when it is by the software and all. So things change. And going forward, eventually, whether we like it or not, the MDR will come to the near zero only, and it will, that will be the direction with which you go. And I'm not sure where is the place to make money. You can't make undue money out of this, is the precise thing, unless and otherwise you add any extra value and convince the customer that you are giving some value for which he is prepared to pay. And as a bank, I have to continuously, I have to make investment in technology. Like say when ATM technology grew, it was 15-20 lakhs, then it came to 2-3 lakhs, the ATM cost came down. Number of people who used that increased. Like that, whenever there is an evolution in terms of the technology, so probably the evolution will happen in such a way that you don't have, like say, all the costs involved are say software costs, which can be scaled up without having any incremental cost on the individual units. So when it goes that way, probably this is how things will evolve, is what it looks like at this point of time.
And Mahendra, from your perspective, you're dealing with both consumers and merchants, right? And you're making that investment today that Kamakodi is talking about at the same time. How do you see the economic journey, right, over the next few years play out, both consumer as well as merchant?
Yeah, and I think 2-3 things I would say, right? First and foremost, I think one of your earlier slides showed that it's about a 20 to 50 basis points cost to process a transaction. The way I read it is, I looked at that data point and I looked at Dilip's data point of 10x growth. And I'm like, if my software doesn't have to scale at the same rate, then I'm processing payments at 2 basis points, right? So that's disruptive. So I think we need to look at not current costs, but long-term costs when we are starting to have these discussions, number one. Number two, I feel that the mental model for how we think about revenues in this space perhaps might undergo some transformation from pure transactional economics to customer economics. We've seen this in different industries play out differently, right? People used to previously pay for a whole entire CD full of an album of music, and that became a per unit of, hey, you can now download a song for 99 cents. I think this might go the other way around, which is I may not pay or earn on any transaction, but there might be opportunities to make revenue if you're a bank, if you're a merchant, if you're a TPAP, whatever it is, in building that customer relationship. It could be through advertising, it could be through credit, it could be through various financial services. I think Dilip talked about how a merchant's business could grow and move from one segment to the other. So I feel that where we are right now, at the current scale of adoption, if we start thinking about what I'm calling it as cashing out too soon, you will hurt growth, right? We need to figure out how to scale the cost structure. I think it's an already insanely good cost structure, but it can scale even further, right? And then perhaps start to reimagine the economic model of this overall industry, not just at a transactional level, but at an overall customer lifecycle perspective. So I think those are a couple of things from a long-term perspective that I think are important. I think from a near-term perspective, while we talk a lot about bank and bank costs and how to subsidize them or how to drive revenues there, there is also the other side of the ecosystem which is driving demand for this, right? Like it's the TPAPs, and they're putting a lot of money in terms of customer acquisition, retention, etc. And whatever that subsidy today is coming through, that needs to be equitably distributed through the ecosystem, which is not happening right now. So I think those are probably like the short-term inefficiencies, but long-term, I just feel like we have to think about this at a 10x scale and then see where these things go.
Just shifting gears to the other side of the coin, which is the credit card and the credit reach side of the coin. I think, Nikhil, you alluded to this earlier that, we still have only about 78 million cards in the country. And we've spoken about the underpenetration for a while now, and we all agree that there's a lot of underpenetration when it comes to credit card. The good news is credit card spend is bouncing back, it's on the growth pattern, but the real question comes down to what are we ready for this drive now, right? So BNPL tried to replace some segment of that, it didn't go anywhere. So will credit cards finally take the space that we've been hoping they will? And what will unlock that reach now of those credit cards?
Vivek, that's a great question and actually $1 million question. I'll try my attempt to, kind of put at least a perspective around this. Obviously, these numbers are fairly well known to us. Potentially with the conversations that are happening around India reaching a $5 trillion economy, as well as, I read somewhere today that we are talking about 2027 being there when we take over, or rather overtake Germany as the 4th largest economy in the world. Most of this will be driven only if we are able to create a strong credit market. And that strong credit market, most economies, developed economies in the world have evolved because they have been very, very strong credit economies. And potentially with, the sort of platform that at least UPI has created, and now Dilip was mentioning also about UPI on credit, I think this will give an overall fillip to the entire ecosystem. So it's a fairly well-known fact as per RBI, data, 14,500 per month is the spend on a credit card. When you go to a debit card, it's only about 750 odd rupees. So it's a 20x multiplier. And of course, more revolver means more consumption. More consumption means, much more activity, and that is what will lead to growth in the economy. So that's the first and foremost thing. And yes, I think most of the growth will come from the tier 3 to the tier 6 towns. Although I find it very fascinating on the definitions of tier 3 and tier 6 towns in our country, and the way those cities behave is very, very different from what we understand in this August room, in this August gathering, in my opinion. So there is a whole lot that's happening in those markets as well. But I think fundamentally, form factors, BNPL, I do agree. But I think BNPL will make a resurgence in a different format. I won't write it off. Of course, it's been deliberated, and maybe for want of a better word, it was kind of misused in some global markets. I think India will be a lot more active in the way we control our regulation. I think the regulator does a phenomenal job of, course correcting the way, the ecosystem moves, in my opinion. And I think credit, UPI on credit will be one, RuPay on UPI will be one significant incentive. And as I said, as we move forward and with the data that was just being talked about on the debit side, just to take a, little bit of a shift to what, on credit, savings account rates were deregulated in 2011. You saw savings account war on rates. Where are the rates today? They have stabilized. So from a pricing perspective, the market itself finds out its own stability. The market evolves. The market decides the pricing, as Mahindra was also making that point. 2 basis points for, it's like those numbers are really, they are numbers that you have to take into account. But coming back to the credit point, I think there is significant enough room. There's distribution, and they will obviously be the same capability to have customers upgraded from debit to credit, which I think is the biggest play that will ensure growth rates. We are looking at 14% growth rates on a monthly basis. September was a 14% month, yes. It's a seasonal or rather a festive season month, so I do understand. But those sorts of growth rates, tell me an economies are growing at 1% per annum. We are talking about 14% in a month. We are looking at very different levels, and it has to happen in India. It hasn't happened for a set of reasons. We have the infrastructure, we have the digital infrastructure, we have the setup, we possibly have appetite today, because look at banks' balance sheets. Mr. Kamakodi will tell you the numbers that you're seeing from all bank balance sheets, rocking.
In fact, that brings me to Kamakodi, from your perspective. One of the drivers of penetration will be the banks willing to underwrite the risk associated with credit card, right? And will the data now that's flowing through a UPI transaction, or a lot more data about a customer going from cash to digital, will that help you extend the credit card to a different customer segment? And therefore, will that be the next path to seeing a larger base of people credit carded in the country?
I would just like to extend from where Mr. Nikhil started, maybe slightly in a different perspective. Because if everybody talks in the same language that it is going up and all, probably even people will not feel it interesting. That too immediately after in the post-lunch session. You hear the same statistics about per capita beer consumption. You hear the same thing in almost every consumption. So let us not get carried away that immediately we are going to catch up somewhere in the top and all. I mean, let us be pragmatic. Once again, it basically comes from the culture or the value system that had been imbibed over centuries. It may take, if not centuries, at least a few generations or at least decades to get these things done. And for all these things, the most important thing is that how quick is your per capita income going to improve? So that only give for a common man, like say, the banks may be interested in giving, but he also should be mentally prepared to take that, like say, amount of borrowing. So it is going to happen, definitely it is going to happen, but like say when you compare like say 70 for you and 800 for China and all, this gap, the 10 times gap is going to get filled up immediately and all, may not be that way, it may happen slowly. It is not just the data, like say for example, the issue is, yes, definitely you have a lot of data to make a better assumption. It doesn't mean that 100% of the people will be getting eligible for a higher limit or whatever it is. So it all depends upon the individuals, how his income increases, how his, like say, stability in the income will be there over a period of time, how his own perception and then the perception of the bank comes in. Yes, definitely things look good, but let us not get carried away just by putting today's point and futuristic point and draw a straight line or pulling the Excel spreadsheet and look out a CAGR and make a valuation on that.
Fair enough. So if I look at the acceptance side, Prasad, now one acceptance expansion is of course what Dilip referred to earlier, right? That you're going to see a segment of merchants who didn't have POS machines earlier, who will now be able to accept credit cards through a different form factor, right? So there's also the question of economics we all debated. So what will it take to get this new set of merchants to start taking credit card on UPI? Of course, it will run on the rails. They may not be able to control it. There are many aspects to it, right? Will we see a resistance to that form factor playing out? Will that be smooth? What's the journey going to be like for that?
So first is, I think with credit cards coming on UPI, I think it is a great thing because it's going to accelerate acceptance of credit cards in the small merchant space. I think that's what you're trying to allude to, right? Definitely, we look at explosion in terms of the way credit is being distributed, right? What is going to happen? I think there is a cost factor, obviously, which is there today. There is a mindset because today the cost regime is very different, right? Today we're not used to seeing costs on UPI so far. But and I can only share from our experience. So we at Innovity, for example, I'll give you a very simple use case. We have about 25,000 small merchants. So we talk about the small merchant space, and they are in the electronics segment, very competitive space. Too much of competition actually. Plus, these are the ones who are kind of also facing the brunt of the tightening of the customer's budget today, right? But what we have seen typically today is that they are very hungry to grow, and if they can see growth, they are willing to consider costs as an acceptable norm. So, in terms of acceptance of credit card, RuPay credit card on UPI, I think it is definitely a clear positive indication. Just to continue with the example of these electronics merchants today, in fact, you'll be surprised to know that they actually do pay us a premium over the normal MDR also, right? Because they see us collaborating with banks and brands and giving them offers. One simple thing, today they are able to see incremental growth coming out of maybe a simple tool like EMI. BNPL obviously is not doing very well, but EMI they are able to see. And what they can understand is, okay, if I can see EMI helping me give incremental growth, and somebody is giving me EMI in a domain where there are standard affordability schemes are not present, I'm willing to pay a premium, and that's what they are doing. So if you give them a visibility of growth and they can see the correlation between growth and the cost, they are quite gung-ho about this. And this has been our experience. And this is not just in electronics or the mid-market space. Even if you look at use cases in every industry, We, for example, we have a very separate use case for food and grocery. We have a very separate use case for fashion and apparel. Right? Same thing doesn't work everywhere. But what that requires us to do is a little bit brainstorming on what the merchant, what the industry, what does consumers today want. So I don't think credit card usage on UPI is going to be it's something which we are really looking forward to. I think it's going to expand the market and in fact going to have very positive effects for us because just adding to what Mr. Kamakoti said that for next 10 years debit cards are here to stay. So that kind of secures the future for POS machines also. So I'm very happy with that. Yeah. I think both there is a lot of sorry, just to continue further. If we can show the merchant or the banks or whoever the partner is that there is something incremental that you can deliver, right? I think they are willing to pay for it.
And what does this mean to the POS infrastructure itself, right? I mean, we've had multiple variants of that evolve over time, right? So we've seen the traditional POS machines, we've moved to soft POS, we've seen UPI QR come up, we've seen Bharat QR come up, we've seen different variants of QR come up. So as you go ahead, what form factor do we see remaining? Will we all these coexist, right? Or will we see over time that it's all going to be one QR on the desk and POS machines will all move to the side? How do you see that space going, Prasad?
So the POS the existence of the POS has been, always questioned from eternity, right? I mean, I remember the first zip-zap machine which we used to see, where you would actually physically do the card swiping. Then the EDCs came in, and then the multi-acquiring POS which we see today. Those are all there, right? I think what is more important is the underlying relationship, whether it continues with the merchant and the business, right? And that continues only if the partners see us as, partners who are adding value to their business. I'll explain a little bit, right? Today, for example, if I look at a POS, from the time which used to only accept payments, today it is doing a lot much more. I mean, we are having API tools which are purchase acceleration tools. We try to help the merchant grow his business, right? And we therefore want to be seen as somebody who is a growth partner, not a cost item, not a infrastructure item. Okay, I set up my shop, I should buy a POS. That I bought an AC, now I want to buy a POS also. We don't want to be like that. We want to be somebody who can enable his business to grow. And again, I'm taking an example from our, my experience, right? So we have, for example, we have a product called Genie, which is used by the small merchants again. Very relevant because small merchants today are facing the brunt of competition. They are facing the, inflationary pressures, customers not buying and all. What we are able to do is using our relationships with some of the banks and the brands, we are able to get them value. In terms of the way the POS has evolved, let me give an example. We've just launched a deep link, which uses UPI as well, and that takes the level of convenience to a different high. So if I'm doing, and this is relevant, for example, in the space, if I'm doing a home delivery transaction, right? I mean, imagine the guy is standing at my doorstep and I'm very worried whether the transaction will go through or not. Right? There's so many breakages. We talked about the clunky experience of acceptance, etc. So we understood that, okay, there is a lot of anxiety in the consumer's mind. What can we do to reduce that anxiety? So we cut down the steps in terms of card acceptance. We cut down very simple things like the intermediary web page doesn't come in. It kind of shortens the journey by about 50-60%. Conversion becomes quicker and the merchants start preferring you. Plus the merchants can also start getting insights on what are the types of payment modes that the customer is preferring. What is the journey of the customer? Where did he exactly choose which link? Those kind of insights help him close the customer. So these are things which as POS players we are evolving, we are innovating as well. And I think over a period of time, I think the entire QR journey, right, of acceleration of acceptance by the sticker was fantastic, fabulous. But the underlying question again is, what else can the POS and the QR do today besides just plain acceptance of cards, right? I mean, there is use case for both. POS as well as QR will definitely stay. They will evolve. The form factor will definitely evolve. But idea is who can deliver much more than just plain acceptance. Yeah.
Got it. And just to fast forward, as we look ahead in terms of investments, we spoke about different kinds of investments happening. I mean, there is, as we're going more and more digital as a nation, not just on payments, but on many other aspects. Of course, there's a financial aspect with payments that becomes even more critical. There's investment in terms of cybersecurity, fraud management or fraud prevention, data security and privacy, which we keep talking about. So, Faso, I may start with you. Are we seeing enough investments go in? Are we, as an ecosystem, different stakeholders need to invest in this, right? It's not just one element. There are different people in the entire value chain that are involved. Many of you are sitting on this dais today across the spectrum, right? Are we seeing enough going into the space that gives us comfort?
I think one of the advantages this market has had is, like I referred earlier, the regulator's taken a proactive interest on these, knowing, I guess, from the fact that traditional infrastructure has been poor, investments haven't been there, and let's say the resolution mechanisms have been poor. So I think the way it's worked in India is there have been soft policies that have come up to ensure that we're able to mitigate some of these. In terms of transactional behavior, India has among the lowest rates of fraud. So I mean, one can kind of split hairs there, but really speaking, I don't think great investment need to be made per se. It's not a significant area of concern. There are areas of concern around addressing customer grievances, which is not so much linked to fraud from infrastructure perspective, but fraud or misuse based on customers' awareness to lack of education. And that's something that you would have seen even including TV ads, is great focus on saying the real need in India is customer education. Because what has happened over, I think, the last 4 or 5 years is the pace at which the ability of a let's say, not digitally literate customer to be able to transact digitally has grown faster than, let's say, the mechanisms to educate them. So to that extent, the real need of investment there is a soft education bit of it, which will happen in due course. I mean, there is no way you can shortcut. But great stuff is happening there. I'm saying anybody who watches regular TV, I mean, I watched TV after many years, and I was surprised to see Mr. Amitabh Bachchan take a break during his KBC questions to educate customers around how it should be used. And I don't think there's any other country where the regulator push for it, where RBI is advertising to say how should tokenization work. So I think the real need is in that segment, and enough from happening there.
Nikhil, you look at this aspect across countries, right? I mean, and so how do you see India stacking up in terms of the security, the protocols that we have around different payment networks today in the country? And we are in a place where multiple networks are coexisting and scaling at the same time. So do you see that we are at par or we're behind in terms of where we are?
No, so I think, taking forward from where what Vasu just mentioned, of course, soft policies, I do agree. And on the consumer side, I think we're just about reasonably there. I think from a fraud perspective, completely agree. I think you don't see a regulator promote, fraud prevention, protection from a consumer perspective. But I think there's a larger piece here, which is on the overall ecosystem's preparedness for cyber attacks and cyber frauds. And I actually will possibly pivot here from consumers towards the entire ecosystem on the corporate and the MSME side. Is there enough investment? And today, it's not that you have to be an online organization to, plan for cyber risk. Every organization today is online. You just read about one of the largest groups in India having a cyber attack on one of their, organizations in the power sector. We also have heard about the Colonial Pipeline crisis that happened in New York in May last year, where there was no supply from Texas to New York because there was a cyber attack, and the hackers had to be paid 75 bitcoins worth $4.5 million for it to be released. So I don't think we've done enough so for example, if you look at rating agencies, I know this is a little bit of a topic. Do rating agencies take cyber risk preparedness of organizations into account before giving out a rating? I think the answer is most definitely an NO, which is, to my mind, a much bigger risk for the entire ecosystem. So it's not only about consumer protection. We are today a connected world, so there has to be that investment, and therefore cyber risk has to be for organizations a boardroom agenda. If you don't have planning for cyber risk, you are running on a sitting time bomb, and it'll go off anytime. As Vasu said, our fraud rates are low, but maybe we don't have significantly heavy level of hackers in this market, and that's something that's going to happen very soon. Because those hackers are as smart as some of the people who build these systems, possibly smarter. Go back to a Hollywood movie, Die Hard 4, and the fire sale that happened in that movie. Look at it and you'll understand what I'm trying to say.
So maybe moving to the last segment of this conversation, we heard the governor speak about CBDC-R coming out soon, pilot. Dilip, as you look at this new set of payment mode coming into the space, right? UPI, as we discussed, largely help move cash towards digital. CBDC-R will potentially coexist and do a similar role. How do you see CBDC-R and UPI playing two to tango here?
So with your permission, I just want to talk about the previous slide, because
Absolutely,
the previous
please.
slide is very important. And this is where, while I agree with Kamakodi sir also that we should price our products appropriately and we should not take undue profits, but at the same time, we should not underprice as well, because the cyber security, the fraud protection and the consumer protection on data and other privacy protections, the ecosystem has to invest, and the ecosystem is strong enough as much as its weakest link is, right? So we do not want the ecosystem to cut corners on these important things. And this is where the reasonable revenue and whichever line of the business which you are talking about is super important to deal with. Now, when you look at the customer protection, the customer grievance, customer protection, we have the ODR, online dispute resolution, which is now mandated by the regulator. The cyber security, now we have the bodies like CERTIN and those kind of institutions, the CSIT, Rebit, who are trying to monitor and guide the ecosystem to build up the standards what you require. However, on the fraud protection side, we think that there is we need a lot more to be done, right? Because while RBI, a lot of efforts have been made by RBI and others, the next 300, 400 million people who are going to come inside the digital ecosystem, the education and awareness level are going to be very low. And these are the people who would be more vulnerable back to the social engineering frauds. So I still believe that there is a lot more to be done, while there has been a lot of things being done. But I think all the three areas requires a huge investments from the banks in India and the fintechs in India to look at that. So all the innovations, multiple innovations would be helpful for investment. They should not look, fintechs must not only look at the valuations and gains, they should also look at investments into these areas, because these are super critical. This is 1 and 0 game in that sense. Sorry, on the central bank digital currency, I think, it's a digital currency, and today the consumer uses the cash for different reasons than what he's using the digital payments for. While the education, awareness, fear would be one of the things, but there is a reason why people use cash in India. And while he was talking about ATMs have not dropped down, it's still stagnant. The cash in circulation is still at one of the highest levels right now. Might be because of COVID, the hoarding effects are still not tapered down. Those might be the reason. But I think it's the right time to start piloting. Obviously, nothing will change in a year or two. It might take 5-10 years time, as sir was talking about. But I think it's an important initiative of the regulator. The business models will change. The way we are doing a business will change. While digital money with the UPI and UPI will continue to innovate, but I think the CBDC provides a huge technological advantage over the digital money, right? And it's you can look at programmability, you can look at purpose-driven money, and a lot of things which we can do in a CBDC, which you can't do in a digital money. So I believe it's a great future, but in the long run. And everything in India will compete and collaborate at the same time. So,
on that note, I would like to thank everyone. I think we are all heading towards a wonderful next 5 years. I think the 10x, 5x that we spoke about, the marginal cost getting better as we go along, security getting better, customer experience getting better. I think a lot of positive notes to take away from this conversation. Thank you so much for this conversation.
Thanks indeed to the distinguished panelists for the engrossing discussions on the topic.
We will discuss.
Ladies and gentlemen, I request you to kindly take your seats. We shall be starting with our session 4th. Ladies and gentlemen, a humble request to kindly clear the dais area. Ladies and gentlemen, I am pleased to announce our 4th session, which is panel discussion on Fintechs, learning from past moves and improving collaborations with banks. May I now invite the distinguished panelists to the dais. Mr. Deepak Sharma, President and CDO, Kotak Mahindra Bank. Mr. Samir Shetty, President and Head, Digital Banking, Axis Bank. Mr. Shankar Subramanian, India Corporate Banking Head, Bank of America. Mr. Vishwanath Ramaswamy, Vice President, Technology, IBM India and South Asia. Mr. Sabyasachi Goswami, CEO, Perfios. And our moderator for the session, Ms. Neetu Chitkara, MD and Partner, BCG. May I request Ms. Neetu to initiate the panel discussions? Over to you, ma'am.
Thank you so much. Collaboration. A simple 13-letter word. Or is it? Over the next 45 minutes or so, we'll try to uncover the various aspects of bank and fintech collaboration. What works? What doesn't work? What could work given the right direction? And the last part is particularly important given the changes in the fintech as well as the regulatory landscape in India. So let's get started. If you look at the fintech landscape in India itself, India is one of the most vibrant fintech ecosystems in the world. We're third largest in terms of number of fintechs and continuously growing. And not just about the number of fintechs itself. If you look at different facets of fintechs, in many places they have increasingly begun to play a much bigger role. So whether I take the area of lending, where we look at new to credit customers, actually 36%, the fintechs have a much higher share of NTC customers compared to banks. If I look at payments, and that's something that we see on a day-to-day basis, actually the market share is much higher, almost 93%. If I look at wealth, where I look at the share of active broking clients, again, fintechs have continued to play a very important role. So the idea is that this is no longer a part of the ecosystem that we can ignore, and it's very, very important and on how we define the bank and fintech collaboration going forward. But where are we actually in terms of this collaboration? And this is one of the surveys that we did earlier in the year, where we spoke to almost 100 incumbents as well as fintechs, the leadership teams in these, and we asked them, what are the challenges that you face today in terms of bank-fintech collaboration? And here are some of the responses. So, low tech maturity of the incumbents, operational complexity, which continues to be a big challenge, regulatory hurdles, and this came up a lot more in the discussions going even in the recent past, and even basic things like incentives. And it's interesting to say, if you see the last quote on the right, which is that earlier it used to be about different incentives. So fintechs focusing on valuation and scale, and incumbents tracking profitability. Thankfully, over the last few months, we are starting to see more of convergence, at least on some of those areas. While we have seen some of the challenges, we also wanted to start to think about what a solution space could look like. And obviously, it's a complex problem, so there are no simple answers. But maybe we just wanted to bring some interesting learnings from across the globe. And one such example is this. So this is actually, CBNC is a community of in the US of financial services professionals. It has about 8,600 financial institutions as part of this, and it's been going on for more than 10 years. And more recently, in Jan of this year, they actually launched something called a fintech marketplace. So in this, fintechs, it's free for the professionals from the various financial institutions and also for the vendors. The whole idea and the concept being that while innovation happens pretty quickly, awareness of that doesn't often comes with a lag. So how do we ensure that the awareness of this innovation is also disseminated a lot more quickly? And so what you see here is, some of the snapshots where they've categorized the fintechs into different segments. Incumbents can actually provide ratings of the fintechs they work with. It provides details of the products. It's almost like the way you shop for many other things. Can you shop for partnerships? I would say some concepts out there, but people have actually really implemented it. So how do we really reimagine fintech and bank collaboration in a completely new way? And we're going to talk about that with the illustrious panel that we have here today. So there are 4 questions that we're going to talk about the panel, just understanding, what are given the topic on learnings from the past, so what have been the experiences with the fintech collaboration, what kind of learnings we have seen, and what kind of imperatives that we see going forward. So maybe let me start with the first 2 questions, given many of them are related. And Deepak, you being the CDO at Kotak, you would have had a lot of experiences. Do you want to share, what have been your experiences with this collaboration, and how has that turned out?
Yeah, sure. Thanks, Neetu. Maybe I think since I'm opening, some of my statements may sound to be a bit of a dampener, because you already showed that how in most categories fintechs are way ahead and banks are somewhere behind. I think there are 3 models that I have seen emerge in my last 6 or 7 years. Because there was a time when 2015, 2016, everybody said, oh, our fintech's going to eat banks away, and our banks getting disrupted by fintech. There was truth in that as we look at that data 7 years down the line. The second was, are banks really out there to compete with fintech? Again, I think there is enough evidence that there are banks, including we at Kotak, have been able to build certain things fast and rapidly enough to build our own fintech model coming out of an incumbent bank like 811. And I think the third part is, which is where now the larger part of the discussion is, that can fintech and banks work together to collaborate and co-create? I think we have started to see a lot of that happening in last few years, be it through the set of APIs or the open banking standards that have started to come, or looking at some kind of a partnerships where not just acquiring customer, but engagement, value add, looking at more as a TSP. So there are many form factors in which I think banks have started to figure where the values are, but that's not uniform across banks. I think each bank is looking at what model works best for them. So when I look at it from Kotak's context, obviously my way of looking at fintech is very different than probably Samir would be looking at Axis, or somebody else is looking at one of the large public sector banks. My model is very simple. I want to look at the firm at Kotak to be a fintech in itself. So there are areas where if I have to concede the space of customer engagement and experience to fintech and we be the backend layer, are we going to collaborate or participate in those space? Answer is no. So we are very clear where we will not partner or participate. But if there are opportunities to co-create with an equal incentive and value alignment, both for the customer and for the firms, then definitely we look at those opportunities. So I think there are those careful now crafting of where you collaborate, where you compete, and where you co-create. I think that has started to emerge within banks.
That's very good and clear, Deepak, that you could articulate it in such a sharp manner. Sabyasachi, I would cross over to the fintech side and hear your perspectives. How have you seen this play out, and particularly as a fintech working with multiple banks, what have been your experiences?
Thanks, Neetu. So from our perspective at Perfios, I think hello. So from our perspective at Perfios, I think the journey has been phenomenal working with banks specifically. And I cannot stress less on one important aspect, which is learning. And learning with enough curation in the process, right? So what we have seen over years is that both banks and fintechs, or rather we will call ourselves as TechFin, we have been collaborating together in terms of co-creating a lot of journeys, and it's more of a consultative approach where we have been brought in early in the journey while the journey has been discussed within the bank so that the right amount of value creation can happen. And I think it's important for any fintech to kind of not look at short-term profitability as the goal. Rather, it has to be a lot more focus on value creation, because as a product that can hold good for long term rather than a short term objective of profitability. And I think that's what has been kind of held good for us. And I think what happened from a collaboration standpoint and a learning standpoint, the banks were quite open, and our relationship has been more of a kind of receive kind of relationship, in the sense we discussed very openly, both parties in this scenario, the banks and us, about the process improvement in terms of where we can improve and build better journeys. And I think there the collaboration truly kind of tested its ground, and it was phenomenal. So I think the key experience from our perspective has been the learning and the curation of the learning during the entire process. And overall, very personal, I would say it's a win-win handshake between both banks and us. So that's what I'll leave it at.
Got it. And also having, like you said, the learning curve itself being partnered with various banks. Samir, you've also, Deepak highlighted Kotak's way that they want to be the fintech in itself. Is there a way you also think about fintech collaboration in a similar manner, in a different manner? What have been your experiences? And I know you have great inputs on learnings on, whether you grow the pie or the way you cut the pie. So would be useful to hear that.
Yeah, sure. Firstly, thanks a lot for having me on the panel, and good evening to everybody here. So, so firstly, your chart said there are 7,400 fintechs, right? And so, fintech is not one entity. There is a very, very big range. And so you have, on the one hand, you have, let's say, folks like Perfios who are actually providing capabilities. And then on the other hand, you will have folks who are helping you get customers, and very different types of partnerships. And I think the two have evolved very differently as well, historically. And both, by the way, have great value, and we have to figure out how we make both happen. Our perspective on the capability side, we are very open. If the capability is good and it's at scale, it is regulatory compliant, and so on and so forth, we are happy to collaborate. We have many of these partnerships and doing very well, actually. On the customer front, our general philosophy to partnerships is that we are India's third largest private sector bank, but our market share is 5%. So 95% is out there. And if we can get access to the 95 by sharing some value, we are happy to. We are not here to lend our license. That is very, very clear to us. We are not here to lend our banking license. But if there are folks who we can work with, and jointly build something, we'll be delighted to do that. And we've been on this journey for some time, actually. We have a reasonably well-developed tech stack, open APIs. Our developer portal is actually quite good. And we have a bunch of partners that we work with. The second type of partnership, I think, has gone through a significant evolution in the last 3 years. So it's moved from everybody try everything with everybody type of thing, to now folks saying, look, every partnership to succeed requires a lot of commitment. And so you can't actually just go out and, do speed dating with everyone. You have to commit to a few relationships. So that, I think, is very clear, both for us and also for fintechs. Second, I think there is a I think fintechs have understood banks better, banks have understood fintechs better. Over the last 3 years, because till then it was just I think 3 years back, it was a little bit of a fairy tale, right? Like,
are you saying dating versus now people are...
Yeah, exactly. Now kind of, speed dating too. It's a great analogy. So now, you kind of seen the bad side of both things, and you are coming to terms with that. And so as an example, 3 years back, there would be fintechs who would say, X we will do over my dead body. Something like that, right? Like, we will just not do it, and it may be completely against regulations, but they will just kind of say, no conversation until you can do this. That has mellowed down quite dramatically. We, on the other side, we would say that something we will do over our dead bodies, and kind of that has changed. So I think the relationships have changed and the conversation has changed. I think there are two things that are going to, my learnings, that are critical now for the next, let's say, 12 to 18 months. First is regulations. I think regulations is moving very fast, and it'll continue to move fast based on whatever one can hear and see. And the regulatory mindset is to say that, look, everybody is open to come and participate. However, it has to be in the right way. Please come through the front door and not through the back door. That's kind of the regulatory positioning, right? And so that, I think, will separate the wheat from the chaff over the next 12, 18 months. And so that's a very important one. Critically, from a bank perspective, more and more the onus of ensuring that compliance is done is on the bank, even for the partner. And so we have to be very thoughtful about that, and we expect our partners to be thoughtful. So that is, I will say, one. The second thing, which I think is becoming more and more important, is this pie piece, right? Which is, there is a pie, which is the profit that you make from or value that you create out of a certain piece of activity. You can expand that pie or you can split that pie. And actually, in the partnership, you end up doing both. But how this pie gets split, and what is an equation or an understanding between the bank and fintech that both benefit and not either at the cost of the other is going to be super critical in making this happen. And this one is not, at least like it's not straightforward in my mind. It's a fairly complicated piece of conversation to have.
Yeah, very interesting. And you know, I remember in some of the conversations that you said, as the fintechs themselves are looking at profitability, so it's almost like having a clear view that is the pie going to expand enough for me to actually make profit? And you know, it's almost like since we came to the dating example, you know, first time you're just, you know, just jumping out there. Now you're very clear of what you want, what they want, and then how do you have a much more mature conversation in some ways. So far we've covered quite a bit on, you know, how things are in India, and you know, Shankar, I wanted to bring you in at this point because, you know, as Bank of America, you've also seen how some of this happens globally. And do you see any differences, similarities on, you know, how some of the partnerships work, and are there any learnings that we need to think about?
Sure. Thanks, Neetu. So yeah, I would say actually quite a lot of similarities if I look at some of the partnerships that our bank has got into, whether it's in Europe or in the US. And I think the way I look at it is that you have two options. You have fintech tie-ups which are strategic, which you're planning, preparing along with the fintech, like what Samir just alluded to, you know, spend time together. And some that happen on a tactical basis. That's because of a market development or a market change. And one recent example that I can probably reference is that I'm sure all of us must have seen that sometime around November last year, one of the largest e-commerce companies just took a call that in the UK they'll stop accepting Visa cards because of merchant discounting rates and stuff like that happened in the UK. Now, if you're a bank that's offering clearing and settlement services to the e-commerce company, you need to have alternative solutions ready and immediate. You cannot be waiting for a solution to be developed, right? So for example, we then got into a tie-up in London, in UK, with a fintech called BankEd, and now we allow, you know, customers who are purchasing on the e-commerce company to just directly debit their bank accounts. Now that was not a feature or a capability we thought would be required. We thought cards would be adequate, but there was a tactical need, a sudden change in customer behavior for which we needed an immediate solution. And it worked very efficiently for us that we could quickly turn it around and launch a capability, which of course we are now cross-selling to many other customers as well. You then have the strategic things where you know that is a gap or an improvement in service that you need to bring in, where you will collaborate, work in partnership with the fintech. So for example, in fraud management, something that I think all banks are focused upon, all banks want to keep looking at alternatives, avenues to improve the processing. And again, in the US, we've got a specific tie-up with certain companies which help us identify the beneficiary of the payment before the payment is executed in near real-time basis, right? So that is a strategic thing that we've worked with the fintech over, let's say, a period of time. They have understood our systems, what's required for us, what kind of information sharing can we do, what is the methodology we will do for that. So I would say not very different from India in that sense, because it is a mixed bag. It is something that I guess even global banks get, that it is something that this is the future, this is the way it needs to move forward. But I agree with Deepak that just like Kotak, most banks have a clear mandate as to what they want to do with the fintechs, right? So again, not very different from an India perspective. And globally, we are clear where we'll partner with fintechs and where we are comfortable that we know that space and that we can manage it ourselves.
Fantastic, very helpful. And I'm going to now actually switch gears to, we've looked at bank, we've looked at fintech. Let's actually come in between to the glue, which actually makes a lot of this work. You know, without this, everything is just two presentations. The thing that actually makes it work together is technology. And, you know, no one better than Vishy, you yourself, to speak about how some of these collaborations have worked. You've actually seen, you know, each one's looked at certain combinations, which is they are one side and, you know, they are looking at many banks, or a bank is looking at many partnerships. You've seen the many to many. So what do you think has worked well, not worked well? What are the learnings that you see?
Yeah, great. And in fact, to all the panelists, and in fact, Deepak alluded to, the fundamental thing what we're really looking at is, with fintechs and banks collaborating, is primarily client centricity, right? That's the first experience you're really giving to your clients or customers. And with that, what falls, which fuels that, is innovation, right? And what fuels innovation is fundamentally technology, right? With banks and fintechs, it's the great divide which used to be there, and slowly that divide or the gap is getting narrowed day by day and year by year. And that primarily gap is getting narrowed because of technology And what I would say is, in this era, we are fundamentally talking about a platform economy, right? You have a fundamental platform on which you're building services, either yourself as a banker or collaborating with a fintech, using the same technology or the democratization of the technology to build those services. Could be in various forms and shapes, and I'll give you a few examples as well. So it's fundamentally the platform economy, marrying the old versus the new, and thereby modernizing the whole landscape. The second piece is some of the innovations. In fact, the Honorable Governor also spoke today morning of the CBDC as well as one such big innovation which is creeping in, and that wouldn't have happened without technology being at the forefront, right? Be it in the form of blockchain or any other form and shape. Today we see AI, which is becoming pretty much pervasive, almost in everything and any operations which we do, right? It could be in terms of giving an instant loan from a bank, which used to take probably days or weeks earlier, and now it's become instant. That's where technology is in the background. The client doesn't see that technology, but experiences that, and that becomes the glue. Or for another example of payments, or for the example, lending management solutions. All of them where technology is the backbone, which really fuels it. CBDC is another example. And of course, you see a lot of other places which really come in modernizing these applications, right? From legacy to the new. How quickly, to the point what Shankar also mentioned, that how quickly can you, or to the point what Deepak said, that can we co-create with a fintech, and how quick that can be and deployed immediately, rather than the age-old era of building an app and developing it, brainstorming and doing testing it, UAT and all of that. Those days are gone. And that's where technology really is on that, putting this entire innovation and this collaboration on a super accelerated highway. And that's where IBM and the technology providers really come in.
Very interesting. And as we look at the future, because so far we've looked at experiences from a different angle. I think as we think about imperatives for the different players in the future, so we've looked at a certain maturity curve that has happened over the last few years, when partnerships happened, certain learnings happened. Now people have become clearer on what they want. People have also started to express that clarity in the relationships. Technology, of course, has helped in a way, it can be more API driven and people can have the connections much faster. But if you were to really think about the learnings from this, and if you were to accelerate the maturity going forward, are there certain imperatives that we look at from the fintech's perspective, from the bank's perspective, from a regulator? Some people say, should we just standardize a lot of these protocols? There are, players in between who are already trying to say, look, if there are, M banks and N fintechs, and, typically they would do M cross N connections, and I can become the player in between so that it's M plus N and not M cross N. Should it be players, or should the regulator itself talk about certain standard protocols so that the time to integrate is like crunched by whatever 80%? Are there certain things that you feel could be imperatives which will really help accelerate the maturity going forward? And maybe Deepak, we can start with you and then hear from the others.
So I would say that technology readiness is not an issue in today's context. It probably was 2-3 years back, but most banks, including like Samir said, or at Kotak, I think beyond whatever are the set of APIs that has been opened up through account aggregator, I think banks have gone and opened many more APIs. So as we speak, we have close to 390 APIs which are available on our API platform. Okay, so I think the core, and as more and more of tech modernization continues to happen within banks, we upgrade our systems, make it API ready, or moving a lot of our new infrastructure on cloud, so our ability to scale up and scale down depending on some of the partners and opportunities that we identify and pursue. I think all of that has started to happen, including the whole cloud-ready infrastructure on Kubernetes and containerizations and streaming of data. I would say 80 to 90% most banks have got that part right, at least those who are ahead of the curve, while others may be at different stages. So I don't see tech as a challenge as we speak. Having said that, I think there are 3 or 4 other areas of enablers. That is what everybody around is more concerned. One is on the whole data and privacy piece. Because as you open up, I think we all understand that the regulatory responsibility rests with a regulated entity, which in this case is bank. Also to ensure that both, even though the data privacy guidelines are yet to come, but I think banks have already started to follow a large part of it, not waiting for the regulation. So I think in terms of access to data, breach of data, what data is getting stored by a fintech or a partner in case if we do those handshake, that becomes one of the critical decision-making point when we do this. The second is largely on the security. Because as we open certain set of APIs, say payment, transfers, you want to enable certain functionalities, what if there is a breach on any of these? So while we can all harden our own environment and how this access happens, but then we start to look at ecosystem risk rather than just protecting our own four walls. So I think that again is one of the critical parameters. And I would say the other part is largely we touched in the earlier part is which business or business model do we see a relevance of going and partnering or co-creating or using even a technology, because a lot of fintechs, they come in to accelerate the growth for the firm. So typically we bring them as a point solution or as technology service provider. But there, whether these fintechs will continue to be in business for long becomes one of the key decision criteria, because you don't want a fintech which probably is unable to raise their next round of fund, and then you find that you have decided to build some critical component with that fintech, and then you are scouting around for an alternative very soon. So I think depending on this, each of these parameters, we have started to assign risk and criteria to see when we are looking at it, what are these criteria depending on what kind of partnership or opportunity are we pursuing, what if scenarios in each of these cases, and then how do you ensure if it's customer facing, for example, brand becomes important, what are your fiduciary responsibility becomes important. But if it's a technology service provider, it's the breach, the longevity of the technology service guy. A lot of these companies keep getting merged and acquired very often, and then you realize the acquiring company is not really committed to the business. So I think a lot of those risks are real, and we have all seen it happen in last 6 to 8 years. So I think keeping all of that in mind, constantly we keep working, and now even regulators have started asking banks to have a fintech governance framework and a policy. So it's not about some part of the bank deciding something which is in conflict with the other part of the firm. So I think as an organization, all of these things are now getting, I would say, into the granular level of operating and the governance framework apart from technology roadmap.
Got it. So it's not just about a cool, shiny thing anymore. There's a structure to the governance, and from a bank's perspective coming in, and I would say even the fintechs to be prepared that, you know, these are the questions which are going to come at me, and this frankly makes logical sense. So I also need to kind of evolve towards that. Samir, what's your perspective? Have you also seen similar imperatives going forward?
Yeah. So I think before imperative, I mean, imperative has to be towards something, right? So what's the objective function? So in my mind, the objective function is that financial penetration in India is very low. Take whichever metric, cards, loans, savings accounts is now very good, but any other metric, it's quite low. And the question really is that how do we get that penetration to a level which is comparable to, let's say, some other more developed countries? And hence, how do we expand the pie, right? It is nobody's case that Axis Bank should succeed or Kotak should succeed or some fintech should succeed. That's not the objective function at all, right? So if we take that in perspective, in my mind, if I go by player, there are a few. First, with fintechs, the 2 points I mentioned, which is being clear that to be sustainable, you have to be compliant. The compliance exists for a reason, and risk management exists for a reason. And if you want to build a sustainable business, you have to be you have to work in the borders of that. And second is figuring out the business model, because this, the example that I keep giving is that if there is 100 rupees of value and that has to be split 20-80 or 50-50 or whatever else, and if that works, then fine. But if there is 100 rupees of value and you need 120 for your business model to just succeed, then that doesn't work. And that I think is a very kind of important point from a fintech perspective. From a bank perspective, I would say agility. And we often confuse speed with agility. These are two very different things. Speed is how fast you can develop something. Agility is that, are you on the job and are you making progress daily? And are you kind of pushing the problem forward? So as Deepak said, tech, I think more or less there. Obviously, we need to do more. But agility is not something that comes naturally to us, honest confession. And we need to find a way to be more agile. We need to also have this mindset of how do we operate in a partnership, because in this ecosystem world, as Deepak mentioned, the risk can come from anywhere. It doesn't just come from your own perimeter. It can come from outside. And you need to have this mindset of saying that, look, yes, if we have to expand the pie, we need to have the partnership. But we also need to have hence the right mechanisms to ensure we keep risk in control or whatever else in control. So those are the two on the bank side. On the regulator side, I think, by the way, I think the government and the regulator in India have created something extraordinary in terms of the public digital infrastructure. Multiple things, right? UPI, Aadhaar, account aggregator, etc., etc. But there is a long way to go. So there is a lot of this quote-unquote standardized things that they can bring to bear, which they are working on, and I'm sure given that past track record, they'll do a great job of it. But that is one imperative. The other one I would say is to create a regulatory level playing field. Today there are multiple arbitrage opportunities where Deepak or I can't do a few things which someone else can do. And those need to be evened out so that there is a level playing field and we are able to kind of compete and in the right way. So that I think is the regulatory imperative in my mind.
Sabya, what about you? You particularly, while you've heard the bank's wish list of what are the kind of things, and then also from the fintechs and regulators' perspective, what would be your wish list?
Okay, so first on the fintechs, I think Deepak and Samir already alluded to that, but let me maybe specific few stuff. I think the first is the fintechs have to become a lot more transparent. I think some of the things which banks generally are used to is very, very transparent, documented approach, a process-oriented approach, and no ambiguity. So I think that has to come from fintechs as a process, not only just process, but even the entire business model that they make has to be a lot more transparent and kind of conducive to the overall ecosystem. So that's the first imperative for fintech. The next, I think, key point which at Perfios we have been believing from day zero is the InfoSec and compliance. I think you can't be in the business and serious stuff. Banking is all about risk and managing risk. You can't avoid the compliance and InfoSec requirements that comes from the banking community. So all the fintechs needs to be prepared about it. And I think of late, the regulators are only stressing about that point. So nothing new. It was always expected. It was the factor of time. But I think people who are prepared will deal with it much maturely than unprepared. The third is, I would say I would be personally very happy if actually, and coming back to your first question of collaboration, if banks and fintech actually come out or create a product or a solution together for underserved and unserved. We do a lot of talking about it, but I really don't see a product out there which actually addresses this in true sense. Yeah, we can claim victory with some small wins, but I don't feel that there is a product out there truly which is catering to the underserved and unserved. So that's something imperative, both on a fintech and banks, but yeah, that's one. Coming back to banks, I think they have done phenomenal work, as I said, in terms of giving the learning to the fintechs. But the time has come when, how do we create an environment for fintechs also to flourish and grow together is an imperative. Because is it about filling some gap, the question which I don't have an answer to, or is it actually creating a long-term value proposition for the end consumers of the banks or the fintechs? So if that question is answered, then I think truly the imperative for a bank will be taken care. And the third part on a bank is that the core systems for any bank, obviously legacy is done away with. We're seeing more microservices, API-based systems. So banks have come a long way on that. But now in terms of, and which Samir pointed out very correctly, is true change in the mindset. Because while the systems are being brought in, it's all about people in the bank, right? So everyone has to also openly accept and adopt to those, which requires a lot of change in the mindset in terms of whether it is an API-based system or a microservices-based core banking, right? So maybe the core banking completely moves to microservices because that's how everybody, the future is looking like. So are we prepared? So that's another thing. In terms of regulators, I think both regulators and if you call it the DFS have done phenomenal work. I think regulators are generally there to prevent accidents on the road when they create some regulation. We should look at it from that perspective. But it would be nice to see if, I mean, and they have done a great job in terms of innovation labs and multiple things, sandboxes. But what can be done to, as I said, promote the innovations to cater to the segments, not which are very lucrative, but to the underserved and unserved? Are we still going to operate in the same type of business model, credit model, the processes, or we break open from that and create a model which will actually address, otherwise it will be just a term financial inclusion. In what sense? Because it's all to do not just with getting, but also to extend credit. Now, is credit always the function of a particular entity or a particular entity within an ecosystem? The answer may be no. So we need to figure out, and regulators can pave the path there in terms of creating or allowing some kind of innovation which actually takes care of that concept.
Very interesting points, and I'm going to come back to one of your points earlier, which talked about bank and fintech and how they think about each other's roles, because in the North Star part, it almost makes you to think: is it that once is the role of fintech that fintechs push the boundaries and then the banks then do it, and then the fintechs move to the next thing, or is it in areas which are almost cut? So we're going to come to that, but maybe quick thoughts from Shankar as well as Vishy in terms of what other imperatives that you see.
Yeah, I think majority of the points have been covered, but again, I'll again bring a slightly foreign bank perspective into this discussion, from how we would look at it, right? So for us to collaborate with a fintech, the other aspect that one looks at is scale. I think Deepak alluded to it in some form about the financial status of the fintech, right? But for a bank like ours, which is across so many geographies, for me to consider opening up and working with a fintech, we would ideally like a fintech which plays in multiple markets as well, right? So that would surely be one of the preconditions for us to consider it, because while of course there will be specialized offerings, specialized products in a particular market, but for example, if I'm looking to work with a fintech for merchant acquisition, I would rather work with a fintech which is there at least in the Southeast Asian markets, right? Not just an Indian player and I then have a tie-up in India and then I've got 5 other tie-ups in each of the geographies that I'm present. So that would surely be a play, or at least a connect that we would look at when we are considering opening up or partnering with somebody. So while, as I said, all the other points were adequately covered in terms of what would be expected, but for us as a global bank, that would surely be one of the criteria as well that we would look at.
Very interesting. And even for fintechs who are looking at, let's say, partnering across markets, then actually it's not just compliance in one, but you have to think through multiple.
So some of the imperatives, more of them covered, but fundamentally what we're trying to solve is both two elements. One is, especially in a perspective from an India landscape standpoint, it's scale and speed, right? Fintech do really get that speed element coming in there in terms of advancements of what they bring on the table. But scale is one of the another big imperative, because for banks of this size, be Deepak Kotak or Axis or any other banks in India, we're talking about scale in India. And to the point what Sabya mentioned, the unserved or underutilized people, right? I think so that's very important as well. The second piece is from a fintech standpoint, what we're really looking at is how do you embed technologies into your own portfolio, right? How do you adopt the latest generation? Could be an AI, could be microservices architecture, could be any of those which would really come in. And from a bank's perspective, obviously, how do you modernize the legacy, right? You are still going to carry a good amount of that legacy. How do you modernize that, and how do you kind of marry that to the fintech's new age world? That's equally important, keeping very important aspect in mind of the regulatory compliances which you need to govern, especially on security and especially on data privacy as well. Because as and when we are going to the platform economy and opening up more and more APIs, the exposure or the aperture of the cyber breaches are going to be even more enhanced, right? And that's going to be very, very critical in that sense as an imperative for privacy of the data as well as security. From a tech provider standpoint, the basic imperatives are how do you kind of look at 4 broad pivots. One is, it could be in the form of analytics and data of AI, and which is where as a tech provider, as IBM, what we have done with the fintech world is recently announced something called as embedding a technology in your fintech or in your application or whatever you develop, is embedding an AI into it. We just announced a couple of the libraries like speech to text, text to speech, natural language processing, some of that. Why do you want to build it when the tech provider is already providing it and you could embed it? So you could have a faster go-to market and collaborate much more efficiently with speed. The second is, of course, automating. And this goes without saying, we automate, and just not process automation, but actually building in intelligent automation. We have done this for one of the large private sector banks in India as well. How did we automate a lot of these APIs in some of the trade finance operations and treasury operations? That's another one. And third, of course, is security I spoke about, and fourth is modernizing the legacy. I think these 4 pivots around the AI, automate, secure, and modernize would be broadly the imperatives which we go at the foundational level, doing it at scale and with speed. That's what I would say.
And also for different categories of players, right? Because as Deepak highlighted initially, some banks would have already gone at and fintechs would have already be at a much higher maturity, whereas in many you would still need to, go up that curve. So how do you bring that going forward? Maybe just moving to the last question, in the interest of time, and this is while we've, imagined to say what are the things we can do, what do you think should really be the North Star? And Samir, you started to talk about it, in terms of inclusion, or, what would really be, something which we would be proud of, that we've really got the most juice out of the, bank and fintech collaboration, and we've been able to reach the pinnacle. Is it about that, it is truly speed dating, that, people come, meet, and, within, X amount of days we are integrated? Is it about in areas like, came up earlier, that in areas where today no one has been able to make headway individually, but together we can really solve a lot of problems which were, unsolved earlier, or make significant headway in those directions? So what do you think would be the North Star of, bank and fintech collaboration? And maybe let's start this way, this time, so just to get, different perspectives.
Okay, so that's just 2 words, I would say. Let me put it really succinctly, right? SBI YONO, right? So that's a classic example of the North Star for us in terms of really embracing, and we know SBI and the applications and the environment they are. SBI YONO really kind of transformed with its universal app and the whole plethora of services. I think that's the North Star for bank and fintech, I would put it.
For me, I guess it would surely be speed of conversion and agility. I think we spoke about both those points. For a bank like ours, and I think Vishy alluded to it, a lot of legacy systems, a lot of legacy core banking platforms, old systems, for us to be able to pick and choose, not very different from the marketplace that you just talked about initially, to be able to pick and choose, have that ability to just get it up and running quickly would be extremely relevant. So yeah, absolutely. One day when we get there, we'll be happy about it.
I was joking with Vishy because when I was reading about the marketplace, it's actually about a community which has been existing for 10 years. And then they just decided earlier in the year to bring this marketplace. And I was thinking, FIBAC's been around for 10 years as well. This is exactly the type of community. So Vishy, why don't you just build it? And then I think we'll have a lot going. Deepak, thoughts from you?
I would say, how do we marry the speed of insurgent and scale of incumbent? So fintechs definitely bring in that speed because they are trying to break in and change and redefine a lot, but they definitely lack the scale that the banks already have. But banks obviously lack that speed to make that change happen. It would be marrying the best of both worlds, where the speed and scale can work together to redefine how we can serve the billion users who are still out of the formal financial service in India.
So I kind of go back to this objective function point, right? That at the end of the day, let's say 10 years from now, when we look back at this question, I think the only metrics that will count are how much did we expand the pie, how much did we jointly grow the universe, and what did we do differently that we were not doing earlier. So for me, the North Star would be that, as an example, let's say 30% of our incremental revenues comes from a partnership, right? And by the way, in a way where we are kind of doing well, the partner is doing well, and we are serving a customer in a completely different way that we were not earlier doing so. So to me, that is a critical one, and I think we have to take a long-term view to this and not just a 6-8 months view.
Thanks, Amit. For me, I think two. One, I already specified in the earlier question, that is, how do we create solutions jointly for the underserved and unserved. But leaving aside that, all the four stakeholders that you mentioned, the fintechs, the banks, the regulator, technology companies, how can we work together to do away with paper irrespective of segments? As of now, do away with paper is by very select segments. You can blame it to the risk teams in the bank, the regulators, the compliance, the mindset, the people, the complexity. You can blame anyone. But the point is, are we really working towards doing away with irrespective of the segment? Now, anybody, the corporate bankers in the room would completely say, what are you saying? It's not possible. But are we really thinking? Because you are saying on the liability side, a lot more digitization has happened. If that has happened, and the tax authorities are completely moving to digital, is it not that finally your solutions or offerings will be without paper? Now, obviously, it requires regulatory blessings as well in a lot of perspective, and one such step is CBDC maybe. In a long run, it will maybe show what the true colors are. But what I'm trying to say is the true North Star will be making or giving that experience to the end consumer, which is completely seamless and frictionless, without asking for tons of documents that we today ask, just because of the simple design and the risk elements to it. Can we do?
Why not? And I'm sure when people conceptualize UPI, you could really think how this would work. And today, you go to any corner and you can pay. And I think many people in the world, and we actually studied this, feel that this is actually one of the most advanced payment systems that we've seen. So yeah, let's see, 5 years down the line, hopefully we should see some of those objectives realized. We have time for maybe one question from the audience, which we can take. Gentleman over there, do we have a mic?
I don't know if it was by accident. We started the discussion with Sabya dating the bankers, and Deepak closed it by saying, by concluding it with a marriage. From the perspective of alternate data, that fintechs are bringing in for decision making, while you spoke of, various stakeholders, regulator being one of them, and the financials are playing a very crucial role in banks' credit decisioning especially. So why is there no thought process in terms of digitizing the financials for the commercial organizations? Second would be for Sabya. While we spoke about profit sharing, is there risk sharing also being owned from the fintech perspective?
I think for the panel as a whole.
Okay. So, see, on the commercial side, as I said, I mean, all the four stakeholders has to play its part. And if I understood the question correctly, is that while a lot is happening on the retail, why commercial is not seeing that kind of traction, which ideally on the digital space it should see. One, as I said, one is overall as an ecosystem, are we ready or are we aligned in terms of the risk or the policy changes that it requires to support the commercial banking on the digital front? I think a lot has happened post UPI and QR. You are seeing a lot of micro enterprises, and I was reading some report. It's crazy numbers which you see who are on QR code, right? But they are not registered under MSMEs. So can we take a look at the policy and change something which has not been thought about? So I am not sure, is it the right time right now? But definitely there should be a forum which should debate on this, which includes all the four stakeholders which Neetu mentioned. If that happens, I think we are on the right track in terms of making commercial banking truly digital as well. But it has to start from someone taking that step. As a tech fin, we are definitely trying our best to come out with more products and solutions which at least starts the journey of digitizing on the commercial side. But maybe some more consultation with the banks and regulators will help to bring it to closure. That's on the first question. The second part is, I think you said, how do we manage the profitability, right? That's what he was asking. See, as I said, profitability is a factor of value creation. Any organization, it has nothing to do with fintech or a bank or manufacturing concern or an FMCG or anyone. If you are able to create a value for your consumers and they see value over a period, it cannot be without profitability, right? And I think a lot in the news is funding winters. It is nothing but basic principles of accounting, right? No organization can run without profitability being in place. So I think it's just stressing upon, again, that fundamentals, which is, do you have the right product, right solution, right product for your consumers so that you can run a profitable organization. So that's how I would say, and in this partnership, whether it is bank or fintech, I think it's time where both appreciates that the value that a fintech brings, and the fintech also appreciates. And I started with the point that the curation of learning that we have seen in our own journey, it has been a journey from the banks, and Deepak is here, we started way back with Kotak. There is immense amount of learnings that we have had, and which has improved our product offerings as well. So it is both benefiting, and hence you see a lot of profitability eventually kicking in. That's what I would say.
I'll just add 2 bits to, I think, this. From bank side, see, when we work, banks and fintechs have very different objectives at times when they get into a partnership. Banks play quarter to quarter, banks have to look at NPAs, there are certain risks parameters that banks have to work on. So it's when the marriages are between 2 different set of firms with very different expectations and goalposts. The meeting point on that doesn't happen easily, right? So fintechs are in a valuation game while banks are looking at the profit. Fintechs have a risk capital, banks have a risk averse or risk management practice. I can give you many such examples within that. So the question is, are there common points which you think can still get this whole engagement working? And that's why while we were saying tech was the easier part, a lot more is about various other components, understanding the risk and regulation, what kind of capital, what kind of, you may call it FLDGs and all those models used to work. But then first loss you will guarantee, but who will eventually go and collect the money? Banks think that they have a better way of collecting the money. So I think a lot of those still, I would say, are things that can be discussed in a much smaller group. However, coming to your commercial bank piece, I would say a lot has already started to happen. Okay, I think thanks to the GST, apart from that, a lot of data today is available, and thanks to the Open Credit Network, Open already lending on the GST through GEM Sahay has started. The GST based lending will start. We were in fact the first bank to start giving the real-time credit decision and lending on Open platform. Many banks will join in a phased manner. I think the trade and cash management already is largely building a strong digital footprint. I think banks have joined hand together now to build the IBBC, which is a blockchain infrastructure company. The idea again there is to look at how you can do the not just real-time bill discounting, but supply chain finance, inventory management, paying to your vendors. And I think some of those new products will start getting created. And then the last of it, I think, which is already matured, is the whole accounting and banking reconciliation through Tally plugins, and Zoho and all has already started to bring in small businesses and mid-sized business into the fold of digital. And like Sabya was saying, thanks to the whole digital payment footprint, as that is getting more and more robust, you will start building a far better digital, I would say, library of all the things that enterprises and small businesses do. And as they start seeing the value of that through access to credit, be it a short term or probably on invoicing, there'll be even more, I would say, pull from the entities to go digital rather than the enablers of digital.
Thank you so much, Deepak, and to the entire panel. I think we were able to bring a lot of layers of complexity to that 13-letter simple word of collaboration. And hopefully you also had a good time. And thanks to everyone.
Ma'am, a quick photograph. Thanks indeed to the distinguished panelists for providing their insights on the topic. Thank you. Ladies and gentlemen, I request you to kindly occupy your seats. So I'll announce. Ladies and gentlemen, my humble request, if you can kindly clear the dais area. All the panelists. Ladies and gentlemen, we now come to the fifth session, which is the panel discussion on Cloud Native Architecture, the challenges and hacks in pursuit of the Holy Grail. We have with us the panel of speakers whom I invite. Ms. Vidya Krishnan, DMD and CIO, State Bank of India. Mr. Avinash Raghavendra, President and CIO, Axis Bank. Mr. Rishi Arora, Senior Partner, ISA, FSS, Sector Leader, and APAC, Core Banking and Payment Leader, IBM Consulting. Mr. V. Sundaram, Director, Business Migrations and Digital Inclusion, Amazon Web Services. Mr. Sudhir Keshwan, Senior Vice President, Cloud Transformation, Wipro. And our moderator for the session, Mr. Vipin, Partner, BCG. May I request Mr. Vipin to initiate the panel discussions? Over to you, Mr. Vipin.
Hello. Thank you. Good evening, everyone. Am I audible? Okay. Okay. So first of all, a warm welcome to everyone to the FIBAC. And thank you so much for taking time out to join this panel discussion on cloud architecture. Today, we were just discussing outside. Yesterday, there was a news report that UPI hit 7 billion transactions last month. And that's the kind of digital adoption we are seeing in India. And the kind of stress that puts on our technology architecture or tech architecture is quite heavy. And in that context, this topic, which is cloud native architecture, a holy grail towards achieving some of these or fixing some of these challenges, becomes very, very relevant, right? And I know it's the second last session of the day, and I'm sure all of you have been sitting through multiple sessions through the day, but we have an esteemed set of panelists here. I'm sure we'll try to keep it as engaging as possible, so and hope you'll find it useful. With that, I intended to introduce the panel, but I think the organizer has already done it, so I don't want to do that again, but let me move ahead. So, over the last, if you look at India or even globally, over the last few years, we have seen a digital explosion in almost all aspects of life. And financial services is not any different, right? We have seen whether it be UPI in payments, digital lending, insurance, across the board, we are seeing a huge or significant growth in adoption of digital technologies, right? And what this has led to is basically making the life of CIOs really tough, I would say. And if you look at the page here, I just put down some of the discussions I had with various CIOs over the last few years. They are in a very, very tough spot right now. And on one front, you have business and customers who are expecting Amazon or a Swiggy kind of experience in every transaction they do. On the other side, they have multiple challenges in terms of talent, in terms of legacy architecture, in terms of cost pressure, and so on and so forth. In all this context, if I look at all these challenges, I think the most important one of the lot is the legacy architecture in which most of the financial institutions in India operate. If you look at the left-hand side, it's the left-hand side of the slide. This is what pretty much the architecture of many financial institutions in India look like today. You have a core which is largely monolithic, very, very legacy, very old systems which are not scalable. On top of that, you have a mesh kind of architecture where you have connections going from different systems to each other, which makes the entire systems very, very, very complex and not scalable. Now, the impact of this is, if you look from a business perspective, is high time to market. In today's market where the customers are expecting new products to be released every 15 days or every 1 month, it becomes really almost impossible to do that. Second is, like the UPI example, when you have 7 billion transactions, the downtime goes up, the transaction failures happen. Then in terms of innovation, if you have to innovate and make very, very more flexible products, etc., it becomes a big, big challenge. In this context, I think at least
when we discuss with many of the CIOs and many of the technocrats, everybody keeps talking about cloud native architecture being the holy grail to surpass most of these challenges. Now, while that is pretty much accepted by everybody, but I still want to hear from, I want to bring in two of our panelists, Ms. Vidya as well as Rishi, one from a bank perspective and one from a tech partner perspective, in terms of whether they feel or in their experience has or adopting a cloud native architecture is the holy grail, or will that help us solve all the problems or many of the problems which we discussed in the previous page? Over to you, Ms. Vidya.
Good evening, and thank you very much for having me here. Is cloud migration a holy grail? There are certainly numerous benefits of actually going on cloud. The kind of elasticity, the kind of flexibility, the kind of scale, the kind of resilience that you could get on the cloud. Also the fact that it could make your investments in physical infrastructure could be rationalized. So certainly there are benefits, and there's a lot of narrative also happening around the fact that one must migrate to the cloud. But I think one also must be very mindful of the challenges that one could face and how to surmount them. First of all, which are the applications that one should move on the cloud? What are the kind of regulations and how do we actually adhere to them? And this also brings in requirement of a new set of tools, and both as far as development is concerned as well as on the monitoring front. Another very important consideration is the economics, the cloud economics, and one needs to have an extremely deep understanding of this whole thing. And these are all very important considerations before we actually set out on a cloud native architecture. Having said that, as far as our bank is concerned, we do have our private cloud, that's Meghdut. And yes, we would like to work on a principle of cloud first and a strategy around a hybrid cloud. But these are very important considerations, and one must take all this into account. We need to have the right skills, the right resources. This is something that's I think the whole industry is working towards. So is it a holy grail if we get all this right? Yes. And and we are in a very disruptive space where technology keeps reinventing itself, and so much of innovations. Well, one thing is certain, that the devil is certainly in the details.
Thank you, Madam, on this. Let me go to Rishi now. Rishi, in your current role as well as even the prior roles, I'm sure you have supported many financial institutions in transforming their architecture into a cloud native kind of setup. So in your experience, have they been able to solve many of these challenges and derive value out of doing this?
Thank you, Vipin, for having me here, and great being with my fellow panelists. You know, if I look at banks, right, before I talk about the cloud native architecture, if I look at banks, what banks were doing, say, go back 10, 15 years back, and what the banks are doing now. I think the products and services the banks offering us today are far more and far enhanced than what they were offering us maybe 10 years back. Banks are truly playing a role in everyday life of their customers. With this consideration, right, why cloud native architecture becomes relevant or important. First, let me talk about the parameters, right? Basically, what are these considerations? Why will, how will you move to a cloud native architecture? Modularization, I think, is very important, right? Separation of concerns or issues per se is very important. I spoke about banks playing a role in everyday life. So APIs become, very important. Managing varying loads become very important. Vidya ma'am already spoke about the benefits. I don't think any one of us would have a debate on the benefits which cloud native architectures would provide us. Benefits around turnaround time, agility, benefits around security, benefits around maintainability, availability. Those benefits, I think all of us acknowledge. But most important is also, how will you move from your current architecture to a cloud native architecture? The process has to be gradual. The process cannot be overnight, right? You need to think through it application by application, right? So, you need to think through basically coexistence at, over periods of time. So, like I said, the process has to be pretty gradual. I would want to summarize by saying, I don't think it is about, wait and watch anymore. I think all the organizations, all the banks will think about getting started on this journey. But like Vidya ma'am rightly said, the return of investment or the business cases, which journeys should go first, whether inward facing or client facing, which loads should move to cloud native architectures, whether, loads which are static or loads which are fluctuating, right? So there are many considerations, on how do you adopt to cloud native architectures. One thing which is pretty important is in our experience, in IBM's experience with the clients who we have worked with in India and outside, right? I think if you have the exec sponsorship, those programs would be more successful. Moving to cloud native architectures is not only a tech initiative, it is a mindset, it is a culture change within the bank. So is it the holy grail of success? I think if you can get all of this together, yes, it can definitely be a holy grail of success. Thank you.
Yeah, thank you, Rishi, for sharing that. I think you brought up an important point in terms of the approach part of it, right? So like you rightly said, whenever I had conversations with anybody from tech side on this, nobody has disagreed saying that whether there's a right answer. Everybody says there's a right answer. But the debate has always been that where do we start? We are like we were discussing outside, it's a bullet train which is going. How do I repair a bullet train while it's moving, right? So the approach becomes very, very important. So with that, let me bring in Avinash. Avinash, the question to you is, what should be the approach while a bank like yours start thinking about moving towards, or starting a journey towards a cloud native architecture? Should we be thinking about a big bang approach where we move the core plus all enterprise apps plus everything into a cloud kind of an environment, or should it be done in a phased manner, or we take a call saying that, okay, I don't want to move any of my core right now, I'll only do my new age digital assets alone. So what should be the approach in your view?
Thank you, Vipin, and good evening to everybody out here. Back to the question. See, there's no one-size-fit-all kind of a strategy. I mean, to the points which Vidya and Rishi sort of so eloquently made, there is a bit of a culture aspect to it as well, which needs to be considered. And one should also be assessing in terms of, what is the kind of talent, what is the kind of framework that we internally essentially have. Now, coming to access, I mean, our cloud story sort of started a couple of years ago. As it happens, we were amongst the first in the BFSI segment to sign up with both Azure as well as AWS when they opened up their India setups. So the fact that, okay, cloud is the direction to go was known to us. What has also emerged over this last couple of years of experience with cloud is the fact that I don't think for a bank of our size, or maybe even a similar bank, a big bang approach is likely to work. We will actually have to go phase by phase. We will actually have to identify the areas that we want to take to the cloud. And more often than not, I think the choices are veering around to, the layers around customer engagement, the layers around integrations, the layers around data. These are the ones which are good fit in terms of cloud. Then of course you have the entire world of, the system of records, the product processors. Now that is a difficult area to crack. And that is why I basically said that a big bang approach is unlikely to sort of work over here. I mean, we'll have to actually pick and choose. The cloud economics part of it, I mean, we were just discussing outside. Okay, I mean, we are the consumer over here, so that becomes a very key factor in terms of, which application do we want to take to the cloud. So, so for us, I mean, yes, this is where we want to go, but it's going to be a gradual kind of a process. I mean, what I see is that over the next 3-4 years, obviously there is going to be a bit of a shift. I mean, right now you could say that, okay, we are on-prem heavy. We will probably be cloud heavy in the next 3 years or so.
Thank you, Avinash. Now let me go to Sudhir. Sudhir, you lead the cloud transformation business for Wipro. I'm sure you advise many of the clients in India as well as outside India in terms of how should they think about transformation, right? So in your basis, your experience, what's your advice or what's your perspective in terms of how should they think about, how should financial institutions think about a transformation like this?
Yeah, thanks. And good evening to you all, and I'm really proud to be part of this panel. The way I think about it is, I leave Big Bang to the universe. I think really Big Bang is best left to the universe because it has a lot of connotations. Having said that, there also is a tendency to look for the how, a templatized how. And what I have discovered is it is more important to not just look for best practices, but the things that will fail you. Because there is a consistency in what fails financial institutions. And that's extremely useful for somebody who's starting the journey now. So, for example, if you look at the stack, the data assets have to be federated. They have to be where the decision is going to be taken, right? So you need to have an architectural approach towards federation of data. If you look at, do you need to hollow the code? The answer is probably yes, but how do you do simplification? And there is methodology now that you start from the customer journey, you think through your API strategy and work backwards from there, right? And working backwards from the customer journey, defining your API strategy there actually hastens your simplification. If you look at the traditional APR strategy, that used to start inward out. And now you're starting outside in, and that helps you with simplification. If you go further down this track, you look at core transformation. But within core itself, there is differentiating and non-differentiating, right? So if you look at non-differentiating but core, for example, CRM, for example, you look at risk engines, you look at payments, you're already seeing all of them being SaaSified. In fact, we were working with a bank recently, and we did an inventory for them, 300 unique contracts which are SaaS contracts, right? So there is this non-differentiating core that is already getting SaaSified or moving towards the cloud-native world. And every part of the stack, from the data, from the customer journey, to the API strategy, to the non-differentiating core, I think there are emerging patterns of what needs to be done and what doesn't need to be done. That is very helpful. Now, just one other aspect, I was discussing outside that, when you talk about India, you need to talk about continent scale in a single regulatory environment. So you have the advantage of a single regulatory environment at continent scale. And there, the decision criteria has changed because, cloud economics becomes a challenge. You have to be very conscious about what cloud economics would be, what the architecture would determine on cloud economics. The other aspect that you need to be very cautious about is the micro-segmentation of needs, the societal responsibility of what you are as a financial institution. The one aspect that is beneficial is you can be gradual in this change, right? Because financial institutions are enduring organizations. We all want them to endure. And unlike disruption that you would see in, say, media or gaming, the other early adopters of technology, financial institutions have the advantage of being enduring. And therefore, that can play to their advantage as they take their journey. So, I think there are very good patterns out there of what works and what does not work. And thinking that through, for financial institutions is what I see as being the successful strategy.
Thank you, Sudhir. Let me bring up a couple of slides and just showcase in terms of how globally companies have taken up the cloud, or how global companies have basically adopted digital native architecture, right, or a cloud native architecture, right. So what you see on the left-hand side is, if you look at digital, we did a survey with a fairly large sample of companies globally, and we classified companies into two categories, which are digital leaders and digital laggards, right. And if you look at digital leaders who are done well on the digital side, at least 64% of them had a cloud native kind of architecture. Whereas if you look at on the digital laggards, only 3% of them had it. And obviously it's a continuum, it's not like yes or a black or white. But the point is, there is a significant difference in terms of performance or benefits which, or the companies have performed where they were adopted a cloud native architecture versus a traditional architecture. And most of them, based on our experience, have got significant benefits, both in terms of tech benefits as well as from a business term perspective, right? From a tech perspective, lower infrastructure cost, and in terms of productivity of the development teams, etc. And secondly, in terms of business teams, much faster go-to-market, almost close to zero downtime during month ends and peak loads, etc., and so on and so forth, right? Now, obviously, there are, I'm sure many of you will disagree with me when I say lower infrastructure cost, because it comes with a lot of ifs and buts. But the point is, if you do it correctly or do it the right way, then there is definite improvement or benefits you can reap from this migration, right? Now, coming to, I think all of us agree that this is a way to go, and we also discussed that what could be a potential approach for us to take up this journey. Now, what I want to spend some time is on the challenges. It's easy said and done, because all of us were discussing outside. It's easy to say that, okay, move to a new architecture, etc. But I just wanted to understand from, maybe start with Sundar, from being a leading cloud provider globally, how do you see, or what are some of the challenges you see while banks or even financial institutions have taken up similar journeys?
Yeah. Let me so the last 5-6 years I've been working with a bunch of financial services institutions in similar projects. And I think what we have seen, which kind of differentiates those who are successful from those who have not been successful, if I look at that, the ones who have not been successful, they've typically taken a knee-jerk reaction. Some CXO lands up in a conference like this, hears what somebody else did, they go up and beat up on their CIO, so the CIO quickly does some patchwork stuff. It works for 3 months, 6 months, but after that, things start to give away, because these new applications need to be integrated back to the existing applications. They don't scale. You have security challenges. You want to bring the data together for a customer 360. These are the areas where it tends to fail. But the ones who succeed, they typically take a step back first and look at how do they want to approach this. Right? There are two broad approaches we have seen working. One is where people slowly start squeezing out the core and taking out component at a time and moving it into a cloud native architecture. People like, for example, Vanguard in the US, they've taken that approach, people like Capital One and so on. And then there are others, like in India, Bajaj Finserv Direct, who have done, where they have stood up a complete digital architecture on the side, wherein they move all their new businesses while the existing business continues on that core, which eventually will get modernized in its own pattern. So these are these two broad patterns that we have seen. I think first is therefore to understand for a given company, which pattern is going to work better. I think Avinash made the point about one size doesn't fit all. So first of all, the first challenge I would say is, first of all, be clear in your mental model about how you want to approach this. That's number one. And number two, when people go out and start this kind of activity, typically what we see, especially when they're doing it on cloud, is they often underestimate the challenges in terms of governance subsequently, whether it be architectural governance, whether it's security governance, cost governance, or operational governance. 4 areas of governance where we have seen people struggle. And cost is possibly the one that hits them the hardest because it hits fast. Because you just switch on some instances and leave it on, where the very next month your CFO is going to be asking you, what the hell, where did this bill come from? Some of these other challenges you might face 6 months, a year down the line, the other 3 architectural challenges, but this one, it's almost on day one you're going to start facing it. So being prepared in advance, understanding what it's going to entail, and therefore putting in place the right relevant people, etc. I was speaking to the CIO of a very large insurer who told me for the first time now they've accepted that they have to set up a tech governance board, and they've actually got an SVP level person to head that function. And the third area where I would look at the challenges is, and I think it was there on your slide, the people aspect. I think we've pretty much struggled on two fronts. One, how do we get the people who are already there to see how cloud is going to help their careers and therefore is not going to be a threat to them? And for the people who do come in relatively new, who are trained, who are better at this, how do we retain them? Both of those have been enormous challenges. I won't claim that there is one solution which fits all of these, but these are three areas that you want to deeply think about as a company if you're going to go down this path.
Thank you, Sundar. So, Madam, I'll come back to you. SBI has one of the most complex, or is one of the most complex financial institutions in India, considering your scale, the kind of subsidiaries you have, etc., right? From your perspective, when you think about, or if you were to take up a, let's say, a migration like this, what are some of the challenges you foresee? Other than, I think Sundar covered a couple of points, but anything else which comes to your mind?
Yeah, sure. I mean, you did start by saying no one size fits all. So certainly we have a different set of challenges that we have to deal with. Though we were the first to have our own private cloud, that is Meghdoot, we have around 400 applications on this private cloud. Yet to actually get all of them, cloud native, there's a lot of preparatory exercise that needs to be done. Also, we do around, per day, we do something over 450 million transactions per day, with most of them hitting core. So, so preparing the core also is a huge activity. So the front end of it, the back end, what do we do with an HP Unix that may not be compatible? So these are the decisions that we need to take. So we also have a very vibrant and enterprise and technology architecture group, which tries to see assesses the need and the impact as well as the economics while we migrate onto the cloud. And then there is the resources that we need to put in. So, and as Sundar rightly said, you actually need two sets of resources, because it's not that all applications can be migrated. It certainly could not be a lift and shift kind of a mechanism. It has to be well thought out, well understood, and well calibrated. So we need two sets of resources, and we need to get the right alignments between them. We also need to ensure that the skills are abundantly available post the migration, especially for understanding, like how cloud operations happen, as well as to manage failovers. So these are the things, and I'm sure, we will stick to that cloud first and the hybrid cloud strategy. And these are the things that we would largely look at.
Thank you, Madam. Madam, I just want to deep dive on the first point you mentioned, which is about a legacy architecture. So maybe if you can bring up the slide. I think broadly, there are, and I think Sundar touched upon part of it, but let me lay out what are some of the options or some of the different strategies people have followed, right? There is one which is about hollowing or leaning the core, wherein you basically reduce your dependence on the core itself. You basically take out all the business logic, use it purely as a ledger. That's the way many of the banks have been at least going towards. That's option number one. The second option is thinking about replacing or upgrading the core itself, right? And within that, there are multiple options. One is the big bang, which all of us said might be killing ourselves pretty much. And beyond that, I think there are two other options or two other models we have seen globally. One is a migration challenger kind of a concept, I think, which is what Sundar was partly talking about, wherein you set up a parallel architecture with a small business or a small geography, where depending on what's the right fit, and then build it gradually. And once that is successful, then you move the entire business to the new architecture. The second model which you have seen is, or many people tried out, is a standalone challenger model, wherein you say, I don't want to touch the core, let it remain as it is, let the traditional businesses continue to run there, but the new digital products or digital solutions, etc., you move to a new core, and which runs in parallel, let's say, forever, right? Now, these are different options which are available, and obviously there are pros and cons for each of them. I think the first question or the first debate I want to have here is, while many banks in India and globally are preferring following the core kind of a concept, considering the rapid change or rapid amount of innovation which is happening, is this a sustainable answer? How long? See, because at some point of time, because these are all COTS products which have certain constraints. Beyond a point, you can't take things out. So at some point of time, this is going to stop. There is going to be a limit to this, right? So is this a sustainable answer, considering, let's say, if I keep at 5 to 10 year kind of horizon? So maybe I can start with Rishi, maybe, and then we can go to to Avinash and maybe Vidya as well.
Sure. So, you spoke about, hollowing the core, right, or core modernization. We use this terminology very often. But what is this, right? See, if you again go back to, and if I talk about our country, if you go back to late 90s, early 2000s, right, that time the core banking systems were being built, right? You were actually migrating from branch banking to core banking systems. And at that point of time, majority of the banking processes were put in your core banking system. Why? Probably because at that point of time, like I said, there was already a huge transformation happening from branch banking to core banking, and the knowledge around the alternatives which were available, about 2 decades back was not, was not there, right? So what has kind of kicked off this discussion of hollowing the core? I think the advent of big techs or fintechs, right? The systems which can probably do things better than what the core systems can do. I think that's what has, I would say, changed the architecture of the way banks are looking at their, systems, looking at their systems today. So what are the benefits? If I can just talk about, and I will talk about the challenges as well. But first, let me just talk about the benefits, right? If a particular system or solution is far suited, functionally more richer, lower cost, right? Can you have that outside of your core? So the concept of, best of breed, best of breed solutions, right? You don't need to have everything hitting your core. So use best of breed solution. That's a benefit which you can look at. Again, look at, varying loads, right? Sometimes, the loads, like I said before, sometimes are static, sometimes are varying. So, can you move these varying loads, outside of your core systems, so that they can be, managed better. So these are some of the benefits. But the big challenges of truly embarking on this journey, one is, and I was discussing this with my fellow panelists just before this session, is about localizations. The amount of localization which is required, right? And at the pace which is required, I think this poses a big challenge. The second challenge which I would again put forth is, what should you move out, what should you keep in your core, is around, again, a return of investments. You cannot just say, okay, I will put everything outside of my core. I think there has to be enough and more time spent in terms of, analyzing these business benefits, right? So, hollowing the core, I think definitely will, embarking on a journey to hollow the core, I think will make your architecture more, more cloud native for sure. But according to me, it is a journey. According to me, customer-facing systems which, which require faster turnaround times. For example, CRM systems right from marketing to onboarding to servicing, right? I think your customer management systems, I have seen organizations embark on that journey, having the customer management or product management outside of your core. So, it's all about picking use cases, picking systems which will give the business a return to you, as long as the challenges which I spoke about can be met, and localizations and return of investments are big challenges which need a whole lot of consideration before you can embark on this.
Yeah, thank you. Avinash, maybe let me bring you in. I think two questions for you. One is, I'm sure Axis Bank at some level would have started a journey towards taking things out from the core itself. So first question to you is, do you believe that this is going to be a long-term answer, or at some point of time you believe that you might need to think about replacing the core? That's question number one. Second is, we were discussing outside, right? When you look at a 7 billion kind of transaction, the amount of stress it's going to put on your core is quite high. So how do you manage this kind of volumes at this point of time?
So first thing is, at this point of time, if you were to ask me to replace the core, and I'm speaking, wearing the consumer hat, I don't think any banker is going to say that, okay, that is a journey that we want to embark. Let's talk about some very obvious things, right? We are in the business of banking. We need to serve the customer, in a very seamless kind of a manner. And we can take global examples over here. Core banking replacements, or for that matter, any core system replacements are multi-year projects, a lot of risks. And especially if you look at the MNC banks, you will essentially find that all of them are saddled with a whole bunch of legacy systems. There's a reason for that. They run into risks. What looks great on a whiteboard, what looks great when you are planning for the same. When it comes to execution, you get down to the nitty-gritties, and then you realize the fact that, okay, it's not so easy. What is the way out over here? You can't rewrite the codes, right? You can't refactor them. If you get into that kind of a journey, it is definitely not something which is going to get done in next couple of years. We will probably be looking at least 5-7 years, and to the point that you were making, regulations are changing, technology is changing, the options out there are changing very, very fast. Okay. So do you really want to be investing into that kind of a journey? The answer, at least at Axis, and what intrinsically, personally, I feel over here is that no, we can't go that particular path. The natural solution to that is, what is called as hollowing out the core, which in the world of microservices is nothing but the strangler theory, where you basically identify a functionality which is useful, overstressed in the current ecosystem. You basically try to bring those components out and run it as such. It starts with one, take the next, and so on and so forth. Hopefully a few years down the line you will essentially see that, okay, what is there in the core is only those areas that you really want them to run over there. Okay. Or maybe you may end up reaching a particular situation where you can may take a considered call that, okay, should we now start discussing a replacement? Okay, if at all. Now, that is the kind of an approach. Interesting that you spoke about UPI. What did at Axis we do about UPI, right? We were also sort of realizing the fact that, okay, I'm trying to send out the SMS from the same core engine. I'm trying to validate all my UPI transactions, etc. So the pass-through transactions, what we decided was that, okay, we will take it out of the core. We will basically, create another engine and keep it over there. And it is only the end of the GL transfers which will sort of, get synced with the core itself. So we didn't call it hollow the core, but effectively that is what we have actually done. And there are umpteen such examples. Just very recently we used to send SMSs out of core banking. We have moved it out. Okay. So this is a journey. It will keep on happening. Are there options out there in the product processor world that we can, as bankers, safely choose and say that, okay, here is a Mambo or here's a Thought Machine? Well, frankly, to the point that my fellow panelists basically made, localization is a massive issue. If you look at the small finance banks or payment banks, a lot of them, when they started off, like we were discussing outside, they started off by taking some solutions on the cloud. And most of them at this point of time have basically taken a reverse journey. Okay, so domain is a big factor over here. Okay, compliance to the rules. Unfortunately, unless and until you have a few folks over there who know this particular system, who can actually work on the same. I mean, these are considerations that as bankers, I think as consumers of these products, we will necessarily need to keep in mind.
Understood. Thank you, Avinash, for that. I think one question to Sudhir. Sudhir, while everybody is pretty much against core transformation, let's assume that if financial institutions in India were to take up that journey, what approach do you suggest? Do you think that setting up a migration challenger kind of a concept is better, or do you think that they should just have a parallel system running only for digital businesses? What do you suggest, based on your experience?
I think at least what I've seen is what's the problem you're trying to solve, right? And just stepping back a bit, I don't see hollowing the core and core transformation as mutually exclusive. I think hollowing the core gives you optionality for core transformation at a later point in time, right? So hollowing core is inevitable. That is inevitable on the journey, digital journey that is in progress. Now, in terms of patterns, it goes back to the problem you're trying to solve. So if you look at global examples or even India examples, when you're trying to solve for a completely new segment in a new product, right? Which requires a different brand positioning, you have the CapEx support from the parent bank, you can go ahead and do it, right? So that is, the last one on your, on the framework that you showed. Alternatively, if you're trying to exploit your existing segment, for example, we have a particular financial institution that is trying to expand the service offering into the segment that they already have. Their migrate to the core, migrate to a new core is making sense to them, because without that, their ability to expand into that wallet share that they have is limited. So I think the answer to this lies in, again, the roots of business, right? What's the segment you're trying to tackle? For that segment, what's the offering that you need to have? And does it also impact your brand, or you're better off building out a new brand? So new product, new segment, new brand, I think, building out the new core, existing segment, exploitation of that segment, but your core is limited in its capability to exploit that segment, and you're allowing competition to come in, then migrate to the new core. At least these two reasonably is, the decision criteria that I have seen working out for banks.
I think, Sudhir, that the way that you put the archetypes, I think it makes a lot of sense. That at least it's a broad directional answer. Obviously, it's highly contextual and depends on which bank and what the context, etc. But at least this gives a directional answer. Quickly, I want to move towards the talent part of it, which Ms. Vidya had raised. I think one is to do a one-time or migration itself, but I think managing the cloud-native architecture needs a completely different set of capabilities, which at least most of the incumbents at least don't have, or it's not an inherent capability which we have, right? In that context, I just wanted to hear from Vidya Madam, first from you, in terms of how are you thinking about it? How can banks attract and retain this kind of talent? Or is outsourcing the way forward? Or what? How are you thinking about that?
You're very right. I mean, we need to get the right skills. We need to get the right skills to operate on the legacy systems. We also need the right skills, contemporary, to run our cloud, systems that we migrate onto the cloud. So basically, and then we need, to ensure that there is a good handshake between the two that's healthy. So for that, one is that hiring the right skills, of course, whether it's the bank hiring it or the vendors. We would like to have our vendors reach out to those geographies where those skills are available, and we would like to work with them to do that. And then there is also this process of continuous training to ensure that they are all contextual, and retooling to ensure that all of them are contemporary. So this is going to be ongoing until we really understand these systems. So that's how we would like to do it. So it's going to be a mix of existing, who have a deeper understanding of banking, the processes, etc., which is extremely relevant as we migrate to the cloud, and to ensure a seamless migration, especially given that we are going to do it in a very calibrated fashion. We would also like our vendors to have that kind of a mix, for which we would like to put in the kind of enablers, and also create that cadre within. That's the way we would like to go. We'll of course ensure that the training mechanisms and the tooling mechanisms are all in place.
Thank you. Avinash, maybe we'll come back to you itself. Madam talked about creating a cadre within the bank, right? So the current HR structure or the current work environment, work culture, etc., is not in line with what the expectations of this new age talent is. And we have been talking about a talent war going on, right? So in your view, how do we tackle this? How do you ensure that within the same organization you have two different sets of cultures being developed? One for the traditional teams, etc., and second is a different set of policies, different set of culture, etc., for a new age talent. How do you manage such complexity?
So this is something, where we continue to learn, unlearn, and, try to do new things practically on a daily basis. I think it's well understood about the fact that, the talent out there which can work on some of these cutting edge technologies, and cloud is one of them. Right? It's one thing is that, how do banks attract those talents? And second is, once you attract those talents, how do you sort of, keep them engaged for a longer period of time? To my mind, this is not a problem for banks alone, although maybe for banks it gets accentuated, because I don't think the brightest minds which come out of the engineering colleges, the first thing that they think about when it comes to implementing a cool technology would be, associating themselves with a bank. They will probably look at very different segments before they think of a bank as such. So the way around it, what we have seen works is the fact that you have got to go build some kind of a brand for yourself. You have to say the right things, especially when it comes to colleges and stuff like that. When you put people in areas like cloud or APIs, blockchain, some of the new modern workloads or data analytics, etc. What we have tried to do over there is we have actually, curated some kind of programs for them to keep them engaged. We have actually tried to create center of excellence. In fact, when we launched cloud, at that particular point of time, because the thought process was that we didn't really want to sandbag it as an exclusive kind of a unit, but it didn't quite work for us. Eventually we had to actually create a center of excellence, give them the leverage that, you can cut through the bureaucracy to get things done. So some of these things we have been doing in not many areas in order to, keep on engaging with them, keep on sort of, keeping them sort of give them a feeling about the fact that, this is the end goal and this is what you are actually helping us, achieve. I think communication is also extremely important over here. You can speak about the fact that, in the last couple of years, I think the salaries have gone to the roof. But frankly, if you speak to the right candidates and you sort of tell them that, this is what you are helping the bank achieve, and this is how it is going to help the community. The sense of purpose is something which I believe is, from a stickiness perspective, is lot more important. We try all of this. We succeed with a few. We are still learning in a whole bunch of places. One more thing over here is that as an institution, we, along with our human resources wing, we are trying to sort of partner with a whole bunch of knowledge institutions over here. We are moving towards that particular segment where everything is going to be knowledge driven, right? So anybody who wants to sort of reskill, upskill, etc., those opportunities are there now.
Yeah, I think, thank you, Avinash, for that. I think yesterday I was reading an article about how Freecharge is doing now. So I think it's a very, very good story. It's that even after the acquisition of Freecharge by Axis Bank, still they are continue to do very, very well. It never got killed within the larger ecosystem, right? Let me come to Sundar. I think, Sundar, one of the points you raised, right, on the governance piece. So can you give some best practices in terms of how should financial institutions think about governance which can help them continue to reap the benefits of cloud native architecture?
Yeah. See, cloud native or lift and shift, either way, right? I think having the basic foundational elements before you get into a significant project is critical. And we've seen, like I said, 4 of these fundamental elements: cost governance, architecture governance, security governance, and operational governance. Now, if I just double click a little bit on them, right, a couple of best practices, I think many companies did not have a clear mental model of what was their baseline cost. There were lots of overheads which were not necessarily well understood. And then 2 years into the project, when they compare what's running on cloud with what was running 2 years behind, with hardly any apples to apples comparison, because not only your volumes have gone up, you have modernized a set of applications, you've created a new set of capabilities and so on. So to be able to separate out therefore and say what has been my cost change, upwards or downwards, it becomes difficult. So it's important to rethink, for example, your KPIs themselves. Should you be looking at TCO, or should you be looking at per transaction cost or per customer cost? Is that what you should be looking at? And also in terms of, for example, security governance. We've seen a lot of organizations simply try to mimic what they would have done on-premise on the cloud, which in our humble opinion is not necessarily the best way to do things, because there are so many tools which are now cloud native, which were designed for the cloud. So one of the things that we strongly recommend to customers is look at what is on offer on the cloud and then take a call whether you still want to reuse some of your earlier components. Too often I see that because it will mean going back to the CISO and getting the new tool certified, which is an absolute pain, people just tend to reuse what they had. And then it may not necessarily be built for the right purpose, so that lands in trouble. So we often recommend that develop an architecture which is relevant, a security architecture which is relevant to the cloud, and then do a game day to test it, and test it periodically. So that's a second thing. And on the operational side, particularly when it comes to looking at what are you going to do on serious spiky events. People like Hotstar have now gotten this down to a science. Just before IPL, a few months before they start planning, how are we going to take a 25 million hit on my OTT platform? And then they do game days to try and see how it would work. What would happen if something failed at that time? Would you still be able to operate? So having such operational game days, security game days, having a baseline of cost, these are some of the best practices we have seen which have set apart people who have been successful on the cloud and have been able to run it on an optimal cost vis-a-vis those who have done some form of lift and shift and then later felt the costs were too high or they were still not able to satisfy security requirements and so on.
I just want to touch upon one of the points which Rishi had made in the beginning about executive sponsorship, right? One of the reasons why many large tech programs or tech transformation programs fail is because of a lack of executive sponsorship. So Rishi, in your experience, if you are to do a transformation or a migration towards a cloud native architecture, how do you ensure that you get an executive sponsorship? How do you get a buy-in from a CEO or a business team and not just from the CIO?
See, according to me, any program, any transformation program which you embark upon is about the outcomes which the program is going to deliver to the bank, be it revenue enhancement, be it cost savings. I think from day one, right, it is all about starting very early. From day one, the governance structures need to be established. The escalation mechanisms need to be established, and most important is continuous tracking, continuous monitoring. Right. I am a strong believer in programs, at least the large transformation programs, having the right executive sponsor from both sides, right? From a bank side and from the transformation from the transformation partner side, right, is extremely important. Programs which have the right exec sponsorship, the probability of success for these programs goes up multifold. So I would just summarize by saying it's all about setting the right governance structures. It's all about defining the objectives, defining the, defining the outcomes very early and continuously monitoring those outcomes on a very regular basis.
Thank you, Rishi. So I think we are almost on time. So any closing remarks from any of the panelists?
Let me try and go first. So, I mean, to the point which I think Sudhir made, right? I mean, cloud is inevitable. I think all the bankers also sort of recognize that. Like I said, most of us maybe, caught the reality of this fairly early. I don't think we get the credit for actually sort of identifying it early. The only point here is that we are probably working in a very different ecosystem versus the startups, versus the fintech community. So obviously, we need to be working within a framework. We also need to be looking at the existing base that we essentially have before taking decisions. But maybe 3-4 years down the line, when we have a very similar panel discussion, I think you will find that the shift has certainly happened.
Thank you, Avinash. Anybody else?
I can go next. I think what I just want to say is we spoke about moving elements of core outside of core. We spoke about cloud native, so moving systems from current on-prem to cloud native. See, I just want to emphasize on the point. I just want to emphasize on data and integration. It's one thing about just moving the system, but in today's world, no system is working or it's operating on its own. You have to think about the integration points. How will the system integrate with the broader ecosystems? How will it integrate with the other system, other internal systems? You have to think of it in detail before you start embarking on such journeys.
Yeah, and one last point from my side. Very often when we get into these large cloud projects, what we find is 6 months into the implementation, suddenly in some steering committee meeting, there are basic questions about why did we start this project. Right? Somebody thought they were doing it because they wanted to control costs. Somebody else thinks they started it because they couldn't retain their people. Somebody else thinks it is because they wanted to be more innovative. So before you embark on any of these projects, please be very crystal clear why you are going down that path. And make sure everybody understands, and even if they disagree, they have to commit to the way forward. Otherwise, down the line, when such basic questions get asked, we've seen projects go into tailspins, go on pending for about a year, then people get replaced, somebody else comes in. We've seen this far too often.
Sudhir, anything from your side otherwise?
I think the panelists have obviously described quite a bit. I think to me, it comes down to, we talk about fintechs a lot as a pressure point. In my experience, it's always been the customer that's the pressure point, right? There is the regulator and then there is the customer. I've actually not come across, a successful incumbent bank worried about fintechs, right? I've seen them being used as, yes, ideators, copying an idea or learning from them how to ideate, but really starting from the customer and then building this entire journey from there has been the most successful pattern, if you were to ask me. There are several anti-patterns, and I'm a big fan of anti-pattern curation as well, because that helps you avoid risk. But whichever way you look at it, I would say everybody who's been successful in progress has actually solved for the customer or for a regulator. And that's really what I see as being the most successful pattern.
Okay. Madam, only a year left now.
So yeah, just building upon what he said. So ultimately, whatever is good for the customer and whatever is good for the business is the right way forward. And here it's not about whether we should, because this is a technology that is here to stay. It's about how and what. So if we answer those questions right, I think there won't be any looking back.
I think we are on time now. Thank you so much. I want to thank entire panelists for taking time out today, and the entire audience for spending time with us. And I hope all of you found this insightful and helpful. Thank you so much.
I extend my thanks to the distinguished panelists for sharing their thoughts on the topic. Thank you. Ladies and gentlemen, as we now come to the last session of the day, I am pleased to invite our panelists for the session.
वैसे भी थे हमारे समय में भी थे आपने तो मैं लगी कर दिया
Ladies and gentlemen, I request you all to kindly be seated. We come to the sixth session of the day, the last session on Infrastructure Finance 2.0, how banks and capital markets will adjust to the new paradigm. The dignitaries may please come on the dais. Mr. Raj Kiran Rai ji, MD and CEO, National Bank for Financing Infrastructure and Development. Mr. Sunil Mehta, Chief Executive, Indian Banks Association. Mr. Vijay Dubey, ED, Punjab National Bank. Mr. Prasad Gadkari, ED and Chief Strategy Officer, National Investment and Infrastructure Fund. Mr. Gurpreet Chatwal, MD, CRISIL Ratings Limited. And our moderator, Mr. Ashish Garg, MD and Senior Partner, BCG. I'll request Mr. Ashish to initiate the panel discussions. Thank you, sir.
Thank you so much, ma'am. Good evening, everyone. I think after a lot of digital and cloud discussions, let's get back to our brick and mortar infrastructure and infrastructure financing. It's really a privilege to be moderating this stellar panel today. Probably between them, they have more than 150 years of banking experience, financing experience, and they bring various elements and they have looked at the whole business of infrastructure financing from their vantage points. We'll probably keep ourselves to 3 themes. There are no presentations. We have 3 themes for discussion. We'll speak about the opportunity in infrastructure financing. We will speak about the overall risk management and how do we think about enablers for infrastructure financing. And we also want to talk about how do we think of long-term liabilities and how do we think about risk capital for infrastructure financing. So let me just get straight away started. I think we have already heard the introductions briefly from our compeer and MC. So, you know, we hear really big numbers on infrastructure. This year's budget spoke about a 10 lakh crore rupee push. We heard about NIP getting continuously populated with more and more projects. We hear about PM Gati Shakti. We hear about, you know, on the other hand, hyperscalers on the data center side. We speak about green infrastructure. Road infrastructure continues to gallop with 37 kilometers per day kind of construction coming through. New areas, Northeast, you know, so there are multiple programs being launched. So Mr. Rai, I want to start with you and, you know, and then Mr. Gadkari, you can come in on how do you know, there's a lot of announcement. You have personally taken a huge step forward to be heading NAFID. How do you see these opportunities? Are they really matching with what is happening on the ground? Just give us a little bit of a perspective on infrastructure financing opportunities.
Thank you, Ashish. There are a lot of opportunities actually on the national infrastructure pipeline, which was announced actually, that on which everybody is discussing, which is 110 lakh crores, which has to happen to achieve our 5 trillion economy also. So there are certain things which have taken off very well. As you rightly mentioned, road is one area. transmission, electrical transmission is some like where we see a lot of interest. But then there are many areas where, like in the process of taking off, we can talk of railways. Railways is a big chunk in this national infrastructure pipeline, which has not seen much traction, even though there are a lot of discussion going on. Urban infra. Because see, India is slowly moving from the rural to the urban side. Actually, the population on the rural side, if you look at the census also, like a lot of urbanization is happening. With that, the urban infrastructure, particularly on the drinking water side, sewage, maybe building metros and better connectivity, housing, affordable housing, most of these things have to happen. Otherwise, again, you will not have a proper development of cities to accommodate people. As a developing economy, it is important for us to invest on urban infra. Another is the healthcare. Actually, they are also coming under infrastructure, setting up of medical colleges. There is a talk of having a medical college in every district, then the hospitals. So then tourism. India is a beautiful country with so much of tourism opportunities actually. But then, you know, not much investment has gone, the quality hotels. So they are all under infra development. They are all in the pipeline. But then we need to really work hard to make it bankable. Actually, many times the projects are talked about, saying that this is what we want to do. I just want to add another big thing is the inland connectivity. This is a huge thing actually, like because this is the cheapest mode of transport. But then it will need huge investment. So the challenge in front of us is the pipelines are there, and all of us need these pipelines. But then we need to work to convert many of these projects into bankable projects, for which right project assessment, study and all that should happen. And then actually like lenders and the people who bring in equity to these projects, they have to be assured that there will be decent returns for their investments. So we need to build that ecosystem, so then this can convert. So the opportunities are huge, but then our task is cut out in creating the right ecosystem to take it, so that this takes off.
Thank you. I think I'll just build upon what Mr. Rai said. He's already covered part of what I would have answered. Maybe I will also approach it from two different perspectives. From a macro perspective, especially for all our banking colleagues and audience, the opportunity set really involves, you know, there are these two large programs which are going on. And Mr. Rai talked about the National Infrastructure Pipeline, which is a $1.4 trillion program, which is really about creation of new assets, and that involves extensive greenfield and brownfield development of assets, which means one has to be adept at taking project financing risk, assessing those. Obviously, it will involve working capital and other kinds of financing at a later stage. So that's one set of opportunity. And under the National Infrastructure Pipeline, I think the big sectors really are energy, urban, railways. These are the three biggest areas. And underlying, as Mr. Rai alluded to, underlying projects will come about. They need some preparation. The second sister opportunity of the NIP is really what is called the National Monetization Pipeline, which is about $80–90 billion, again a sizable thing. And that's a much, in a relative sense, a less riskier thing, because it involves extensively operating assets, where government is really selling off or monetizing assets, and where there are established cash flows, established contracts in place, and that's another set of opportunities. And here the big sectors are really transmission lines, highways, airports. Those are the kind of sectors the government is trying to do. The another thing I think Ashish, you alluded to, and that's again a big theme we are seeing, is really around green financing, climate-related infrastructure. And there are again specific sets of opportunities there. You know, whether it's on the water side, there is this National Mission for Clean Ganga, underneath which I think around 80 to 100 number of projects are going on, some through HAM contracts, some through EPC contracts. So I think that's another set of opportunity which is coming up. Then there are government is doing large format electric bus tenders. You know, recently CSL tendered out about 5,000 electric buses, which Tata Motors won. So these are newer kind of things which are coming up. There is offshore wind sector which is coming. There is green hydrogen. So a lot of new things coming alongside the traditional sectors. And I think one has to pick and choose which ones you want to attack.
Thanks, Prasad. So clearly there is so much opportunities here. At some point of time, we will request the panelists to share how bankers should think about developing capabilities to be able to address some of that. I'll move to Mr. Mehta now. Mr. Mehta, you have seen this all. You have seen the world from a variety of angles, as board members, as part of some cabinet committee meetings. Tell us, is there the economic case for investing in infrastructure clear? Do we still need government help to invest in infrastructure, or do you think the sustainability of infrastructure financing is there?
So, well, I totally endorse the views expressed by Rajkiran Raiji and Mr. Prashad that India is a land of opportunities. As regards infrastructure, I think we are at a much lower level of development as compared to the other developed countries, and there is a great scope, and that leaves us the greater scope for investment in the infrastructure sector. As regards help of the government, yes, no infrastructure project can grow without the help of the government, because infrastructure projects are basically meant for public. And when the infrastructure projects are meant for public, their revenue will come from public, their utilization will be by public, and the representative of public is the government. So without their support, no infrastructure project can succeed. Why I'm saying so? If you say road projects, ultimate owner of the land is the government. Ultimately, they have the ultimate rights. Because even in the constitution, the directive principle, land is just not a fundamental right. It's a government has the right to acquire it and can say it. So without the government support to go forward in infrastructure is not difficult. But thanks to the government, they have already recognized this requirement, and they have created a new institution, FID, which is headed by Rajkiran Raiji, looking for a special direction, reviving the infrastructure funding to face these challenges. And infrastructure will definitely require a great amount of funding, which may not be able to come only from one or two sources. So we will have to create a basket. And as rightly said by Mr. Prashad, then there will be infrastructure project which can contribute for any green financing. So we can even source the international funds which can offer us a cheaper funds for a green financing. Then there can be some infrastructure projects which may get interest by the long-term PE funds and all that. So India has got a potential. Now, only thing is to creating that basket for investment into this, because solely the government cannot contribute for it, and creating a right ecosystem will definitely fill up the aspirations of the Indian economy of 5 trillion economy, because infrastructure will produce employment. Infrastructure will definitely push up all these things.
No, thank you. Absolutely, the value and the multiplier of infrastructure is absolutely is kind of almost like a law. Let me turn the issue on its head, and let me get to Mr. Dubey. You know, if we just look around the last few years, India's position in geopolitics has changed dramatically. You know, we are becoming much more bolder. Our assertion on the world platform is changing a lot. And on other side, we see China kind of flexing its muscle, but also learning and failing on its entire BRI, the Belt and Road Initiative. I just wonder, as financiers and bankers, do you see opportunities outside India on infrastructure financing, which could, you know, be a win-win in terms of, for example, getting the right returns and also working with developers in India? Have you thought about it?
Thank you, Ashish. That's a very interesting question actually you have asked. My co-panelists have discussed the enormous opportunities that are available in infrastructure in India. But COVID has been a great learner for all of us. And one of the important learnings that have come from COVID is, prior to COVID, if you think of it, the supply chain management, the globalization of supply chain management, moving to the places where you had the minimum costs involved, was the in thing. But suddenly COVID has made us realize that entirely supply chain management based on globalization principles may not work efficiently. And then, as you rightly said, the one particular country, Belt and Road Initiative, COVID specifically the period has brought out a lot of negatives which has resulted in that country losing its trust. Simultaneously, when I talk of it, what I'm also talking about is, during this period, again as a learner, the COVID vaccine, and not only we vaccinated our own people, we helped many other countries in terms of the vaccination program. And while we have crossed 200 crores plus of vaccination, even today, October 2022 figures when I see, Africa vaccination is only 24%. And one of the basic causes that has been realized is lack of basic infrastructure there, lack of roads, lack of cold chain storage facilities, lack of power. So The point is, in this recent report which has come by the World Economic Forum, the Global Risks Report 2022, they very clearly specified that when we talk of development, it cannot be restricted to one country per se. It has to be on a global basis where international dependencies and international cooperation is the only way forward. So having said that, what I am coming to is, जो एक हमारे संस्कृति है वासुदेव कुटुंबकम, उसी को आगे बढ़ाते हुए, and given that whatever my colleagues have talked about the experience that India has, in fact it is one of the smallest per capita, lowest per capita carbon footprint in terms of the infrastructure development that we have done. So that becomes a very strong plus point for us to now branch out. And there are enough countries who are out there who would be benefited by the expertise that we have developed, both in terms of, when I'm talking of expertise, I'm talking both in terms of the real estate development companies and also in terms of the financing institutions. Let me just one point more, which is, when I'm talking of this, one important aspect is, essentially this becomes a soft power for the country, brand India. And to that extent, it is also important, imperative for all of us, that when we talk of this sort of globalization where India and Indian companies go abroad, help in infrastructure development, for which there's immense potential, we as citizens, as countrymen, as fellow countrymen, should be very clear about 2 points. One is quality, which I basically call as economic sustainability, and the second is environmental sustainability. That is what is actually going to help our country go forward further.
This is very interesting. Mr. Dubey has kind of given a roadmap of how at least a large lender is thinking about new opportunities. I'm sure many bankers will be inspired by that. Gurpreet, I'll turn to you. You know, these are dizzy numbers. $1 trillion, $1.4 trillion. This massive numbers come there. But one wonders, where is this money going to come from, right? We were just having a discussion in the pre-session enclosure. There's hardly any bond issuance, for example. Yes, of course, InvITs are starting to come in. New product structures like takeout financing, refinancing. We're starting to see a little bit of that. But they are nowhere to match this kind of a demand. You have any thoughts on how India can think about a bond market development to really get infrastructure financing going?
Thanks. I think you've come to a very relevant point. I think what we've seen is that, like my fellow panelists, Mr. Rai, Mr. Mehta, talked about great opportunity, and we're talking about hundreds of lakhs going to be spent. And obviously, as one of the panelists rightly mentioned, that infrastructure is a common good. The government needs to enable that. But obviously, the government can't spend all the money. You need private sector participation. So we think bond market in India isn't really firing from a perspective to fund infrastructure. What we've seen bond market really doing, we have a few central counterparties like NHI, PGCIL, all of them. If they go to the bond market, they will get money. But obviously for the private sector, it isn't very easy to get money from the bond market. I think this is also, to some extent, I would say, a perception problem. We've had times in the past where we've seen some of the traditional bond market investors, and traditional bond market investors are pension funds, insurance companies, mutual funds. I think these are guys who largely fund the bond market. I think they've had significant losses which have come from infrastructure. I think they haven't, they've been shy around it. I think it's a perception problem today. I think we've seen over the last, I would say about 8-10 years, a significant amount of change happening in the way infrastructure is funded and financed. We've seen far more fairer concessions being today there. If you see the HAM concession today vis-a-vis what was there about 12 years back for BOT, I think it's a sea change in terms of fairer concessions. We have central counterparties playing a very disproportionate role today in infrastructure funding. If we see NHI or, for example, SECI, any of the projects which they are counterparties to, the stakeholders, the investors, the developers, the lenders are far more comfortable than if there is any other counterparty. We've also seen the IBC I think while there's a lot to be done there, but I think that's also helped in very fast resolution for many of the assets. And lastly, I would say the InvIT and the REIT, the way they have developed, I think is a very large boon or a very big boon for infrastructure financing in the country. It basically, what it does is it reduces the leverage to 50% and has only operational infrastructure. If you have those, we've seen that being far more stable from a credit quality perspective. So I think all this is, I think we need to do a far better job in trying to work with the bond market participants to try to get them to understand this and then start lending to it, because technically when you're funding infrastructure, it's a 20-year contract on one side. You need 20-year money, and the guys who can give you 20-year money is a pension fund and insurance company. It isn't a bank. The bank has, they have their ability to kickstart all of it. At some point in time, they will hit sectoral caps. I think that's one aspect. The other is traditionally bond market in India is developing as we go along. Today it is 6-7 lakh crore which actually gets issued in a year. It's a total 40 lakh crore market. It isn't a small market. Dominated by some of the large players. We believe some of the other aspects which will help is how to create institutions. Again, as I said, in India, infrastructure, you would need central counterparties to help. I think one of the important institution which we believe will kickstart or push investments as well as bond market investments is the institution Mr. Rai is heading. I think it will play a very stellar role over the next, I think, 5 to 10 years in the way infrastructure is financed through direct funding or through providing guarantees. We would need more institutions around similar, which will help make market. I mean, you need secondary market liquidity in the bond side. I think we would need market-making institutions. We would need ways to attract foreign capital, retail capital to ensure that we develop the bond market. Our sense is as we go down the road, we do this right, we will have bond market funding a good portion of Indian infrastructure.
Fantastic. Thanks. We really look forward to participating as retail investors in some of these bonds. China, for example, has done a fantastic job with their bond markets. This is actually a very pleasant experience to see such large audience at 6 p.m. So we are going to have the session done a little differently. After 2 questions, I'm going to open for a brief time for some audience questions. So I'll be very happy to take a few questions after 2 questions. If you have some thoughts, 2 or 3 questions, we can take that up. Mr. Rai, you were brought in by Gurpreet a couple of times as from an institution perspective. You have also been given 20,000 crore rupees by government, but the roadmap and the ambition for you is huge. 3 lakh crore rupees, 5 lakh crore rupees. Obviously, you will need to tap into some pots of money. What's your thought about the insurance and pension markets in the country?
The advantage today in India is we have a thriving insurance and pension fund mobilization. Actually, they're all growing at double digits. The assets they're holding is phenomenal. They're growing very fast. So naturally, they need to take long-term investments calls. Basically, they generally need 20-year, 30-year kind of bonds, actually. So this is exactly what we need, actually, for the infrastructure funding. We need to build the right system, actually, to tap that money. As an institution, actually, like when we talk of bond market, there are 2 major markets. One is as an institution, I raise money by way of bonds from insurance and pension fund and then lend to the people like, companies for execution of work, or the companies directly raising in the bond market. I think the ideal thing is companies directly raising. So that maturity of the markets will come over a period of time. As Mr. Chatwal mentioned, actually, we need to provide sufficient liquidity in the secondary market, actually, for the bond market to thrive, particularly the long-term bond market. Actually, practically in India, about 10-year bond market is actually non-existent. So there are huge funds. Actually, we see the present situation, according to the assessment, the insurance and pension funds in 23 itself can invest about 2.5 lakh crores in the infrastructure bonds. There is huge money, actually, like which will supplement our efforts. So now as an organization, we have multiple sources to depend on, but insurance and pension funds are major sources, both domestically and internationally. See, one small thing I want to put it across. Today, there is a lot of financial savings happening across, both domestically and internationally. and particularly on insurance and pension funds. That's why we see a lot of interest from Singapore or Canada in many of our assets, basically. They're all searching for good assets which can give good returns. Basically, if you are able to like sell our assets right, to create the right ecosystem and structures, I think raising resources should not be a problem. So that is my thing. I'll like chip in at the right point of time.
So, let me get you in, Prasad. There are two visuals I have. There is a visual I have of all these global SWFs with trillions of dollars invested in infrastructure, long-term money, chasing 8-9% kind of, dollar return, 10% dollar return. On the other side, you have Indian risk capital, which typically will not be happy with anything which is not around 20%. You have probably tried to saddle, given that you are running multiple funds, you are into multiple sectors. What's your perspective on risk capital, both from the international perspective, but also from Indian perspective, and how do you think we can channelize some of this money into prospects that Mr. Rai mentioned?
So Ashish, I think on this, couple of things have happened. Firstly, I think from a government perspective, there are, especially in the last 4 or 5 years, we see there are different structures which have been created to tap different kinds of, because not everybody is going to be open to taking all kinds of risk. So people who are okay with operating risk and cash flow based thing, you have InvITs, you have infrastructure debt funds, those kind of instruments have been created, and those are the instruments which pension funds are coming into, some of the global insurance funds have come into. Separately, like NAPFID now, 5 years back, NIF got created. So we have created a kind of a particular investment strategy to tap these investors. So what we have done is we have really 3 funds that we have created underlying the NIF structure. One is a pure infrastructure fund, and this is extensively focusing on operating assets with selectively developmental stuff. That's where we have been able to bring some of the largest Canadian pension funds, Australian pension funds, Middle Eastern investors, sovereign funds from Southeast Asia, because they were happy with that risk return profile. Then we have a fund of fund product, which is really not investing into projects, but we thought we will leverage and create many more funds underneath, which will then invest in companies and projects. That is where we have been able to get multilaterals as partners. So whether it's Asian Infrastructure Investment Bank, ADB, BRICS Bank, all of these guys have come in. We have created a third pocket, which is really looking a little bit on what we call a growth equity fund, which is looking at newer sectors, whether it's manufacturing, electric mobility, healthcare, and that's where we are looking at a third set of big investors. So really tailoring your strategy depending on what the investor profile will look like or what it will be comfortable with. I think that's the trick which the government has also tried to work on. That is what as NIF we've been trying to work on. And overall, finally, the trillions and the billions of dollars, what you're talking about, India will not have one way, right? We need a basket and multi-pronged strategy over a sustained period of time to really raise the capital which we want.
Godspeed, we really hope some of this kind of plays out. And actually, it's fascinating to hear what NIF has already done in terms of multiple structures. As I promised, I'm happy to take 2 or 3 questions. Okay, gentlemen, right there, you raise up. Can somebody just put a mic there? So just keep the question brief. We have a lot more questions to ask our panelists.
Thank you. So I'm Rohan, and I actually write on infrastructure projects and policies for a UK-based publication called InfraLogic. I cover the South Asia region. I have an observation and a comment. One observation I think is we're not really calling a spade a spade. The NIF, for instance, was, you see the charter of the NIF, nowhere does it say it cannot invest in greenfield projects. That's what the government wanted when they said we will set up an institution called the NIF 10 years back. Yeah, I think when the government came to power. But so far it's been a private equity style kind of investment. They finally didn't go ahead and invest in first try. There was a lot of criticism on that. An online child retail store. So that's where it's been as far as the NIF is concerned. It has come in for a lot of flack, not least from the roads minister himself on several public forums. That's one observation on the NIF. I think maybe it's because of that, the lack of greenfield finance, because of the NIP that we are talking about, the need for the DIF that came about, and Mr. Rai is sitting here today. So question for Mr. Rai is, how are you going about, can you tell us something about how you're going about the job of this new bank? Today, we're
So let me just, because I'm just wanting to, there are 2 or 3 more questions. So if you can just lay out your vision for NAFID. I think the question is, how do you want to go ahead and kind of...
Yeah, but specifically, you know, today we are seeing projects going up for financial closure only from roads. You know, we are talking about this healthcare and this and that, but there are no DPRs for that.
Yeah, let's hear him. So, sir, I mean, there is obviously the demand is there, the excitement is there. You have almost donned the chair of a startup. So, what's your vision to take this forward, sir?
Yeah. First, clarity on behalf of NIF. Actually, maybe many times we don't know what NIF has done. NIF has done a lot of innovative things. Maybe you have to sit with Prasad to understand, because I spent some time with him to understand, and they have done a lot of things. But then generally these kind of things take time to really play out. Creating structures which are non-existent and then attracting investment and getting the right talent to do that, it is this thing. So don't have a preconceived notion that things are not happening. It is not moved as fast as it should have been, but then there are issues. But then they have done a lot of work. When it comes to NAFID, see, we are a DFI where we are also lenders, actually, but financing is not the only job. Actually, our role is actually our multi-fold, actually. Developing a long-term bond market is one of our mandates. And also, creating the right ecosystem. Basically, ecosystem where we do the right project assessments, build right kind of structures for financing, and then crowding in investment, basically. So we need to attract investment. We are also lenders, but then we also have to bring in a lot of other investors to this project. Now, in the specific point, actually, basically, your thought may be flowing because some of the projects actually do not get the financial closure and all that. But then I feel, because I was heading a commercial bank, quite large commercial bank for 5 years, and I know almost all the infrastructure companies. For the right kind of companies, where the bidding is right and if it is viable, we have not seen any problem in financial closures. The financial closure problem comes if the company doesn't have the right credibility, and we have a problem in the way they have bid for a project. Basically, we see a viability issue there. So banks have learned their lessons. In the last 10 years, there is a lot of information in the ecosystem about failure of infra projects. Even though government has corrected many of that. HAM is one product of that correction. So,
Sorry. I'm just going to, this is a limited time panel. I'm going to not have a follow-up question.
Yes, Mr. Rajkiran Roy. Sir, we are all accustomed in India of lending for 7 years, 8 years, 10 years. And now we are talking about 20 years, 25 years. These are all long-term projects, large projects. So how do you see, like Mr. Mehta has said, that the government role will be very, very important? Because many of these projects are based on the government policies and plans. So looking at our Indian political system, like you see bullet train, only one state stopped it for 1 year, the project. So how do you see and how do you mitigate the risk, and avoid this mismatch of short term and long term? Like those Latin American companies, they borrowed for only 8-10 years and put up the project for 20-25 years, like even Malaysia. So how do you balance it here in India suddenly with this, your company which is talking about 2 lakh crore, 3 lakh crore rupees investment?
Let me rephrase the question, sir. So the point is, everyone understands there's a policy risk, political risk.
I'm Ashok Ajmera.
Some of these
Thank you,
projects. So is there a portfolio approach which kind of balances this out? Is there a continuous dialogue that you need to have with stakeholders to kind of move forward? If you can throw some perspective, sir.
Yeah, actually, these are the risks. Basically, nowadays, the right covenants are also put, actually. If there's a political risk. Actually, this is a dispute resolution, basically. When the project goes right, there is no issue. Only when there is a political risk or a policy change and all that. So we need to put the right covenants. It is a dispute resolution. And I think we have evolved well in this front also. That way, today substitution in projects and termination payments in projects have come out very well. So now I think we are learning. These issues have happened earlier, but I think right now we are attracting a lot of money here. See, actually, a lot of money is flowing into the current country today in brownfield projects. Not in greenfield yet actually, but brownfield we are seeing a lot of interest. Only because the policy is much more comfortable today. So I think the resolution basically, it is not in our hands, but then the stakeholders like government have realized, so today like some of the states which are not in the right, like they don't act in the right spirit, they get punished. So, because there is no investment which will flow there. So, states which are proactive, there is a lot of investment flowing there. So, I think the differentiation will, the market will create the differentiation.
Absolutely. So we'll give, sorry sir. We'll give Mr. Rai time to breathe. I'll come to Gurpreet back. Gurpreet, one of the things is how, while we have a very good data infrastructure being created on our retail side, with credit bureaus out there, we also have something now. There are multiple credit bureaus out there. How do we think about data, analytics, from an infrastructure perspective? I mean, the famous ROCks initiative of World Bank is well known. As a data company or in some ways analytics company, how do you think about that? And then maybe Mr. Dubey, I'll come to you on how as a banker you think about a portfolio approach to infrastructure.
No, thank you. It's a good question. I think we've seen a very strong retail revolution, or at least the NBFC revolution, consumer credit coming at the back of credit bureaus. I think infrastructure also needs something similar. We have as I would say, some of it is today, we are moving in the right directions. We've started in some manner. I think the direction is very positive. As I was talking, one of the regulations or one of the SEBI initiatives which I thought is very conducive for infrastructure development, I talked about REIT-InvIT, I think it's also linked to data. Today, we have more than 20 REITs and InvITs listed. Each of them have a data stream which is coming out in the public domain. So if you take roads, there are about 6 to 7 InvITs listed. You have data available of traffic available out there. We have on power, transmission, etc. Each of these have listed InvITs coming out. Previously, all the analytics or data about infrastructure used to be either lying with banks or investing institutions. It wasn't available in a public domain. So a data stream of, say, for example, what is the irradiation or the PLF for solar plants wasn't available. It was available in a particular bank or 2 banks or 5 banks. Today, with this aspect, we are seeing far more data streams coming in public domain. A big data source would, at some point in time, will be the toll data which NHAI has. Today, NHAI, the way it's developed, has a very large data sets which are available in public domain. So I think the important perspective here is that better data will crowd in investments, and we are seeing that happening. Today, we have a sister arm called Crystal Research. Actually, it publishes for the 2 asset classes, both roads as well as renewables. I think a good amount of data for a large number of projects are available with them, many of them from public sources, as I talked about, many of them from secondary sources by discussion, etc. There are good data streams. We've seen lenders, we've seen investors getting this data to help out. I think we are in the right direction. So we would, our sense is that some of these large central counterparties have a decent amount of data. We should figure out a way how to put that in public domain to help lenders and other institutions take calls.
That's very useful. I think as lenders, we really need to think about data, and I'm very impressed to see so much data is available on some of these sectors. Mr. Dubey?
Yeah, when you talk of portfolio approach, essentially when one gentleman was asking about one particular project and the difference of opinion between different political parties which led to certain delays. See, I put it this way, the difference of opinion is the strength of our country. And infrastructure projects being long-term will always have this issue which we all have seen in the past and will continue in the future. And that's where this portfolio approach as a word when we are using, it could be not only in terms of technology used, it could be in terms of the projects that we are looking at, it could be in terms of the funding processes that we are talking of. So that is a बहुत पुरानी saying है ना, don't put all your eggs in one basket. Essentially, infrastructure project also diversify yourself across technologies, across geographies, across types, funding, ratings. Things will work out.
All right. That's a very simple but very, very sagely advice. Mr. Mehta, I have a question for you. Look, recovery is, in some ways, one can say the other side of lending coin, right? I mean, you will lend and you will have to recover. This is a business. But, a question kind of emanated there. There was a dispute resolution point that Mr. Rai mentioned. Is there something specific that needs to be done at an industry level which helps? I mean, you have been really passionate and you have seen good times, bad times, which can be really done at an industry level which helps in infra recovery?
Well, there is a scope for a lot of improvement in this sector. And I think government is also gearing it up the way the earlier road structure, the BBB model was introduced. And then they realized that there can be a variance, maybe because of the construction of a parallel road, maybe because of some other political issues. So they created a HEM model where, at least to an extent, the cash flows come through a annuity model and the cash flow risk is minimized. The construction risk still continues, but the cash flow risk is minimized. So that is one improvement which the government has brought. Then the secondary thing which the government is now working on and what the entire ecosystem need to work on is creating the value of the and sanctity of the contracts. Like once the contract is reached between an entrepreneur and a government, come what may, that should be honored, and that is one priority which the government has to find, maybe through legislation or administrative measures, that once the any funding for infrastructure project has been done, then whatsoever was the initial agreements, if at all that is breached, then there has to be a reasonable compensation, and that compensation need to be faster, and for which mechanism need to be created. So there is a need for it. And this can definitely be inbuilt into the covenants while giving the loans. This can also be a tripartite agreement between the government and the entrepreneur as well as the financial system which lends to it. And that will facilitate the greater investor confidence in investing their money into the infrastructure project. So dispute resolution, its speed, and preventing the dispute by enabling a mechanism into the covenants, into the contract, will definitely facilitate this.
Just to add to what Mehta Saab has said, see, when we look at the past, the recovery issues that we faced, but going forward, the technology that is now available, which was not earlier, need to make more use of it. When I say this, essentially just take FASTag as an example. Prior to implementation of FASTag, the per day toll collection in our country was approximately 45 crores per day. Post FASTag implementation, now it is crossing 130 crores per day, which means the pilferage of around 90 crores per day, which was happening, which was ultimately hitting the bankers only, the financiers, because the money was getting pilfered. And I'm talking of nearly 90 crores per day, which logically should have come as a recovery to the banker, was not coming. So once we have more integration of the technologies available, and FASTag is one prime example already available, and just to take it forward, maybe when we talk of the throughput on the ports, you have transponders, etc., which will actually have a very real-time sort of a tracking, monitoring available to the bankers and ensure that the funds are automatically flowing into the accounts. So then you are basically taking out the pilferage and the misreporting which was otherwise happening. Recoveries get ascertained.
Excellent, excellent. That's good news. Let's take two questions. Yes, sir.
Hello.
Yes, sir. Please go ahead, sir. You had the question. Yes, sir. You have the mic, sir. Yes, go ahead, sir.
So I think the key question which you raised is that we see a great opportunity, but where will this dollar come from?
Yeah.
And I think we talked about pension fund and insurance fund and capital market, bond markets. I think the critical question, I think Mr. Mehta, you mentioned, and Mr. Rai and Mr. Gadkari, I think the critical question here is the enforceability of contract. We are basically bottom last 20 in the world. Our ranking is 163 out of 180. And therefore, whether it's an Andhra government, you can get out, whether it's an NHAI, once the toll once there is an upside, the toll is stopped. So I would say that's an important thing. And one critical issue in that is that if you look at the entire contractual framework in India, it's all contracts, not government. And therefore, what you require is a government policy and there is an act of government, and the projects get awarded under an act. Now all these projects are awarded under contract. And that is a big problem, and I would say that's an important part what you said, that you won't be able to raise that capital, what we are talking about, trillions of dollars, unless that risk which Mr. Mehta mentioned get actually...
Yeah, absolutely, sir. I think that's a great point, and let's keep making that points at the right forums. Yes, sir. So one there, and then we'll come back to our panelists for final round, final set, sir. Yep. Sir, I'll just take that and then come back to you. Yes, sir, please. Just keep it brief, sir.
Yeah,
if there's a question.
Very brief. I think Mr. Rajkiran has confirmed that we have to an asset so that the funding is continuous. Sir, when we go around the country, I mean, when I see the maturity experience and the kind of we have, I think a different model has to be seen to create the infrastructure needed by the country. Whether it's a road, it's a health, education, and there, believe me, no private investor, talk about any group in India, there is a limitation. There's a limitation of 3 year, 4 year, 5 year, 15, 20 years. So I think government has to come out with some PPP model. These are the district, these are the road, these are the hotels, these are the thing which is required, and this maturity and experience and credential should be utilized for the speedy implementation. Now those things are procedure issue, the ratings, and then those things, I think a team has to come out and see that what the country needs has to be done.
Thank you very much, sir. I'll take 1 or 2 comments, sir, your comment and your comments. Sorry, sir, we'll just come back.
In addition to that, my question is for Mr. Rai. See, there are number of large stalled projects in different sectors where banks has lent lot of money. But since these projects have been stalled, so those projects has come into the NPA. So what will be your approach for continuation of these projects so that these projects are completed and there is a win-win situation for the banks as well as for the project owners?
There's a wish kind of thing. Yeah.
See, in your earlier avatar, you were in the government, we were monitoring this. See, there is a stalled project monitoring group in the government, and there is a very effective monitoring. There are multiple issues in this. I think we don't have that time to discuss these issues. But then what we should see is, basically many of these problems are flowing from the earlier way of doing infrastructure planning and financing. What we have seen in the last 7-8 years, actually we have not seen much problem in infra projects. The project launched afterwards, I think they are all progressing very smoothly, getting completed very smoothly. Yes, we inherited some old problems which we have to sort out over a period of time. There are multiple issues there, right from environment to land acquisition to, and actually because of the delays, the promoters also have run away now. So I think these are the issues which have to be tackled separately.
Sir.
So for a country like India, like developing country, and a lot of infrastructure is required, right? And a lot of in the pipeline. But one important thing for us is to think about the human capital, right? So we need the workforce to, implement this infrastructure. What are your thoughts about, whether government is doing enough for such workforce? Because we recently saw during COVID, like a lot of workforce went back, and that stalled a lot of projects.
Yeah. So I'll just actually take a twist on that question. It's a great question. So we speak about all these opportunities, and I had mentioned that earlier as well. What are institutions doing, financiers doing, to develop either technology capabilities or human capabilities? I mean, his question is from execution of the infrastructure, but I'm saying even as financiers and bankers, we can say green hydrogen, we can say all these fancy new infrastructure coming in, but we need to understand what they are, how do we monitor them? Do you think we are doing enough as financiers and bankers to build these capabilities out there?
Maybe I may have to take this question again. See, on the, your point was from the company's side, basically who are executing these projects. What we are seeing is basically a lot of like if you take the major infra, what is road. I think today the technology which is being used in road laying is one of the best internationally. So what these companies have done is they have taken the best international technologies, and then specific projects like tunneling, maybe something on the waterfront and all that. there are tie-ups happening with the international companies, what we are seeing. So I think technology and the resources for the private sector who are implementing these projects, I am not seeing a problem. So today we are able to drill the longest tunnels, whether it is in Kashmir, the most difficult Himalayan terrain, the tunnels are working. Yeah, and even in the metro we have seen. So I think in Bombay you see the tunnels are like on time, they are able to drill. So I don't see a problem on the private sector side. But your point, like what Ashish twisted, it is on us actually. Actually, since the commercial banks started doing infra financing because there are no other players, so specific expertise on project appraisal and monitoring did not develop actually. There are very few people who are really capable of doing these project assessments today or funding infra and all that. And it is on us today to build these capabilities. From our side, yes, we will be working on that. There will be a lot of other agencies also will be working on that. So that talent from the financial world is not sufficient. We need to build on that. I agree on that.
Just to probably throw another perspective on this, so I think going back to your question from the government's perspective, at least what we see, there is an agency called National Skill Development Corporation, and that's, it's been there for a while, but government has kind of tried to reinvigorate that, and that agency is trying to work with various state agencies, central agencies to create and train, because you rightly brought out, we need workers, staff who are skilled to handle new technologies, new sectors. So that's happening at a macro level. From a micro level, I can tell you as NIF how we have looked at it. Frankly, the only way to solve this is really by doing. So we have done an investment into ports and logistics. We said we don't understand that, but we have partnered with one of the best, which is Dubai Ports, which is helping us bring probably one of the best practices in the world, and that's how our staff are getting trained, and we are in kind of ensuring those skill sets. We have done an enterprise which is focused on healthcare. It's a healthcare focused fund where we have supported a set of people who are ex-GE. So these are best-in-class people who have done healthcare equipment, and then you are setting up those kind of systems, processes on the ground. That's the only way to solve for it is how we see it.
And actually, if you think about it, a lot of these aids which come or loans which come with a technical assistance component. We have to be very open to also importing some of the technical knowledge that we don't have to really create this infrastructure. I'm really being told we are out of time, so I'm going to have, lady, I'll take your question. But I'm going to, just ask one question to Gurpreet. You are in the rating agency business, so I'm sure a lot of new ideas, new product thoughts come to you because your stamp and approval and your pushback gives a lot of assurance to a lot of people. What are the new developments, innovations you are seeing on the product side on infra financing?
No, thanks. I think from the way we've seen infra, the way it's developed, I think it's actually a little bit old. In the budget 2016, Mr. Jaitley had suggested that we should look at a different way of evaluating infrastructure projects. So we all sat together, the rating agencies, stakeholders, to develop a product called expected loss ratings, which is basically nothing. Currently we rate companies based on probability of default rating. That means do you have the ability and willingness to pay in time. But what happens if you don't pay in time? What happens if there's a default? What we've realized and we've seen in the last, as many of my co-panelists said, that the projects which was done in the last 7-8 years have all been in time. We've seen a good amount of recovery happening for projects which have been stuck and delayed. Many of the projects which were really in trouble are today sitting as AAA projects in many InvITs. I think the fact that the loss given default in the infrastructure projects with the right concession, with the right counterparties is fairly low. So what expected loss does is it looks at probability of default, multiplies that with if you default, what's the recovery? It gives a perspective to lenders that over the lifetime of the project, of say 20 years or 30 years, what kind of losses you will make, not whether the project will default or not. But if there's a default, how much money you get back. And we've seen in solar, we've seen in road, many of these projects, and the caveating is who have the right concessions, who have been funded properly, who have the right counterparties. We've seen the losses are very less. So even if there is default, people come back very quickly and the money is recovered. So it's a new data point. We've done almost 150 projects in terms of a pilot basis and seen that expected loss actually gives you a good perspective. And the loss given default is not one number which as bankers we used to take a World Bank report, say that in India if something defaults, you'll get 25% of your money back in 4 years. That is not necessarily true today in infrastructure. So the point is, EL ratings is a new concept. It is something which is an additional data point to the PD ratings. Maybe it's a high time for lenders to also look at that and be comfortable about what they're lending to. Thank you.
Maybe it's the time to come out of our earlier thought process,
Yes.
and where we see high defaults and high losses. Maybe the last 7 years data points are different. I think based on that 7-year data point, we need to have a relook actually, as he rightly said, the expected credit loss models actually.
Lady, the last question from you.
Yes, so my question to you, Ashish, basically, you said that in the morning there were discussion how this $1 trillion money is coming from, right? Even if you say greenfield projects or infrastructure projects. So why India is also not working or thinking on liberalizing more the liberalized remittance schemes or international pooling? So for example, wherein the corporates have multi-country presence, if India also allows them to have international pooling structures, don't you think the corporate will get more funds in India for these projects?
Look, at the end of the day, ultimately the capital moves basis their own, their own balance of risk reward. I mean, there are multiple things. I mean, Prasad spoke about how you need a variety of vehicles, a variety of structures to be able to really, get the balance right. Now, how deep the market is, we just heard the market is actually not so deep. How do these risk-reward equations really play out? I think we're all on this journey, even on the road now, a little bit of a poster child for us. It took a lot of years for us to get to where we are. I think many initiatives, for example, on the Gift City side, there are multiple things that are being spoken about where some of this money can get channelized in. So I would be a lot more optimistic to say things are starting to move. I think as long as we can provide a little bit of a stable policy regime here, a right dollar return can be demonstrated over years. I think a lot of money can easily flow in. I wonder if any one of you have a perspective to add. Sorry, go on.
So I just wanted to add one thing. Even in the Gift City, the LRS is applicable. So if you want to have free flow of capital funds in India, you also need to study what the other developed markets are doing. So there they have all international pooling structures in place.
Lovely. Sorry, thank you. I mean, just, we're really out of time. So my final question to all of you, which can be answered in one word, one phrase, or one sentence, is how do you see infrastructure financing in the next decade or in the decade of 20s?
I'm very bullish on this.
Bullish, okay.
That is the only way forward for our country's development.
For our country's development, infrastructure financing.
It will evolve as best asset class.
It will evolve as a best asset class.
Totally agree.
Okay, you agree with all of this?
Likewise, I think we have said, this is clearly the largest opportunity or one of the biggest opportunities as we see it, and it will be tackled through a multi-pronged approach again, I'll say.
Wonderful. What an optimistic way to end day one of FIBAC. Thank you very much. I know there were a lot of more hands raised up, but thank you so much for being very patient with us. Thank you, panelists.
Yeah, gentlemen, you can have a group photograph. Thanks indeed to the distinguished panelists for sharing their insightful thoughts and their vision. Ladies and gentlemen, I thank you all for your active participation in the various sessions held during the day. And now we come towards the end of the first day of the IBA FICCI Annual Banking Conference. May I inform you all that a networking reception has been arranged at Gulmohar and Lotus Room. Looking forward to meeting you all again tomorrow at 9:30 a.m. for more enriching and informative sessions. Good night and Shabba Khair.
Sir, how do you...
They are extensively focused on tech, we are focused on equity. And home market creation strong. India needs 2050 NIF and Africa. You are not enough. It's a good starting point to work with.